Okay. I think I have fairly taken you through business combination. Yeah. So now that we are done with business combination, let's quickly get into consolidation, finish off few questions in that also. Okay. Now, AS21 and IND-AS 110. IND-AS 110. Consolidated financial statements. Okay. Now, when I say consolidated financial statements, it means a consolidated balance sheet, a consolidated P&L, and a consolidated cash flow statement. Predominantly, these three put together, we call it as consolidated financial statements. However, if you look at CMA final, they have always been testing only on consolidated balance sheet, but not P&L or CFS. Okay. So we are going to cover consolidated balance sheet only predominantly, understand how it's supposed to be done. Okay. Now, what does consolidation mean? Standard says it is line by line addition of items in financial statements of parent and subsidiaries financial statements, parent and child or subsidiary, child financial statements. Now, if I just do line by line addition of all the items, it can just be called combination of financial statements. Why call it as consolidated? Okay. Here comes the purpose. The background behind preparing consolidated financial statements is there is somebody called an ultimate holding company or ultimate parent company. Okay. This ultimate parent company, it has got a set of shareholders. It has got a set of shareholders. Now, these shareholders are people who will ask for the company saying that, look, I have made so much investment in the company. You took this money, invested in another company also. You are giving me a separate balance sheet P&L for that company separately, this company separately. All that is fine. Individually, I am able to see, which we call as standalone financial statements. But the problem is, if I would like to see my investment as a whole, how it is performing, I don't have a single document which will talk about all clubbed together. All clubbed together. That is the point where the requirement for consolidation came in. That is the point where a requirement for consolidation came in, where I will be consolidating the other entities in which I invested into my financial statements, such that my ultimate holding company's equity shareholders can just go through that one document alone and decide whether the performance is good, bad, ugly, and review their investments. Okay. This is the ultimate objective as to why consolidated financial statements are prepared. Okay. Now, what do we do in consolidation? For that, first we need to understand something called as control. What does control mean? Control means there are different types of controls. I think yesterday I have mentioned about something called as de jure and de facto. Okay. Now, there are few things which by rule will tell that I have control. There are few instances where by facts and circumstances I can tell that there is control. I would give you various instances. Accordingly, you will make sense out of it. For example, I hold more than 51% of an entity. Okay. Or more than 50% of an entity. Now, by rule, if you hold majority stake in a company, you can call yourself having a controlling interest in that entity. Okay. In fact, you need to observe all stages of interest. So from 0 to less than 20%, we call it as minority interest or non-controlling interest. In AS, the language used is minority interest. In Ind AS, the language used is non-controlling interest. From 20 to 50%, we call it as substantial interest. Okay, substantial interest. Beyond 50%, up to 100%, we call it as controlling interest. Okay. Beyond 50% it is controlling interest. This is normally what we call as control based on rules. Okay. Now, Ind AS defines control on a qualitative factors. This is based on rules. Ind AS does not say this to be rule, this to be the real control. It says control in a different perspective. It looks from a qualitative parameter. Qualitative parameters. Okay. What qualitative parameters are there? The first is ability to influence the other entity. Ability to influence the other entity. We also call it as overpower. Okay. We also call it as overpower. Now, what does this mean? This means that I actually have a very minor stake there. But whatever I say, that company will listen to me. Best example, take Infosys. In Infosys, Narayan Murthy today holds hardly 4%. But if he says this should not happen, entire board will agree to it. There is no second decision taken. Okay. Maybe they will try to convince him why they are correct, but they will not speak against him. Okay. Why is that so? Because it is the brain child of Narayan Murthy. He has grown it so big. Today, everything, every operation, every system in place, everything is done by that single man. Okay. in which case the respect what he owns is different. For that reason, one guy, he can influence any decision. Today he's not part of the major activities also. He's not the CEO. He's only the chairman, that's all. He's only the chairman, but oversees what's happening inside Infosys, that's all. He's not, he has created a fresh blood of governance into the company, and they are taking care of the governance. He is not part of the governance at all. In such case also, today if he goes and sits in the board, whatever he says to it, everybody should accept. Okay, such kind of ability to control is what I am calling as ability to influence the other entity or the same entity also. Now, say for example, this Infosys has went and invested in a data science company. Now, this data science company might have hardly given out 10% equity to this Infosys. Now, will the data science company be influenced by Infosys or not? Obviously yes. Why? Because this man is able to invest in them a little, but he's also cautioning him, saying that you need projects. That project should come only from Infosys. I just invested 10%. If that project does not come, your company is gone. Yes or no? So like that, if he is in a position to influence, it indicates that on the other entity he has got that influence. Yes or no? Okay. So such influence is what I am trying to talk about. Second, okay, second, link between qualitative link between variability, in fact, and return. Link between variability and return. What is this about? Here we are talking about a situation where my ability to influence the other entity and return from that entity are decently linked, which means say maybe Tata, if they have acquired a smaller group, now does that mean I have acquired them by paying a huge sum? Does that mean I get equal amount of returns? There is no requirement that I should get profits out of every investment. I invest with a like how we discussed yesterday, strategic purposes and all. Okay, so I invest at a higher valuation or something, but I might not get returns out of it, but still I have control over the other entity. Okay, now I paid extra money over and above what is actually required. Why? Because I would like to have a controlling interest. Okay, do I get relative returns out of it? Maybe not, but my intention is going forward it becomes big, it becomes large, so that I make good money out of it, or good projects can be pitched out of that. Okay, in such case you would look at the link between variability of investment and also returns out of that investment. Okay, so these are kind of factors which you need to look at. When we look from the qualitative parameters to define control. The moment control is established, automatically I have to prepare something called as consolidated financial statements. Okay, now how do I define control in few circumstances? I will give you few examples. Please see. Say there is an entity. In this entity, A Limited holds 40%. Okay, A Limited holds 40%, and the remaining 60% is held by 60 unrelated individuals. 1% each. Unrelated individuals 1% each. All of these guys put together hold 60%. Now, if you look at the company's, if any serious decision has to be taken, will these all guys come together? Unrelated parties. That means I am the only shareholder holding majority control. I would not say more than 51% here. I have the ability to influence decisions. Why? Because out of this, if 50% of this go and say yes, if 50% go out and say no, will their voting stand? It's hardly 30%, not satisfactory. Now, if I join hands with them, with either a yes or no, I am in a position to take decisions, yes or no. I am in a position to take decisions. In which case, standard says, though you don't satisfy the numerical dominance, here you are satisfying this variability and returns. Yes or no? If you observe, it is only 40%. Numerically, you don't hold majority, but still you are in a position to influence the other entity. You have that controlling interest. Am I making sense? Okay. Hence, A Limited can be considered as ultimate holding company, and it will have to consider it for consolidation. Okay. So these are kind of factors which we look through in defining whether control exists or not. Okay. So there are many other examples which I have given in the material to you, which you can quickly go through. Now we will get into how we do the problems. Okay. Now I will tell you multiple situations. Then we will come down to the steps in consolidation. Okay. Now there is A Limited. It's A Limited, and then there is B Limited. Okay. A Limited has got 100 equity share capital, 100 reserves, 300 liabilities, 200 assets, non-current assets, 100 investment in B Limited, face value 100. Okay. And then I have another 200 current assets. Total my balance sheet is 500. Okay. Now in B Limited, if you see, 100 is equity share capital. I have 100 reserves, 100 liabilities, 300 assets. This is my balance sheet. Okay. Now, if I have to prepare a consolidated financial statement of A Limited CFS, consolidated financial statement. Okay. Normally, I told it is line by line addition of assets and liabilities. Yes or no? So this 200 will be added with this 300. Say it is 500 here. Okay. This 100 rupees will knock off against this 100 of equity share capital. Eventually 0. This 200 rupees, you don't have current assets. Say in the subsidiary 200. Equity share capital, you take it as it is of the holding company. 100 rupees is the reserves what you have. 300 current liabilities and 100 rupees outside liabilities, all put together 400 here. So this is basically how much? 600. What went missing? Whose 100? This, sir. So it is basically 200 then. Okay. Okay. So 700. 700. Why did we do like this? Why? Because I would like to, my intention in preparing consolidated financial statement is only to show the equity shareholders of ultimate holding company, look, this is your value. Against this, these are your results. This is basically the performance of the company as a whole, is what I would like to convey. Okay. Now, I will slightly change the situation. I will slightly change the situation. The same example, here I have invested 150 instead of for 100% of the equity in B Limited, I invested 150. Okay. So this becomes, how much it is? 550. Here it is 350, say liabilities outside. It is again 550. Okay. Now, how would this balance sheet be now? Now, tell me, your assets 200 plus 300, no change? Yes or no? So it is 500. Investment, I invested 150 when their equity value is 100. Yes or no? Why did I pay that extra 100, extra 50? Goodwill. Goodwill. Okay. So that means goodwill of 50 is getting created here. Then I have 200 of current assets. Take 200 current assets as it is. Take 200 of current assets. Now, liability side, as I told you, equity share capital is only from the perspective of holding company's ultimate equity shareholders. So it is only 100. It is only 100. Then reserves. Since I hold 100% of that subsidiary, I can take 100 of mine and 100 of his together. Okay. 200. Then I have an outside liability of 350. They have an outside liability of 100. All put together 450. Is it matching now? Okay. So it is 750, 750. Am I making sense? What did I do here? I invested more than what its equity share capital value is. Okay. Now I'll take again another example. I invested not 150 but only 80. Only 80. That means my balance sheet total is 480. Okay. Here it is going to be 280. 480. Okay. Now what would be the position of my balance sheet, consolidated balance sheet? I have got assets, no change, 500. Okay. Something which is worth 100, I bought for 80. I paid less for it. What should I do? I got gain. Hence, I will recognize it in capital reserve. Capital reserve. Hang on. Okay. Next. 200 is my other assets. Take 200 as it is. Equity share capital, only holding company 100. Reserves, I will take this plus this 200. Apart from this, capital reserve of 20. Capital reserve 20. And then liabilities 280 and 100, 380. All put together, how much is this? 700. And here also 700. Okay. This is how it happens in case. This is how it happens in case you don't have non-controlling interest at all. It is just me and my only subsidiary where I hold 100%. Okay. Wholly owned subsidiary this is. Now we will slightly change the situation. Now we will slightly change the situation. I am A Limited. I am A Limited. There is B Limited. It's B Limited. Now, in B Limited, equity share capital is 100. Reserves are another 100. Outside liabilities is 300. Okay. And all assets put together 500. Okay. Now coming to A, equity share capital is 100. Reserves is another 100. Outside liabilities 300. I have non-current assets of 200. Investment in B 80%. 80%. Okay. I bought for 80, say. Okay, 80% I bought for 80. And I have current assets to the tune of, what is the balance? 160, yeah? 260, yeah? 240, it is 500, no? 220. Okay, it is 500. Now please note, I don't own 100% of B Limited. I own 80%. Okay. Now Ind AS says the remaining 20% as non-controlling interest. It did not use the word called minority interest. Why? Because I gave you the previous example. If you collectively see, they hold all put together 60%, but no use. They don't have the ability to control. They are not minority. They are not someone who holds less than 10% and all, 20% and all. Collectively, all of them put together, they are greater than 50% in number, but don't have the ability to control. They all will say, if you say yes, I will say no. That kind of category. Okay. For that reason, all that 60% of are useless for me. I am only talking about someone who can join hands with me. That is, I am the only fellow. Though I hold only 40%, I hold the ability to control. Is it clear? Now, now tell me, in this situation, how do I prepare consolidated financial statement? First and foremost important thing what you need to do is, if I say 80% of that other entity is mine, if I say 80% of that other entity is mine, I will have to take 80% of 500 assets, 80% of outside liabilities of 300, 80% of reserves 100. Out of 100, 80% is 80 mine. Equity share capital, out of 100, 80% is mine. If I do like this, it might not give a holistic picture. Okay. Hence, what standard suggested is, standard suggests there are two ways in which consolidation can be done. One is called as total consolidation technique. Second is called as proportionate consolidation technique. Okay. Now, out of these two techniques, Ind AS suggests you to follow only total consolidation technique in any situation. In any situation, it is only total consolidation technique. There is no concept of proportionate consolidation technique to be adopted. Now, what does total consolidation technique mean? What does proportionate consolidation technique mean? First, I will tell you what is proportionate, because thereafter we will not do that. Okay. So, proportionate consolidation technique fairly speaking, AS 21 does not follow. Fairly speaking, AS 21 does not follow. Where it will be used is, in case AS 27 has to be adopted, then you will follow proportionate consolidation technique. What is AS 27? Joint ventures. Only in case there is a joint venture, you will adopt something called as proportionate consolidation technique. Otherwise, proportional consolidation technique is nowhere used in AS also. Okay. Now I will talk about proportionate consolidation technique in this case. What will happen is, in proportionate consolidated balance sheet, I will show equity share capital. My own equity share capital 100. Reserves, mine 100, his 80, because I hold 80% in him now. Okay, mine 100, his 80, 180. Then I have outside liabilities 300. They also have outside liabilities 300, but only 80% is mine. Okay, so outside liabilities, it is 540 both put together. Assets, non-current assets, I hold 200, they hold 500. Out of 500, only 80%, 400. Okay, so 600 is my non-current assets. Investment is going to get cross cancelled here with my equity. Okay, there is no goodwill or capital reserve also. Like that only I intentionally fit that number. Okay, and then current assets 220. That's all. Okay, current assets 220. So like this we do in case it is proportionate consolidation technique. Tell me what is the total? 880, 820. Okay, clear? Please note, ఇది మీకు అర్థం కావడం కోసమే. దీని తర్వాత మళ్ళీ దీని జీవితంలో ఎక్కడ చూడరు మీరు. ఓకేనా? ఇండియాస్లో జాయింట్ వెంచర్ ఉన్న ఇది పనికిరాదు అక్కడ. అందుకనే చెప్పా, దిస్ యూజ్డ్ ఓన్లీ ఇన్ AS 27. In India, this is nowhere used. Okay, so this is how proportionate consolidation technique would be done. ekkadado marchipondi nakkalla meeku. Now let us look through how total consolidation technique works. Under total consolidation technique, total consolidation technique. Now total consolidation technique means I will consolidate the entire balance sheet of B into mine and provide for what others hold in that company in my consolidated financial statements as a liability. As a liability. In such case, I call it as total consolidation technique. That means I will literally add line by line fully into my balance sheet, but provide for minority interest or non-controlling interest in my consolidated financial statement, saying that, look, I have taken the entire balance sheet into mine, but just because I have taken entire balance sheet into mine doesn't mean everything is mine. Out of this total, here is a value which pertains to somebody else, is what I am going to disclose. Okay, now non-current assets, take fully. Now 200 plus 500, 700. Okay, then investment in B 80%, forget about it, it will eventually not be there. Okay, next current assets 220, take it. Okay, now equity share capital will not change, same 100. Now comes reserves, please see. Now comes reserves, please see. Mine 100, out of the reserves of the subsidiary, mine is 80%, other party holds 20%. Yes or no? Right now what am I doing? I am cancelling this 80 against this 100. So there in equity share capital 20 is still there. Okay, along with that, minority interest will hold out of this 20%, yes or no? Or non-controlling interest will hold 20% out of that. So let me leave that also as part of non-controlling interest. Okay. So I will add to my reserves only my share of profits. Okay. My share of profits. Reserves and surplus would be 100 plus 80, which is 180. Then comes non-controlling interest, which is 20 plus 20, 40. Then comes other outside liabilities. Okay, which is 300 plus 300, 600. Am I making sense? All put together, how much? Okay. This is what we do in total consolidation technique. This is what we do in total consolidation technique. Now, types of problems what you have in consolidation. Types of consolidation. Number one, single subsidiary. That means there is a parent and there is a child. Number two, multiple subsidiaries. There is a parent and there are two childs, C1, C2. Number three, chain holding. There is parent, there is child one. This fellow has a child. Chain holding. Okay. Number four, triangle holding. There is parent, there is child one. Okay. There is child two. In this child two, child one also invested. Okay. Next, number five, cross holding. There is parent, there is child. P invested in C. Even before P invested in C, C already invested in P. Okay. Though you have so many varieties, from CMA perspective, at the max, this is what asked. Multiple subsidiaries కూడా ఈనాడు అడగలేదు మీకు. కరెక్టా కదా? Okay. Only plain vanilla problem is what's being asked for you in CMA. Enana choice. Okay. So single subsidiary is what? A problem which could be asked at the most. Okay. Now, how do we solve a consolidation problem? There are multiple ways in which you can solve. There are different faculties who teach in different ways. I don't deny any of those methods. అందరు చేసేది ఫైనల్గా కన్సాలిడేట్ బ్యాలెన్స్ షీట్ వేయడానికే. ఓకే, ఎవరిని తప్పు పట్టట్లేదు. I have my own way of solving that I will teach. If you feel that is comfortable, you follow, or if you have already followed something else, go with that only. ఎందుకంటే మీ మైండ్ ఆల్రెడీ ట్రైన్ అయిపోయి ఉంది. I don't want to change that. Okay, you can go with your method of consolidation also. There is no wrong in it. Okay, I follow this procedure because I felt this to be convenient. That's all. Okay, either way is good. Okay, so any consolidation problem, steps in consolidation are these. Number one, so first of all, you need to take three important pieces of information. Date of consolidation, date of control, okay. Third is shareholding pattern. Okay, shareholding pattern. Now, once these three pieces of information are taken, in just 5 steps, you will be able to finish off consolidation. Step 1 is called as net worth analysis of child. Net worth analysis of child. First of all, what do you mean by net worth? Normally, we call it as assets minus liabilities. Okay. But on the other side, how can you express it? Is basically equity share capital plus reserves pertaining to equity shareholders. That also you can call it as net worth. Now, for limited purpose of consolidation, from this problem solving perspective, net worth means equity plus reserves. Okay, equity plus reserves. Now, this net worth analysis would be done. Net worth analysis would be done as on date of consolidation. As on date of consolidation. Second important point, this is even more critical, with respect to date of control. ఇక్కడ 3 పాయింట్లు రాసాం కదా, డేట్ ఆఫ్ కన్సాలిడేషన్, డేట్ ఆఫ్ కంట్రోల్ అని చెప్పి. ఈ రెండు చాలా 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 ఇంపార్టెంట్. ఆ 3 పాయింట్లు కూడా చాలా ఇంపార్టెంట్. ఆ 3 రాయలేదంటే మీకు ప్రాబ్లం ఎగిరిపోద్ది. ఓకే, net worth analysis of child as on date of consolidation with respect to date of control. I will explain that little later. First, let's finish it off. Okay. Now, how your table will look, if you see, if this net worth analysis will look is, there is something called as C and R. CR ante capital revenue. C and R, capital revenue. Now, below C, you should mention date of control. Below C, you should mention date of control. Whatever be the date of control, you are supposed to write that. That's initially only for you to understand your sequence of problem solving and all that. So otherwise not required. Okay. Then now you are supposed to take each item in your net worth. A, equity share capital. Equity share capital is always a capital item. Equity share capital is always a capital item. Hence, equity share capital will always be taken only on C side. Will always be taken only on C side. Okay. Next, B. You will have multiple types of reserves. You will have multiple types of reserves. What all reserves would be there? You may have general reserve. You may have P&L. You may have securities premium. Like that, any reserves, general reserve, everything. Okay. All we will take. Okay. Apart from this, you will also have, when you say net worth, it is not just equity and reserves. If at all there are any on the asset side relating to equity shareholders, what will be there? Pre-incorporation expenses, not expensed, kind of things. Yes or no? So it is basically miscellaneous expenses not written off. Not written off. If it is there, that also will come. Okay. Next, if there is any revaluation reserve, that will come. Okay. And then, for now, note it here. I'll explain about it little later. URP, upstream transactions. అదేంటన్న తర్వాత చెప్తా. అంటే మీకు తెలుసుంటే గొడవ లేదు. యూఆర్పి అంటే అన్రియలైజ్డ్ ప్రాఫిట్స్. ఓకే, యూఆర్పి అప్స్ట్రీమ్ ట్రాన్సాక్షన్స్ విల్ కమ్ హియర్. With respect to all of these items, it will fall at times only in one place, that is C. At times it will fall in R. It can fall in both the places. Okay, now what are we actually doing here is, I am trying to segregate the net worth of the subsidiary as on the date of consolidation with respect to date of control. Say for example, I in the sense subsidiary has got 20 lakh rupees worth of general reserve as on the date of consolidation. That is as on date of consolidation. Say for example, the date of consolidation is 31st March 23. I invested in that company. That means I got controlling interest in that company on 1st of April 22, 1 year before I bought. Okay, 1 year before, the company had a general reserve, whatever reserve of 10 lakh rupees. 10 lakh rupees. Now tell me, can I tell that the entire 20 lakhs which is there on balance sheet date 31st March is earned after my investment? 10 lakhs is already there with them, no? That means I am investing in a company which already has some accumulated profits. Okay, so any such profits, I should call them as capital profits of that company, right or not? Only what is earned after my date of investment, I should call them as revenue profits of that company. For that reason, I am putting a deadline stating date of control. Any profits earned before the date of control, or any net worth which the company holds already as on date of control, is capital profits. Anything which is earned after the date of control are revenue profits. This logic is very simple. You know AS 13, investment accounts. Yes or no? Investment accounts, if you receive interest before the date of investment, what will you do? You will capitalize that interest income received. Yes or no? Why are you doing that? Because that's not your real income. You should adjust it against your investment, but you should not take to P&L. Applying the same logic here, you are not going to take the capital profits into your revenue side. Okay, for that purpose you are splitting here based on date of control. Clear? Okay, now once this is done, you take total of C and total of R. This total of C belongs to 100% of the equity shareholders. Yes or no? And R total also belongs to 100% of equity shareholders. Now what you should do is, this should be split between parent and non-controlling interest. Am I making sense? Okay, now say for example, the shareholding pattern here what I have given is 80-20. Okay, in which case what happens here is, I will split this between parent and non-controlling interest in the ratio of 80-20. This also will be split between 80-20. Okay, this is what we do. Now we are done. If this part is done, trust me, you are 90% of the problem done. దీని తర్వాత ఉన్నదంతా కూడా టేబుల్ ఫిల్లింగ్ అనమాట, టేబుల్ ఫిల్లింగ్ యాక్టివిటీ. Okay, so once this is done, now you should do something called as Number 2, non-controlling interest. Non-controlling interest. ఇప్పుడు what will non-controlling interest get? He will get his share of equity share capital. He will get his share of reserves and surplus. That's all. Right? Now, tell me, his share of equity share capital, is it taken in net worth analysis or not? We have taken. His share of profits, reserves, I have put it here. All reserves and surplus of the company, everything is taken. That means if I just take this number and this number, it is basically your step 2. Do you agree? Okay. So net worth non-controlling interest is basically A, share of capital profits from step 1. Okay, I will put it as A, B, C, D. Okay, 1B, B is share of revenue profits from 1D. Can I go ahead? Now, step 3 is cost of control. Step 3 is cost of control. What does this mean? This means I as a parent has invested in that subsidiary. Why did I invest? Because I get some equity value from that other entity. Okay. Now, what is that other entity's equity value I got? This, yes or no? This is what I got from that other entity. Right? As on date of control. That means the day when I invested, I get this much share as my investment value. Against my investment, this is what I am getting. Okay. Now, I need to see whether I got a profit or loss in the transaction. Okay. So, for which we will take investment made in child. Take that value. Where will you get it from? From standalone financial statements of parent you will get. Standalone financial statements of parent you will get. Less share of capital profits from 1A, which is this. Okay. When you deduct this, if it is positive, you call it as goodwill. If it is negative, you call it as capital reserve. Ante, you have found out what is the worth of that entity. అందులో నీ షేర్కి ఎంత అన్నది తెలుసుకున్నావు ఫస్ట్ స్టెప్లో 1Aలో. ఓకే, ఆ 1A వాల్యూ కంటే నువ్వు ఎక్కువ పెట్టావా తక్కువ పెట్టావా? అర్థమైందా? ఒకవేళ ఎక్కువ పెట్టుంటే కనుక గుడ్ విల్, తక్కువ పెట్టుంటే క్యాపిటల్ రిజర్వ్. క్లియర్? దిస్ ఇస్ థర్డ్ స్టెప్. నెక్స్ట్, fourth step is, so now if you carefully observe from first step, if you see, I have used 1A. ikkada 1A is used, 1B is used, 1C not yet used, 1D is used, right? Now all that you have is 1C to be used. So fourth step is called as reserves for CBS. CBS ante consolidated balance sheet. Reserves for CBS. Okay. How do I prepare it? Take particulars and draw so many columns for so many items of reserves you have in your balance sheet. For both the companies together, you should see. Say for example, in holding company, there is general reserve, there is securities premium, there is P&L. Okay. In subsidiary, there is revaluation reserve, there is something else. Okay. Investment allowance reserve. Every reserve should have one column. Okay. So take all reserves, then H limited, that is parent limited own reserves first should be first taken. You take full of whatever parent has got. Okay. 100% will be taken. Child, you already did it here. Yes or no? 1C. 1C is already done. So from child, you are supposed to pick it from 1C. Only thing what you need to be cautious here is, in 1C, if you have multiple items here, I am taking only one part as 80% of the total. All I need to give is a breakup of that 80% for these values, for the above values. For the above values, I should give breakup. That means, say for example, I have 30,000 here, 40,000, 50,000, 60,000. All put together, how much is it? 1,80,000. Okay, 1,80,000 into 80, split between 80% and 20%. It is going to be how much? 1,44,000. 44,000 and 36,000. Right? 36,000. Okay. Now, where will you put this 1,44,000? It is actually P&L 30,000. This 1,44,000 has got something related to P&L. This 1,44,000 has got securities premium, something about securities premium. Miscellaneous expenses not written off is there. Like that, you have different items. So what you need to do is, you should give a breakup saying, out of this 30,000, 80%. Actually, all put together 80% is this. I want you to give individual breakup here for each number. Why? Because without that number breakup, you cannot take numbers here. Am I making sense? Okay. So you take that numbers also and take totals. Oh, wait. We will not take totals yet. Here, there is an important adjustment called URP downstream. URP downstream. I'll explain what those words are little later. Okay. URP downstream. In case there is URP downstream, deduct that from your P&L. If P&L is not there, maybe any other reserves, general reserve also, no problem. Okay. Once this is done, take totals and take a grand total also. Take a grand total also. Okay. With this, all steps in consolidation are over. Fifth step is nothing but preparation of consolidated balance sheet. Fifth step is consolidation of balance sheet. Consolidated balance sheet preparation. Now what all will happen? Start with assets. Okay. Non-current assets. Holding plus subsidiary you can take. Or parent plus child, whatever. Okay. Parent plus child. Next. investments if you have in your balance sheet, that will get cross cancelled, yes or no? Cross cancelled, and it will lead to goodwill if step 3 is positive. Yes or no? Step 3, if it is positive, it will come here. Then you will have current assets. Again, parent plus child. Parent plus child. Okay. Next. With this, you will be done with your assets. With this, you will be done with your assets. Now coming to equity and liabilities. Start with equity share capital. Only parent. Only parent. Then reserves and surplus. Step 4. Okay. Non-controlling interest. Step 2. Non-current liabilities. Parent plus child. Okay. Then what else are you left with? Wait. Goodwill is taken in asset side. In case there is capital reserve, hang on. If there is capital reserve, it will form part here itself. Capital reserve, if it is there, it will come here itself. Okay. This will also get added here itself. You need not separately do again. Okay. Then you have current liabilities, again parent plus child. Finish. So these are broadly the steps what we are supposed to do. Okay. Now in this, you will see some adjustments. In this, you will see some adjustments. I'll first tell you what those adjustments are. Then while we do problems, the problems which I have picked, the 2 problems are comprehensive problems. Every adjustment I have added in that. Okay. Yeah. Additional adjustments. What are possible are, number 1, as I was already talking about, unrealized profits is an adjustment. Number 2, revaluation of assets is an adjustment. Number 3, bonus issue is an adjustment. Number 4, intercompany owings is an adjustment. Number 5, dividend is an adjustment. Okay. Out of this, you have already seen intercompany owings adjustment in your amalgamation. If at all there is any intercompany owing between parent and subsidiary, cross cancel. Cross cancel. That is nothing to explain here for you. Okay. Now I will pick up each adjustment, explain what we will have to do, so that we will take break. I can see faces already sleepy. Okay. We will finish off this explanation alone, take break, then come back and finish off those couple of problems. Okay. Ippade kavala? Now, I don't mind. Either way is fine for me. 2 hours అయిపోయిందా? Alright, fine. Take a break then. No problem. Let's understand each of these adjustments now. The moment we are done with this, we are fairly done and we can start ahead with the problems. Okay. Now, the first adjustment is about unrealized profits. What do unrealized profits mean? First of all, keep this consolidation part aside. There could be transactions of purchase and sale between the parent and child. That means parent can sell goods to child, okay, or child can sell goods to parent. Now, the problem is not about selling goods by one to the other and making profits. That's not the problem here. The problem is a parent sells goods to child or vice versa, and the other party holds goods with them on the balance sheet date. That's the issue here. Why is that an issue? Because your Ind AS or AS on inventory tells that your inventory should be shown on the balance sheet date only for cost or NRV, whichever is lower. Now, in standalone financial statements, if parent purchased goods from child, this inventory actually contains a little margin made by the child. Yes or no? But from parents' perspective, that is at cost for them. No problem. Same way, if parent sells goods to child, there is some markup, there is some profit made by parent. Child shows that at a cost for them. That is actually their cost. The problem is when you are actually clubbing these two together, you are now telling that it is only one entity. In which case, the goods sold by parent to child contains a markup in child's inventory, and the P&L of parent has got that profit. Yes or no? This is the problem. Standard asks you to show your inventory at cost or NRV, whichever is low. But now I am saying both these companies are one, and it is not shown at cost. Because from parent's perspective, say for example, 100 rupees is the cost of goods. Parent adds 20 rupees markup. 120 is the price at which it sold to child. Okay. Same goods, another 100 rupees parent also holds in its balance sheet. Okay. What will happen in parent's balance sheet? There will be 100 rupees. Okay. And 20 rupees is the profit in P&L. In child's balance sheet, there is 120 of stock. Now, when I club these two, P Limited consolidated, my inventory I am going to state it as 220, and I would say P&L I have a profit of 20. Not making sense, right? When I say both entities are one now, I should not show this profit of 20 here and here. I am simply inflating the balance sheet value. Right? Hence, that is what I am calling as unrealized profit due to consolidation. Individually, did they make profits? Yes. But when I consolidate, these are supposed to be, any profits between these two entities should be cross cancelled. Okay. For that purpose, you need to do something called as URP adjustment, unrealized profit adjustment. Is that clear? most of the times this adjustment will be given from a perspective of stock, from the perspective of stock, but it can be with any asset. That means parent may have sold machinery to child at profit, or child may have sold some plant or land at profit. It could be anything. It could be anything. But most of the cases you will see inventory as a adjustment. Even if the question this time in the examination, if he comes up with if he wants to test something new and would like to change from inventory to plant and machinery also, don't get surprised. That's why I'm telling you in advance. Okay. So this is with respect to adjustment, what can happen. Now we will come to accounting. I have mentioned about that URP in two places, step 1 and also step 4, if you see. Okay. In step 1, I called it as URP upstream. URP upstream. In step 4, I called it as URP downstream. What are these upstreams and downstreams is what we need to understand. URP upstream means, URP upstream means the goods moved from child to parent. The goods moved from child to parent. That means profit is in whose hands? Who earned profit? Child made profit. Okay. Stock is with whom? Parent. Okay. Now I am trying to eliminate the profit. Now whose profit am I eliminating now in upstream transaction? Child's profit. Where am I analyzing child's profits? In step 1. In step 1. That's why I have put this URP upstream in step 1. Okay. Now come to second possibility, URP downstream. URP downstream. What does this mean? Stock is moving from parent to child. That means profit is made by whom? Parent. Is there any place other than step 4 where I am analyzing parents' profits? No. I am just taking parents' 100% profits in step 4. Yes or no? That is what I have mentioned here. Please see. P Limited's own 100% is what I have mentioned. Okay. That's why here I am going to eliminate URP downstream. Okay. That is why these two steps are important. Is that clear? Okay. So out of 5 adjustments, 2 are done. One is intercompany owings, you know. Second is URP. Now you understood. Okay. Now I will now talk about bonus issue. Fairly speaking, this is not a adjustment per se. This is a caution. This is a caution. This is not an adjustment as such. It's just a caution. What kind of caution? At times what happens is, in the problem he will give you shareholding pattern. He would tell something, and in the balance sheet when you see, parent will parent might not have recorded that bonus issue. Child might have recorded bonus issue. Parent might not have recorded the bonus issue. Say for example, initially 10,000 shares are there in subsidiary or child. Out of this 10,000, 80% is held by parent and 20% is held by non-controlling interest. Okay. So 8,000 and 2,000. This child announced a 1:1 bonus issue. Announced a 1:1 bonus issue or 1:2 bonus issue. 1 for every 2 shares held. Okay. Now what will happen? It is going to be 15,000 in the ratio of 80-20. Yes or no? What would it be? 12,000, 3,000. Right? 80-20 ratio. Now, this is what's accounted in child. In parent's standalone financial statements, he will say investment in 8,000 equity shares of child some value. Okay. Now, if you don't carefully observe about this bonus issue, you will think that the ratio is 8,000 out of 15,000. That means somewhere around 55% is my controlling interest, is what you may think, and completely collapse the problem. Am I making sense? Okay. So whenever you have any bonus issue, you need to completely see through in all places bonus adjustment is done or not. Okay. That is another very cautionary point. It's not an adjustment as such. It is a caution point. Okay. Next, apart from that, you have dividend adjustment. This is something which you have already learned in your AS 13 investment accounts. Okay. If there is any dividend relating to pre-acquisition period, if there is any dividend relating to pre-acquisition period, what you should be doing? Yeah, that is basically a capital profit. Yes or no? Yenanna ekkado alochistunnava enti? So it is basically capital profit for me. That means I am supposed to adjust this against my investment. I am supposed to adjust this against my investment. Okay. Now what he will say is, in questions he would somewhere mention saying that there is dividend relating to 2020-21. The date of control is 31st March 2021. Okay. Now the dividend whatever has been received has been taken into P&L and చెప్పేసి వదిలేస్తాడు. The moment he has mentioned that it is taken to P&L, it should strike in your mind saying that that is wrong. Okay. So what you should be doing? First you should do standalone financial statements corrections. First you should do parents standalone financial statements corrections. Only then you should go for consolidation. Okay. First you should do correction. What corrections will you do? Already, say for example 10,000 is the dividend which you got. Okay. And your investment value in your balance sheet is 10 lakhs. Okay. Now this 10,000 should actually get adjusted against your 10 lakhs of investment. Right now what happened? This went into P&L account. This went into P&L account is what he is saying. Now you should debit your P&L account and credit the investment account. Yes or no? So that means you should do SFS adjustments first. SFS means standalone financial statements. SFS adjustment first, where you will write saying P&L account debit to investment in equity shares of Child Limited. Okay. 10,000, 10,000. Okay. By doing this, what happens is your investment amount is corrected now. That should be used in step 3. Corrected amount should be used in step 3. You should not go with your what is given in the balance sheet in your question. Okay. So this is another important aspect which you need to be cautious about, dividend adjustment. Lastly, revaluation adjustment. Now, revaluation adjustment is very, very critical. I will tell you why. While talking about business combinations, I told that if I intend to buy their equipment at a fair value, I will take it at fair value. Okay. If I intend to buy their equipment at fair value, I will take it at fair value. That means on purchase itself, I am able to take it at fair value, forgetting about their book values. Forgetting about their book values. Now, by investing in another entity, while investing in another entity, in equity shares especially, while investing in another entity's equity shares, then also I would have done that calculation of this asset should be considered so much value, not only the book value. All that calculations I would have done earlier. Yes or no? But nowhere it will be documented. I will just put money on that equity shares, that's all. Nowhere it would be documented. I will just put money in that company. Now what are you doing? You are consolidating. Now you are doing what? Consolidating. When you are consolidating, you should bring those assets into your books at the rate at which you thought while investing. Yes or no? Had it been business combination, day one when you are bringing those assets inside itself, you are saying fair value is the value. But in consolidation, you are not doing that. No, you are just putting money into that company's account. That's all. You are just getting a share certificate. Today, when you are actually bringing that balance sheet into my balance sheet, I should not take book values of those balance sheets, but I should consider the fair values which I thought while investing in that company. Agreed? Now I'll make you explain. I'll make you understand this. Please see. I invested in equity shares of X Limited. Face value 10 rupees. Market value 100 rupees. This is the price at which I bought. Okay. I bought entire 100%. Okay. 100% I bought. Now, their balance sheet is like this. Land, book value 100. Okay. Building, book value 100. Plant and machinery, book value 300. Other assets, all put together 500. Total 1000. Okay. And you have equity share capital, entire 1000. This 1000 is what I bought. Okay. Now, this 1000 I bought for, now I'll tell you, this is the book values. Okay. This 1000 I bought for, I know that the value of land is 500. I know that building value is 80. Plant and machinery 270. Other assets all put together 600. Now tell me what is the total? 500 plus 80 plus 270 plus 600. 1450. Now I invested for 100% 1450. I invested for 100% 1450. Book value is how much? Only 1000. I paid 450 extra. Why? I know fair value is so much. I know fair value is so much. Now, if I have to prepare consolidated financial statement, if I take these book values, how will it match with my investment? Yes or no? How will it match with my investment? It will not match. For that reason, I should take fair value only. I should take fair values only, because 1450 is what I have invested. For 1450, how will I bring it here? I will bring land into my books at 500. Okay. Buildings, I will get it at 80. Plant and machinery, I will get it at 270. Other assets, all put together 600 is what I bring in. Only then this 1000 will get knocked off here. Yes or no? Okay. So if I take it only at book values, balance sheet will never match. Got it? So for this reason, while revaluation is done on the date of investment, that revalued numbers should be considered for your consolidation purpose. Is that clear? Now, the moment you say you will be considering revalued numbers on the date of control, automatically your depreciation also should be done on the revalued number only, no? Till now, child would have done revaluation, child would have calculated depreciation only on book value. Now I want that also to be corrected. That means again P&L will have an impact. Okay, so that means whenever a revaluation adjustment is there, there are two things which you need to see. Number one, consider fair value of asset revalued. Number two, consider depreciation on asset revalued. Okay, so differential amount of depreciation, whatever is extra supposed to be charged, is what you're going to bring in. Is that clear? This is what with respect to your revaluation adjustment is. Clear? For all of this, I have given you material. You can go through that. Okay, so that is what we are going to do. Now, having said this, said about this, let's begin with the questions given there. I think I've just given 2 questions. Should be sufficient. Huh? Yeah. Please see 12th question. For you to do. Please see the question which is on the screen. 12th question is what it's given. Don't bother about the problem number and all. I've just picked up from my it here for your problem solving. That's all. Okay. Yeah. The following are the abridged balance sheets of Chai and Sam. Okay. All this talent belongs to my team behind. So they'll create all these names. Okay. I think it's almost like now no more relevant actually. Chai and Sam. Yeah. Let's not bother about it. Ayyo. Huh? Yeah. Equity share capital. Equity shares of 100 each. Reserves and surplus. In that you have general reserve and P&L. Trade payables, total assets, fixed assets, investments in equity instruments, that is investment in equity shares of SAM is 5 lakhs. Then current assets total. The following additional information is provided. Chai Limited acquired 3000 shares in SAM on 1st July 24. The reserves and surplus position of SAM as on 1st April was as under: general reserve 2,50,000, P&L credit balance 1,20,000. On 1st October 24, SAM Limited issued 1 share for every 4 shares held as bonus. No entry has been made in the books of Chai for the receipt of these bonus shares. Okay. On 30th September 24, SAM Limited declared a dividend out of pre-acquisition profits at 25% on 4 lakhs. Its capital on that date. Okay. Chai Limited created the dividend to its P&L account. You know what to do. Okay. Chai Limited owed SAM Limited 5 lakhs for purchase of stock from SAM. The entire stock is held by Chai on 31st March 25. SAM Limited made a profit of 25% on cost. Okay. Prepare consolidated balance sheet of Chai and its subsidiary SAM as on 31st March 25. So this is what the question is about. Okay, now what all adjustments did you see in this question now? Yeah, first of all, he gave you bonus. Second, he gave you dividend adjustment. Third, he gave you URP adjustment. Now, URP, what URP it is, downstream or upstream? Who made profit? Who made profit? Sam made profit. That means upstream. Stock moved from Sam to Che. Okay. So upstream. So that means 3 adjustments are covered here. Okay. So let's do those. Now tell me, out of these, how many are SFS adjustments? How many are SFS adjustments in this? URP is a consolidation adjustment only. While preparing net worth analysis only we are going to do, or else step 4 we are going to do. It is not an SFS adjustment. Standalone financial statement adjustment kadadi. What is a standalone financial statement adjustment? Pre-acquisition dividend is a standalone financial statement adjustment, because he said it was taken into P&L of Che. Okay. Next, bonus is also a caution adjustment. Caution. Okay. Now tell me, he says on 1st October 24, Sam Limited issued 1 share for every 4 shares held as bonus. No entry has been made in the books of Che. That means in Sam, did he do or not? He's saying it is done. Now look at Sam's share capital, 5 lakh. Okay. Now look at the wording which he has given, saying that he has given pre-acquisition profit out 25% of 4 lakhs as dividend. That means earlier my share capital was 4 lakhs. After giving that 1 for every 4 share held as bonus, it has become 5 lakhs, which is right now reflecting in the balance sheet. That means he is right in telling that Sam has accounted it. Okay. So it is just in the books of Che, we are supposed to make adjustment for that bonus issued. Okay. So these are 2 things which we need to do. Now tell me, did he tell you what is the date of consolidation? Emma? Date of consolidation is 31st March 25. What is the date of control? Date of control, he says it is 1st July 2024. Now, do you know profits and losses, reserves and surplus and all as on that date of control? Because in your net worth analysis, you need that date split. No. Do you have that information? Actually not. He gave you from 1st April. He gave you. As on 1st April, these are the reserves is what he has stated. These are the reserves is what he has stated. And at the end of the year, that means at the beginning of the year, at the end of the year, he told you it is, at the end of the year, he gave you it is 1,70,000, 1,30,000. Sams. Yes or no? Now, you need to analyze 5 lakh rupees, 1,70,000 and 1,30,000. What is the statement I wrote that there? Analysis of net worth as on date of consolidation. That means 5 lakhs, 1,70,000, 1,30,000. With respect to date of control. Date of control is 1st July. But as on 1st July, I don't have information. As on 1st July, I don't have information of profits. What is the breakup of profits exactly on the date? I don't have. I have from 1st April. On 1st April, what are the profits? I know. On 31st March, what are the profits? I know. But I don't know exactly on 1st July. In such case, what we will assume is, it is assumed that profits are earned evenly throughout the period. Anukuni, we will proceed. So that we will do it on a time proportionate basis and split between pre and post incorporation. Is that clear? Okay. So with this intro, let's begin with the solution. So first thing what we are supposed to do is SFS adjustments. Then only we will go to consolidation. Okay. So problem 12. Part 1. Part 1. SFS adjustments in Chai Limited. Okay. Now in that, A for bonus shares. For bonus shares. Okay. Shares bought. Shares bought is basically how many? 3000, yes or no? Shares bought 3000. Bonus shares. Bonus shares. 1 for every 4. 3000 divided by 4, how many? 750, yeah? 750. Okay. Number of shares outstanding on 31st March 25. 3750. It's just a number. That's all. B. B. Pre-acquisition dividend adjustment. Pre-acquisition dividend adjustment. Okay. Now, what is the amount of pre-acquisition dividend this fellow received? Yeah. Please hang on. Now, please see. He has issued 25% on then share capital, which is 4 lakhs. Okay. So 4 lakh into 25% is the dividend which is given for all the shareholders. Out of that, mine was how many? 75%. And initially 3000 or 3750? Only 3000 before bonus issue. Okay. So it is going to be 4 lakh into 25% into 75%. How much is it? 75,000. Okay. Now what entry will I write? P&L account debit to investment in equity shares of SAM. 75,000. 75,000. Okay. Now at this juncture, whenever you have some such SFS adjustments, please write summary of accounts used. Okay. Summary of adjusted accounts. Summary of adjusted accounts. Number 1. What all accounts did you adjust now? P&L you have adjusted. P&L revised balance would be what? Initially in Chai, you have got P&L of 1,60,000. Okay. 1,60,000 minus 75,000. So now you have just 85,000. Number 2, investment in SAM. Earlier you have got 5 lakh rupees. Now you are adjusting 75,000. It has become 4,25,000. Okay. Hereafter, if you are using these accounts, you should use only these numbers. So part 1 SFS adjustments are over. If there are any SFS adjustments in child, that becomes part 2. Okay. Then part 3 will become consolidation. Now in this problem, you don't have SFS adjustments in part 2, that is in child. Say for example, he says bonus has been announced but not accounted by Sam. In such case, that becomes a separate SFS adjustment. Okay. Now, so let's start with part 2, consolidation. Consolidation. In this, start with 3 important points: date of consolidation, date of control, shareholding pattern. Date of consolidation is 31st March 25. Date of control is 1st of July 24. Correct? Shareholding pattern is 75-25. You can either do it as 3000 is to 1000 or 3750 is to 1250. Now let's get into the first step. Step 1. Net worth analysis of Sam as on 31st March 25 with respect to 1st of July 24. Okay. Take C and R. Below C, put that 1724, which is date of control. Start with share capital. Share capital you are supposed to take as on 31st March. How much is 31st March share capital? Sam's 5 lakhs. Take it. Share capital always C side. Nothing comes R side. Nothing comes R side. Next. General reserve. General reserve given there is 1,70,000. Yes or no? Okay. Now, out of that 1,70,000, he says on 1st April it was 2,50,000 it seems. Okay. 1st April it is 2,50,000, and during the year what could have happened for that to become 1,70,000? 80,000 I would have withdrawn. Yes or no? I would have made a loss or something could have happened. So you need to analyze this 1,70,000. Okay. So what you do, general reserve, put a bracket beside that, working note 1. Working note 1. Okay. Leave some 10-15 line space, come down, working note 1, analysis of general reserve. Okay. Analysis of general reserve. Now, he has told you that on 1/4/24, opening balance of general reserve is 2,50,000. 2,50,000. On 31st of March 25, closing he has given you as 1,70,000. That means 80,000 got consumed. Do you see any transaction which consumed that 80,000? Dividend, huh? Enana? Bonus ichcharu kada. Bonus 1 lakh rupees bonus is given. You should assume that 80,000 of that 1 lakh is given out of general reserve. Remaining 20,000 from P&L. Okay. So now bonus issued 80,000. Okay. Bonus issued is 80,000. Enana? Dividend ఇక్కడ తీసుకురావట్లేదు ఇప్పుడు ప్రస్తుతానికి ఐఎమ్ అస్యూమింగ్ దట్ see you can either use one of those, use it for one of those. Okay, so bonus is what I'm assuming. 80,000 completely used only for bonus is what I'm assuming. Okay, now tell me this 80,000 is out of profits before my date of control. That means this 2,50,000 is C only, no? C. This is also C. This is also C. So that means net of these two 1,70,000, this is also C only. 2,50,000 is there as on 1st of April 24. Out of that profits only bonus is given. That means remaining 1.7 lakh is also out of my pre-acquisition profits only. Do you agree? So that means you can take everything on C side, 1,70,000. IAS officer. Okay, next. P&L. Again, working note 2. P&L. Working note 2. Analysis of P&L. Okay. Now please tell me what is opening balance 1,20,000. Okay. Opening balance on 1/4/24. It is 1,20,000. This is basically C. Yes or no? Next. During this year, he gave balance bonus from this only, no? If he has used only 80%, 80,000 from general reserve, remaining 20,000 he would have used from this only, no? Okay. This is bonus utilized 20,000. This is also C. Out of opening profits only I have used. Okay. Then I also gave out of my pre-acquisition profits dividend. How much did I give as dividend? 85,000. 25% on 4 lakh rupees. 1 lakh rupees is the dividend which is given. Okay. So dividend paid 1 lakh rupees. That is also paid out of the same money. Yes or no? Now if you see, after using all of this, I still have a closing balance of, on 31st March 25, I have a closing balance of how much? 1,30,000. That means this 1,30,000 is earned during these 12 months. Okay. Earned during 12 months. Okay. Now out of this 1,30,000, 3 months is pre-acquisition period, 9 months is post acquisition period. Why? Because I purchased shares in this company on 1st July. First 3 months is pre acquisition period. So what is 3 months ka profit out of 1,30,000? 32,500, and 9 months is 97,500. Okay. With this info, so 32,500 is C and 97,500 is R. Do you agree? Now sum up the entire C and take it in C column. See here. What is it? 32,500. Yes or no? R is 97,500. Am I making sense? Okay. Then apart from this, what else do we have? We have URP upstream. URP upstream is there. URP upstream. This you can do it here itself. This you can do it here itself. What is the value? Now he says stock with Che is how much? 5 lakhs purchased from Sam. The entire stock is held by Che. Okay. Sam made profit of 25% on cost. So 25% on cost means on sale price it is 20%. Okay. 20% of 5 lakhs is 1 lakh rupees. Please take. Okay. So URP where you will take? Only revenue side, because see, we are doing this adjustment only because there is a relationship between these two parties. Otherwise, we would not have done. Hence, it is supposed to be considered always on our side only. Okay. Now tell me what is the total of all of this? Seven lakh 2,500, and here it is. Take red pen and strike off and write there. I'm an idiot. 1 lakh is a reversal of profit. It's not profit. Unrealized profits, I am knocking off that profit. I should reduce it. Okay. So effectively it is going to be 2,500 negative. Okay. Now this 7 lakh 2,500 and 2,500 you are supposed to split between Che and non-controlling interest. Sama. Panjay. Okay. What is the ratio? 75-25. How 5 lakh? 26,875. 1 lakh 75, 625. Here it is 2,500. Right? Correct kada? Emma? Tappa? No, is my percentage correct? First of all, 75-25. Oh, is it okay? Okay, okay. So that's 20%. No, sorry. Okay. 1,825. 75 and 600. Okay. Now, where will this go to? First item, where will it go? It will go to step 3. Yes or no? Cost of control. Second item will go to step 2. Fourth item will go to step 2. Third item will go to Step 4. Now let's go ahead. Step 2, non-controlling interest. A, share of capital profits. It is 1,75,625. Share of revenue profits 625 negative. Effectively, it is 1,75,000 for non-controlling interest. Step 3, cost of control. Cost of control. Investment in equity shares of SAM. I won't tell you what it is. Less share of capital profits from step 1. 5,26,875. Yeah, what is it? Investment is not 5 lakhs, huh? Very good. So adjusted number is what you are supposed to take, 4,25,000. Finally, you have a capital reserve of how much? 1 lakh 1,875 it seems. Capital reserve. Amount is in brackets, so capital reserve. Next. Step 4. Reserves for CBS. How many types of reserves do you have here? It's just 2. General reserve and P&L. But you also now need to take the capital reserve. One more column for capital reserve. Okay. So particulars and 3 columns. General reserve, P&L, capital reserve. Chase own reserves. First, take 100%. General reserve, I will tell. P&L, I will not tell. 1 lakh. P&L is very good. 85,000. Is there any capital reserve? No. We will take it from step 3 separately. Okay. Next. Share of revenue profits from SAM. From your step 1D. Step 1C. 1,875 completely is from revenue profits. That is P&L only. Not general reserve. Please see. General reserve, it is nil. It is only P&L. So upstream transaction also will go to P&L only. No, profit will go to P&L only. So 1,875 negative, you can take it in P&L only. Okay, general reserve nil. P&L it is 1,875 negative. And then capital reserve from step 3. Okay, it is lakh and 1,875. No, don't put in brackets now. ఎంత 1,01,675 అన్నారు 8,875 అనేది అన్నారు. ఓకే, ఇప్పుడు కాదు నేను కాదు అనుకోవడమే. ఓకే, Please take totals. 1 lakh. Here it is 83,125. 1,01,875. I want grand total. 2 lakh 85,000. Okay. Now balance sheet, very easy. Consolidated balance sheet as on 31st March 25. Okay. Assets, please start. What all assets do you have there? Fixed assets, both put together, 7,30,000. Then investment will not come. In its place, capital reserve already came in step 4. Okay. Then current assets, it's going to be 14,70,000. Edinana? Very good. Yeah. So let's put it in inner column. 14,70,000 less URP to be removed is how much? URP is how much? 1 lakh. Apart from that, he also spoke about some intercompany owings. Intercompany owings, please see. He says, no point. Yeah. Che owed Sam 5 lakhs for purchase of stock. So that means that 5 lakh I'll have to remove. Yes or no? Okay. So 5 lakhs let's remove. Less intercompany owing 5 lakh. Anything else to be done? Anything else to be done? That's it. Please see. Yes. Now, look at the question given there. Look at the question given there. Look at trade payables of Che. It is only 4,40,000. Okay. But he's saying Che owes 5 lakhs for purchased stock. Match outlet kada? Why is that so? Why is that so? There could be a check in transit. Okay. There could be a check in transit which he did not tell you, hidden information. Okay. So if there is any check in transit, you are supposed to show it as part of your cash and cash equivalents. Right. So what we will do is, you can do it in 2 ways. You can just knock off 4,40,000 in both the places and leave it off. But if you are knocking off 5 lakhs here, you should add check in transit for 60,000. Okay. For you to have that remembrance, please write it with different ink pen. Add check in transit 60,000. Value please now. Total 1470 minus 1 lakh minus 5 lakh plus 60,000. Yeah, 9,30,000. Okay. So your total is going to be 16,60,000. Then liabilities, equity and liabilities. Equity share capital, only parent, how much? 1 lakh, 10 lakh? Then reserves and surplus, step 4, 2,85,000. Then you have trade payables. You should only take 2 lakhs because 4,40,000 you are cancelling. Yes or no? Trade payables 6,40,000 minus 4,40,000. 2,40,000. Oh, 2 lakhs only. Sorry. Okay. So is that satisfying or not yet? Why? You have non-controlling interest also. Emma? Non-controlling interest also. In fact, you should write it before trade payables. I will mention it here. Please see. How much is it? 1,75,000. Okay. So all put together it is 16,60,000. Any questions before I go forward? Yeah. Let's finish off one more question. Then we can take a break. Yeah. On 1st April 24, Hot Limited acquired 40 lakh fully paid equity shares of 10 each in Coal Limited for 7.5 crores. Okay. The balance sheets of the two companies as at 31st March 25 are given below. Equity shares of 10 each fully paid. Amounts are in lakhs. Okay. Securities premium, general reserve, P&L. Current liabilities, trade payables. Other current liabilities is unclaimed dividend. Unclaimed dividend, very, very important. This is. Till now, we have not seen this. Okay. Totals are given. Some typo errors and all, alignment issues. That 1103 came down. It's basically subsidiaries total. Okay. Assets, land and building, plant and machinery, furniture fittings. Investment in equity instruments of gold. Then you have inventories, trade receivables, cash and cash equivalents, other assets, preliminary expenses. Preliminary expenses. What do? Take it in your net worth analysis. Total. Okay. Following additional information is given. The balance of general reserve and profit and loss account on the date of acquisition of shares by Hot Limited were 2 crores and 30 lakh respectively. He directly gave you what is the profit on date of control. Your calculation from opening balance, all that is not required in this problem. He made your life easy. Okay. In July 24, Coal Limited distributed 10% dividend for the year 23-24 Hot Limited credited the entire amount of dividend received to its profit and loss account. Again, dividend adjustment is there. Okay. Next, on 31st March 25, Coal Limited owed 60 lakhs to Hot Limited for goods purchased from it. Hot Limited sold goods to Coal at cost plus 25%. What adjustment? URP. What adjustment? Who sold to whom? Parent sold to child. That means downstream. URP downstream. Goods costing 15 lakhs to Coal Limited were still lying unsold with Coal Limited on the above mentioned date of balance sheet. So on total value you need not do, just on that 15 lakhs if we calculate, that's sufficient. Okay. As expected, the entire amount of unclaimed dividend appearing in the balance sheet limited belongs to minority shareholders. Okay. That is nothing but non-controlling interest shareholders. No part of preliminary expenses had been written off during the year. Whatever is there is like that only. So that entire amount can be taken to your net worth analysis is what is indirectly told you. You are required to prepare CBS as on 31st March 25. Very, very simple problem. No too much of difficulty. Fair case. Fair case. Now, do you see any adjustments? SFS adjustments first of all. What all adjustments are there? Number one, there is wait. There is distribution of dividend for last year. This fellow says he has taken it to P&L. That means that is a SFS adjustment to be done. Number one. Next, apart from that, all are consolidation adjustments only. Yes or no? One is SFS adjustment, remaining are consolidation adjustments which we are supposed to do. Okay. So now let's begin. Okay. Problem 13. Part 1. SFS adjustments in parent. In parent. Okay. Part 1. SFS adjustments in parent. Okay. Yeah. What is the amount of dividend this fellow declared? So he says 10% is declared. Okay. Share capital is how much? 500 lakhs, yes or no? 500 lakhs into 10%, which is 50 lakhs. Now, what is my holding in the company? I hold how many shares? Please see. I hold 40 lakhs. That means 80% I hold. Okay. So it is basically dividend for FY 23-24. Pre-acquisition dividend. Okay. So 500 into 10% into 80%. How much is it? 40 lakhs. Okay. What would be the entry? That's all. P&L account debit to investment account. 40 lakhs, 40 lakhs. Okay. Now, apart from this, there are no other adjustments to be done. Yes or no? Let's write summary of revised balances. Number 1, P&L. P&L of parent given there is 610 minus 40, 570 lakhs. Number 2, investment in equity shares of gold 750 minus 40, which is 710 lakhs. Okay. Now, part 2, consolidation. Consolidation. In that, 3 bullet points. Date of consolidation, date of control, shareholding pattern. What are these 3? 31st March 25. Date of control is 1st April 24. Shareholding pattern 80-20. Okay. Let's begin with first step. Net worth analysis of gold as on 31st March 25 with respect to 1st of April 24. Okay. Take C, R, below C, 1st of April 24. Start with share capital. Share capital given there is 500. Only on C side. Only on C side. Then you have securities premium, not for gold. Not for gold. General reserve you have 280. Of the 280, this fellow says it was 2 crores and 30 lakhs respectively for general reserve and securities premium, yes or no? Okay. That means 200 is opening, 80 is transferred during the year from P&L to general reserve, yes or no? Okay. General reserve, otherwise it will not get created. Okay. So general reserve 280. Yeah, we can adjust in P&L. Okay. Next, P&L, let's do it as a working note. Working note 1. Okay. Working note 1. P&L analysis. P&L analysis. Now, he gave you closing balance of how much? 150. 150. But opening is only 30. Opening is only 30. So first take opening balance 30. This will go to C. Yes or no? This will go to C. Now, during the year, he says he has transferred to general reserve 80. Just now you saw. Just now you saw it is transferred to general reserve 80. That means this is R. Okay. And also during the year, this guy has paid dividend for last year. Okay. Last year dividend is paid. How much? 50, 50 is paid, no? 50 is paid. If it is for last year, it is C. Yes or no? If it is last year, it is C. Capital profit. Then, and current year closing balance is how much? Closing balance is 150. That means something is earned during the year, which is R. Current year earnings. How much is it? 250. 250 is R. Okay. So this is R. Am I making sense? Now you may get a doubt. Sir, if my opening P&L is 30, how did I give last year dividend of 50, sir? That means it can be assumed that you paid out of general reserve, in which case you take this dividend to general reserve and transfer to general reserve will be reduced here. Some adjustment here and there, that's all. Okay. So you need not bother much about such transactions. Okay. Now it is, you have got C of negative 20, R is positive and the 120. 120, 80, 170. Yes or no? Okay. So now please take 20 negative in C. R is 170 positive. Take total of this and this. All C's together. Take it in C. Okay. Take total of R's. This and this. Total is how much? 170. Okay. 170, take it in R side. Clear? Is that done or something else to be taken? Is that done or something else to be taken? Is that done? Something else to be taken? Question, please see. Excellent. Preliminary expenses. Not written off. Always preliminary expenses not written off will form part of capital profits only, capital items only, because these are incurred long ago. Okay. So what is the value? 20 negative within brackets. Okay. Now please take total. Total is going to be 640. 660, yeah, okay. 660. Here it is 250. 660 between H and non-controlling interest in the ratio of 80-20. The 528, 528, 132. Okay. This 250 between H and non-controlling interest. Again 80 is to 20. 250. Hang on. It's not yet done. You further need for step 4 breakup of this 200, yes or no? Okay. Now 80 into 80%. General reserve P&L 80 into 80% is 64. 170 into 80%. 136. Why do I need this? Because in step 4 I have to give individual numbers. That's why I'm doing it now itself. Can I go ahead? Now step 1 is over. Okay. Let's go ahead to step 2. Non-controlling interest. Okay. Non-controlling interest, there is a important catch here. I will not tell. There is an important catch. I will not tell. A, share of capital profits. B, share of revenue profits. C, something. What is that something? I will not tell. Yeah. Huh? Unclaimed dividend. Unclaimed dividend is the something. Okay. So 132, 50, and 3. Okay. All put together it is 185. 185. Then step 3, cost of control. Step cost of control. Investment in equity shares of C, I will not tell. Less share of capital profits from step 1. It is 528. What is investment? 7, 10. Very good. So you have a goodwill here. 118, 182. Okay. Okay. Goodwill 182. Next. Step 4. Reserves for CBS. Take particulars. And how many reserve columns? ఏంటన్నా చెప్పనని చెప్పాను ముందరే. నేను చెప్పను, ఆల్రెడీ చేసావు. నీ నోట్బుక్లోనే ఎక్కడ ఉంటుంది, ఎత్తుక్కో. స్టాండ్ అలోన్ ఫినాన్షియల్ స్టేట్మెంట్ అడ్జస్ట్మెంట్స్, ప్లీజ్ సి. SFS, summary of revised balances, you will see it there. Okay. Yeah. So if you look at your reserves, you have securities premium, you have general reserve, you have P&L. Okay. So securities premium, general reserve, P&L. Antena? Only 3 items, right? That's all. You don't have capital reserve in this problem. That's why. Start with H limited own reserves. H limited own reserves. Securities premium is 100. General reserve is 120. P&L I don't know. P&L please. 570. Yeah. 570. ఎక్కడి నుంచి వచ్చింది? మళ్ళీ అక్కడి నుంచే వచ్చింది. Stand alone adjustments, what we have done. Revised balance. Okay. Then share of revenue profits from step 1. It is 64 in general reserve, 136 in P&L. Okay. Now URP downstream. He says the stock with stock with child is 15 lakhs, and he says he sells at cost plus 25%. That means if it is 25% on cost, it is 20% on sale price. Okay. So it is 15 lakhs into 1/5, which is 3 lakhs. So it is 3 lakhs Positive or negative? Positive or negative? Negative. Negative. You are supposed to reduce that profit. That's why. Okay. So now please take totals. Now please take totals. 100, 184. Here it is 703, and GT would be grand total. And the 987 it seems. Just to save some space in the page, I am going to do in T-shape. You guys do it in vertical format only. Okay. So CBS assets. Can you please tell me what all assets do you have? Land and building is there. Leda? Undiga? Land and machinery ante undanadi rainira. Land and building is 300 and అదే 335. 335. Plant and machinery 695. Then furniture and fittings 257. Good. Then wait, you have goodwill. Come in the sequence. Goodwill from step 3, 182. 182. Then inventory. You are supposed to deduct that 3 and tell me. Net of 3. What is total of both? First of all, 506 minus 3. 503. Yes or no? What else do you have? Trade receivables also, I think there is an adjustment, no? Now, please see, wait. Cold owed 60 lakhs to hot for goods purchased from it. Now tell me, in trade payables of cold, you have 170. So it is satisfying. Now trade receivables of hot, if you see, it is 150. That means in both places I can knock off that 60. Yes or no? So trade receivables I can knock off 60. So it's going to be 150 plus 170 minus 60. It's going to be 310. Okay. So trade receivables 310. Then what else do we have? Cash is there. 100 plus 140, 240. పేజ్ మిగులుతుంది ఫ్రెష్గా స్టార్ట్ చేసుకోవడం వాల్యూ చేసినందుకు కానీ యా 2522 it seems. Balance sheet total is. Now come to liabilities side, equity and liabilities. Share capital is how much? 1000. Reserves and surplus 987. Non-controlling interest 185. Then trade payables net off, you should tell me. 300. Okay. Then that's it. Telling? No. Bills receivable, sir. 50 difference. Why? I didn't get you. Once again. No, why in the previous problem are you talking now? Wait. Let's see. So trade payables 190 plus 170 minus 60, correct? That is what we did. Huh? Trade receivables is 260, yeah? So 150 plus 170 minus 60. Enta? 260, yeah? How much did we take? 310, huh? That's wrong, no? I've asked you with the net of adjustment only. How much is it? 260. Can you please tell me the total now? 2472, huh? Two four seven two. I think here also it's satisfying now. Yeah. Any doubts? Okay, na? Consolidation. We'll take a break. Come back and start with valuation. Yes. Let's begin. The last bigger topic what we have is valuation for now. Okay. Valuation, you actually have multiple valuations. One is with respect to goodwill. Second is with respect to shares. Okay. So number one is goodwill. Number two is shares. Okay. So for me to do shares, we also have to first understand valuation of goodwill, because goodwill once done will be a continuation for shares. That's why. Okay. Now, how do we value goodwill is what we have to see. But before seeing that, for valuation of goodwill, you actually need 4 parameters to be first understood. 4 parameters to be understood. Then we can talk about how valuation of goodwill is generally done. Okay. The first parameter which you should understand is terminal capital employed. Terminal capital employed. We also call it as closing capital employed. In what circumstances do we use and all? Let's discuss later. In what circumstances, what we are going to use and all, we'll discuss later. For now, understand what are the concepts we have to use. What all we will have to use. Now, what does terminal capital employed mean? What does terminal capital employed mean? Say in a financial year, your year starts from 1st of April to 31st of March. That capital which existed on 31st March is what we call as terminal capital employed. Am I making sense? Okay. Next. What does opening capital employed mean? Opening capital employed mean that capital which is there on 1st of April is what we call as opening capital employed. Okay. And then there is another important aspect called average capital employed. Average capital employed. Now, you should tell me what average means. Opening plus closing by 2. Okay. Average capital employed means it is opening plus closing capital employed divided by 2. You get average capital employed. Okay. Now, calculation of average capital employed, there are different methods also. I will discuss about that little later. For now, understand that there is something called terminal capital employed, opening capital employed, and average capital employed. Now, apart from this, you also need to know something called future maintainable profits. Future maintainable profits. What does future maintainable profits mean? Future maintainable profits means those profits which I foresee in this business for a foreseeable period of time, for some period of time. That profit I call future maintainable profits. While calculating these future maintainable profits, there are some conditions which you need to satisfy. Say for example, if there are any odd periods in the past, if there are any odd periods which you have seen in your past, those should not be taken into consideration. Okay. At times what happens is, for example, you will try to calculate your future maintainable profits based on your past record. Your past is the basis for you to tell whether you will be able to achieve that in your future or not. Now, when this be the case, we will try to understand, say for example, if I have to calculate 5 years future, 5 years down the line future, I will first work backwards last 5 years. When I look back the last 5 years, if I get to know that one particular year, say third year in the past, is not a good year for me. It was bad because COVID came. Now, while valuing a company, you cannot take that year as a basis. Hence, what valuation standards suggest is, first try to see if you can correct that 1 year's profits. If you think you can correct it, correct it. If you cannot correct it, reject that year itself from your calculations. Reject that year itself from your calculations. That is what valuation standards suggest you to do in case of calculating future maintainable profits. Okay. So, what kind of corrections do you do? What kind of corrections means? Say for example, last year he says profit percentages, say 40%. Okay. GP percentage is 40%. And then he gave you some other information saying that you will end up at a net profit of some percentage and all. But this year you got to know, last year I'm lucky enough to get 40%. Market is bad today. It would not be appropriate to consider 40% now, is what I feel. In which case, still thinking that I will make 40% is not correct. Yes or no? Hence, I will have to make adjustments to it. That is what corrections are. You will first try to make corrections. If corrections are not at all possible, then reject. To the extent possible, corrections we will do. If corrections are not possible, we will reject that financial year itself while calculating our profits. Okay, that is with respect to future maintainable profits, how we do and all. Okay, now last important thing which you need to understand is number 5, industry rate of return. Industry rate of return. Now, what does this industry rate of return mean? Industry rate of return means the rate at which industry is actually earning profits. The rate at which industry is earning profits is what I call as industry rate of return. Now, why do I need this? This will be useful for me to calculate goodwill. If my profits are over and above that industry rate of return, it indicates that the difference, additional amount of return whatever I get is basically my super profits, yes or no? Hence, you need to know what is industry rate of return. I'll repeat once again till now what all I have discussed. Otherwise, for you it will be like Greek and Latin. I have started off saying in valuation you have two things to value. One is goodwill, second is shares. For me to go for valuation of shares, I should first do valuation of goodwill. Then only I can go for shares valuation. Under shares, under goodwill valuation, I have not yet started goodwill valuation directly. I am only discussing what key important terms you should learn. Okay, the first one is about terminal capital employed. Second is about opening capital employed. Third is about average capital employed. And then I spoke about what a future maintainable profit means. And then I spoke about industry rate of return. Okay. So these are few things which we try to understand. Why we need terminal capital employed? Because there are instances where I use terminal capital employed while calculating goodwill. What does terminal capital employed mean? In a financial year, that capital which is there on the last day of the financial year is what I call as closing capital employed or terminal capital employed. Same way, in a financial year, that capital employed which is there on the first day of the financial year is what I call as opening capital employed. And in the same way, there's something called average capital employed, which is basically average of these two, opening and closing, is what we call as average capital employed. Now, apart from that, there's something called future maintainable profits which we will have to calculate. To calculate future maintainable profits, the basis is going to be my past. The basis is going to be my past. Say for example, I have to calculate 5 years down the line from now. To calculate 5 years down the line from now, I will rely upon my last 5 years, how my trend was. How my trend was. So, while considering this last 5 years data, I have to make some corrections to the data because what conditions existed in the last 5 years might not exist today. Hence, you may have to make some corrections to that data. If you feel some of the data in a financial year is not correctable, they are so absurd, not at all matching with the current trend at all. If you feel correction is nowhere possible, then you will reject the data. That means that one financial year itself you will remove from your calculations part. Okay, this is how you do with respect to your future maintainable profits. Next, with respect to industry rate of return, why do you need an industry rate of return? Why? Because after you calculate capital employed, you get to know, you apply this industry rate of return to your capital employed, you get some profit. You get some profit which is market based profit, market expected profit. That will be used by me to compare with my actual profit. With my actual profit. If my actual profit is greater than this market defined profit, in such case, the extra amount what I earned is my super profit. That will be used for calculating goodwill. That will be used for calculating goodwill. That's why you need industry rate of return. Is that clear till here? Okay. Now, I told you have terminal capital employed, opening capital employed, average capital employed, 3 capital employeds. Inside that, there are various ways in which capital employed can be calculated. That is called as number 1, or I'll take it as A. Your capital employed can be calculated from a viewpoint. From a viewpoint. What does that mean? It means from whose standpoint are you saying that as a profit? From whose standpoint are you calling it as funds? Okay. Now, there are 3 standpoints which exist in valuation. One is called as shareholder standpoint, which is equity plus preference standpoint. Okay. Okay, or I'll put it here. First is equity shareholder standpoint. Okay. Second is shareholder standpoint, where investment is not just from equity shareholders but also preference shareholders. The third is long-term fund standpoint. When I say long-term, I also consider equity shareholders funds. I also consider preference shareholders funds. I also consider non-current borrowings from non-current borrowing standpoint. Okay. When we calculate capital employed, he would specifically tell you from which standpoint he is expecting you to solve the problem. Okay. Accordingly, your solutions keep changing. Now, say for example, when I say equity shareholders funds, what does that mean? Equity share capital plus reserves belonging to equity shareholders. Yes or no? Okay. Then, if I say shareholder standpoint, that means all put together. That is equity and preference shareholders point of view. In such case, it is equity shareholders funds, which is this, plus preference shareholders money. Am I making sense? The third standpoint is equity, preference and non-current borrowings all put together. 3 standpoints. Okay. So these are few things which you need to mandatorily understand before starting any problem. Is that clear? Now, having said this, now average capital employed, you have different ways in which you can calculate. Okay. I have stated average capital employed is basically opening plus closing divided by 2. Okay. Now, in few circumstances, he will give you only closing balance sheet. He will not give you opening balance sheet. How will I calculate average in such case? Is the question. For that, standard suggests you can start with closing. You can start with closing capital employed minus half of your adjusted current year profits is what it suggests. Half of current year adjusted profits. If you deduct, it will be equal to your average capital employed is what it suggests. Okay. Now, you need to understand why this logic is correct. Why this formula is correct. Say for example, I have an opening capital of 100 equity share capital. Okay. Reserves are 150. Reserves are 150. All put together, that's much. That much. 250 is my opening capital employed. Say for example, while coming to closing, my equity is the same 100 and my reserves are 250. That means from opening it has increased by 100. So my closing capital employed is how much? 350. If you go by this formula, opening plus closing by 2, it is going to be 250 plus 350 by 2. It's going to be how much? 300. 300 is my average capital employed. Now same thing if I do it with the second formula. What is my closing here? 350 minus half of what is current year's adjusted profit. It is basically 150 minus 250. 250 minus 150, it is 100 rupees. Okay. Here also you get the same 300. That means except for current year's profit, there is no other reason for your average capital employed to change. That's your intention here. Okay. In such case, you call it as average capital employed. You can use that formula for your average capital employed. If he gives you both balance sheets, no problem. Go with your average capital employed directly. But if he does not give you balance sheets completely, this is the approach which you are supposed to use to calculate. Is that clear? Now that we have discussed what opening capital employed and all this is, let's look through in what all ways goodwill can be valued. Okay. Now, goodwill can be valued predominantly in two ways. Okay. One is called as primary models. Second is special models. Okay. In primary models, you have again two ways in which it can be done. First is called as your capitalization method. Capitalization method. Second is super profits method. Capitalization method. Second is super profits method. Okay. Now, in special models, what kind of methods can be there? So he may give you, a mix of methods, or he will define his own way of calculation. He will suggest you something on his own. In such case, we call it as special models, where he will not give you clearly this is what the methodology which is supposed to be used. Okay. Now, in case of capitalizations and super profits, predominantly the capital employed which you use would be only your closing capital employed, predominantly closing capital employed. But in case of special models, it is going to be average capital employed. Predominantly the capital employed which we use is going to be average capital employed in special models, but primarily it is always your closing capital employed or terminal capital employed which we use. Okay. Now, what does capital employed mean? What does capitalization model mean? Capitalization means you will try to capitalize the profits earned. You will first see what is the profit earned by a company and try to apply industry rate to that, you get you get an amount of capital. You would now see, you now get to know that if so much amount of capital is invested, only then this profit generally comes. Now if you have worked with a lesser capital when compared to the market capital required, that indicates you have overperformed than your required capital, yes or no? In such case, that's a benefit which we are giving. Okay, so this is how we use capitalization methodology to understand goodwill. I'll give you an example. Please see. Say my profit in the current year is 10 lakhs. Market rate of return is 20%. Okay, market rate of return is 20%. That means to achieve 10 lakh rupees profit in the market, if it is 20%, 10 lakhs divided by 20%, how much is it? So capital required is 50 lakhs. Say I have invested, my terminal capital is only 30 lakhs. That means 20 lakhs I have saved here, no? 20 lakhs is basically my talent of not consuming so much of capital, my skill set of not using so much of capital. That means this is basically my key place where I perform better. Okay, this is how you do in case of capitalization. Now in case of super profits, this is something which you guys know right from your +1 +2 days onwards, because in your partnership and also you know this method is predominantly used. What do you do in super profits? You will calculate what are normal profits for capital employed. Say for example, I have invested, same example I am taking, I have invested 30 lakhs. Market return on 30 lakhs is 20%. How much did it generate? Hello? It is 6 lakhs which you should generate. But I generated 10 lakh profits. That means my super profit is 4 lakhs. This into number of years of purchase, say 5 years. 20 lakhs is the goodwill, is what I say. Okay, this is another way in which you calculate under super profits method. Okay, now special models, let's look into it little later. For now, understand that these two methodologies exist for us in primary models. Is that clear? Okay, now why is that we use terminal capital employed in case of primary models is because we are trying to do it on a specific day. We are trying to do it on a specific day. When it comes to special models, we will use ACE because he would specifically say the profit is supposed to be earned evenly throughout the year. Some conditions he'll put there. Some conditions he'll put there which will force us to consider that average capital employed. Okay. Hence, if at all it is a primary model which is asked for, we will use only terminal capital employed, or for super profits also terminal capital employed. But if he specifically asks you to use average capital employed anywhere, you should use that only. You should use that only and do the problem. Is that clear? Okay. So now maybe we can pick up the goodwill problems first, finish them, and then go to equity share capital problems then. So what all I have done, I have told you now. It is given in the material. The material which I have shared you, theory material, it is already there. Okay. Okay. Yeah. So look at this question given here. This basically talks on how goodwill is to be calculated. Okay. Following is the extract from the balance sheet of Popular Limited. Two dates are given, 24 and 25 balance sheet dates. Okay. So current year is on the right column. Okay. Please be cautious about it. Share capital, general reserve, P&L, 18% term loan, creditors, provision for tax, proposed dividend is not there. Now, can you please see and tell me whether balance sheet is tallied there or not? It's tallied. Okay. And then fixed assets, 10% investment, stock, debtors, cash at bank, fictitious assets. Okay. Now, additional info, replacement values of fixed assets were 1100 on 31st March 24 and 1250 lakhs on 31st March 25. Rate of depreciation adopted on fixed assets was 5% per annum. 50% of the stock is to be valued at 120% of its book value. 50% of investments were trade investments. Debtors on 31st March 25 included foreign debtors of 35,000 recorded in the books at 35 per USD. The closing exchange rate was $1.39. Creditors on 31st March 25 include foreign creditors of 60,000 recorded in the books at $1.33. Closing exchange rate was 39. Profits for the year 24-25 included 60 lakhs of government subsidy, which was not likely to recur. 125 lakhs of research and development expenditure was written off to the P&L account in the current year. This expenditure was not likely to recur. Future maintainable profits are likely to be higher by 10%. Tax rate during 24-25 was 50%. Effective future tax rate will be 40%. Normal rate of return expected is 15%. One of the directors of the company, Arvind, fears that the company does not enjoy goodwill in the prevalent market conditions. Critically examine this and establish whether Popular has or has not any goodwill. Now, you should tell me what is he asking us in the question, first of all. In what methodology does he want you to calculate goodwill? Future maintainable profit. Okay, fine. Now tell me, did he give you all information regarding the assets or not? Assets and liabilities. Everything he has given. Now using that info, how will I calculate the how will I calculate goodwill? Is he asking you to do it using this ACM? Is he asking you to do it under ACM, or what methodology he wants you to do? Yeah. Terminal capital employed. Why so? Emma? So basically, here he says normal rate of return is expected to be 15%. Okay. Normal rate of return expected is 15%. So if at all I have to do capitalization method, how much will I take? What will I be taking? Yeah, I will be taking only super profits. Why super profits? No, you will see what is the profit earned during the year. No, you can go by what is the profit earned during the period. That can be compared with your industry returns. Industry returns that will give you whether you have, you know, saved some capital employed or not. That is one way in which you can look at. Agreed or not? Okay. So now first we have to calculate what is the fair value of your assets and liabilities. He gave you some details with respect to replacement values and all. So you should first calculate what is the values as on 31st March 24 and 31st March 25 using the below information, the additional info. Okay, that will give you a clarity on how much it is. Then net asset value per shareholder and all you can calculate from that, or you can find out what is the net worth of the company. Using that net worth, you will apply the normal rate of return of 15% to understand what what amount of return you are making, and then calculate what is the goodwill out of it. Okay, so let's begin. Yeah, so let's take calculation of net worth of the company on two different dates. Let's do it for both years, capital employed. Okay, so particulars 2024 2025. Okay, now so let us start with assets given there. Fixed assets, let us take fixed asset. He says it is 1100 and 1250. Yes or no? Please take fixed assets 1100 1250. Then you have 10% investments. He told you about 10% investment, saying 50% of investments are trade investments. Okay, now I am going to take only trade investments. Why am I not going to take non-trade investments? I will not take non-trade investments because I am calculating goodwill. See, if I have invested in non-trade investment, that indicates that I have some extra money. I have accumulated some profits. That profits I would like to invest somewhere so that I get some extra income. My operating activities are something different. Apart from my operating activities, I would like to generate some extra income so that I will enjoy if required. But when you are trying to calculate value of goodwill for your business, you only are supposed to consider trade investments but not non-trade investments. Is that clear? Okay. So now here 50% if investments were trade investments is what he is saying. So now you are supposed to take investments only trade investments should be considered, which is 125 and 125. So no change in value. He did not tell you anything also. $125. Then what do you have? Stock is there, no? Stock is there. For stock, did he tell you anything? He told you something. Please see. 50% of the stock is to be valued at 120% of its book value. Now hang on. He has told you replacement value of fixed assets. Ante if at all I have to replace my fixed assets on that day, this is the value I would have got. Ignore depreciation after that. Emma? Yeah, see, he has specifically told you 1100 is as on this date, 1120 as on this date. Since he has specifically told you the dates as on which this is the value you will realize. See, realizable value ante మీ depreciation తీసుకున్న తర్వాత కూడా. Okay, that is why you are taking realizable values. Next. Okay, yeah, stock we are supposed to see. It is given as 260 and 300. Now he wants you to make some adjustment to it. 50% of the stock is to be valued at 120% of book value. So can you please take that and tell me? Stock 50% at 120%, remaining 50% at 100%. Endanana? 260 and 300 is what I have. That means 130 into 120%. 156, 156 plus 130. Okay, so it's basically 130 into 120%, 130 into 100%, which is 156 and 130. And for 25, enana? Okay, 150 into 120%. Ante enta? 180 and 150. Okay. Next, you have debtors 170 and 110. Debtors, do you have any adjustments? Now hang on. For 170 there is no adjustment, but for closing debtors you have a foreign receivable. Some adjustment has to be done for that. What adjustment should be done? Now please see, read that once again. He says debtors on 31st March 25 include foreign debtors of 35,000 recorded in the books at 35 per USD. Okay, so 35,000 into 35. Can you please tell me value? 2,25,000. 12,25,000. Now closing exchange rate is 39. So 13,65,000 is what you are saying. Now tell me, how much should I increase because of this? 1,40,000 is supposed to be increased because I need to take what is the fair value of my receivable. Okay, so actually total debtors you have is 110. That means 110 lakhs. Out of 110 lakhs, you need to deduct 12 point something which you told and add this value. Total value would be how much? Debtors opening is 170, easy. Closing is 110. Sorry, 110 minus 12.4. కాదు నాన్న, ఇనీషియల్గా ఉన్నది 35 రేట్లో ఎంత? 12.25 ఓకే, ప్లస్ ఓకే 111 111.4. Are you guys okay with this? Then cash at bank, will there be any change? No change. You can take it as it is, yes or no? Okay, so 46 and 45. Next, fictitious asset, please don't consider. That means it does not have any value in reality. Okay, now you are supposed to deduct your liabilities. Okay, now please see what all liabilities do you have. What all liabilities do you have? Let's come from the bottom. Provision for tax first. Provision for tax. Did he tell you anything about provision for tax here? What did he tell you? Tax rate during 24-25 was 50%. That is for your FMP. That is for your FMP calculation, not for your capital employed calculation. Okay. So your provision for tax is 11 and 13. Please take it as it is. Okay. Then creditors, it is 35 and 45 given. Should I do something to it or not? What should I do? Very good. Closing, again, you need to observe that exchange rate difference. Okay. So creditors, what has happened is he says there is a creditor including foreign creditors of 60,000 recorded in the books for 33. Closing exchange rate is 39. That means my exposure increased. My payable increased. Yes or no? So now I should do that part for this. Okay. Creditor, let's do. Creditors opening is how much? 35. 35 is opening, no? 35, and closing given there is 45. Okay. Closing is 45 minus existing is 19.8 and plus 23.4. How did you get these numbers? This is basically 60,000 into 33 and this is 60,000 into 39. Okay, so it is 48.6. Okay, then term loan is there. Okay, so it is 180 and 165 given. No further items given in this regard. Yes or no? So you can take that as it is. Okay. Now can you please tell me capital employed? $1501. $1634.8. Okay. Now you know what is opening capital employed, what is closing capital employed, right? From owner's perspective, that is equity shareholders perspective, because in this problem you don't have preference share capital at all. Okay, you don't have preference share capital at all. It is basically directly from owner's perspective. If you would like to know capital employed from what do you call long term funds perspective, what should you be doing? You should add the term loan. You should add the term loan, then you will get from long term funds perspective. Okay, in this problem he did not ask you that. Now capital employed you got opening and closing. Now can you also calculate and tell me, since we are doing for the first time, also do average capital employed? Yeah, average capital employed is going to be that plus this divided by 2 enta 1567.9. Okay, now how will I calculate profits? Where do I have data to calculate profits? Emma, did he give you P&L account? So basically he gave you reserves, opening balances and closing balances. By understanding these two, you get to know what is current year's profits. Okay, so let's analyze the reserves to understand what is future maintainable profits. Okay, so now let's start calculation of FMP, future maintainable profits. Okay, first start with opening reserves position. Opening reserves position. Please see what is opening reserves. 400 plus 160. Yes or no? $560. Closing reserves position. Closing reserves position is 425 plus 215. Okay. That means current year increase in profits, increase in reserves is how much? Current year increase in reserves is 80. Can I call this as my profit? I cannot. Why? Because there are some adjustments which I will have to make. Now, if this is increase in reserves, it indicates that this is profit after tax. Okay. Now, so now that you know, profit after tax is 80. What is he saying? Tax rate already calculated is how much? 50%. Okay. So I am trying to calculate future maintainable profit. If I have to calculate future maintainable profit, I need to make adjustments to my existing profit to understand in future how much I will make. Okay. Right now I got 80, which is real profit in the current year at 50% tax rate. I should reverse that back and also make adjustments to my profit. What kind of adjustments should I make? In fact, if you see debtors, there is increase in debtors. That means there is a profit which I got there. Same way, creditors, I have to pay extra. There is some loss which I incurred. These are supposed to be considered here. Same way, he says research and development cost 125 written off to P&L. This expenditure is not likely to recur. That means in future I will save these monies. That also I should add to my profits. Like this, all adjustments we have to see and arrive at what in future I will make as profit. In future I will be making as profit. Okay. So let's begin with that. Now PAT given is 80, which is at 50% tax rate. Okay. So tax expense would be another 80. Profit before tax is going to be 160. Okay. To this, we should add all the items which we considered. Okay. We have to do, we will do. Okay. Now, in this profit, tell me, will I have income from non-trade investments also or not? Yes. While calculating goodwill, I want pure business profits. Any non-business profits I will avoid. Okay. I will eliminate those non-business profits. So your interest income on non-trade securities should be deducted. Yes or no? So less income from non-trade investments. How much is it? It is basically investments will give me how much return? 10%. That means 125 into 10%. 12.5 I should deduct. Okay. Then let's come from each of those items given there. Okay. Depreciation he is talking about 5% per annum. Okay. Depreciation is 5% per annum. You should tell me what I should do now. Huh? Existing depreciation is to be added back. Now tell me what is the depreciation to be added here. Emma, how do you get it? How much is it? 35, 37.5. Oh, okay. Any other number? Huh? Depreciation after tax. So basically 550 is what you have in the opening, and closing is 650. Closing is 650. So it increased by 100. It increased by 100. Now, do you know, did he tell you how much is the current year purchase of machinery or something like that? No information is given. Yes or no? Okay. And there is no other place where he has told about depreciation, how much is considered also, right? Only 5%. That's what he has told you. All right. So if I take it on 550, it would not be appropriate because there is purchase of asset also. Okay. Uh, yeah, that's right. Opening balance of uh, assets, if I take, it would not be appropriate. Okay, let's come to that. Let's come to that. But first, let's finish off others. Otherwise, let's come to that. We'll finish off others. Okay. Now, uh, apart from that, what other adjustments do we need to do? 50% of the stock to be valued at 120% of its book value. Something he has told. Is there any impact about that in my P&L? Is there any impact about that in my P&L? Fairly speaking, yes. Opening balances I will have to adjust. Closing balances also I will have to adjust. Yes or no? Okay. So let's do stock adjustment. Now there is opening stock, book value, opening stock book value. How much is it? 260. What should I do to that? I should add it here and deduct the fair value. Yes or no? Book value I will add and deduct the fair value. Again, closing stock, fair value I will add and deduct the book values. Okay, so let's do that. So please see, stock 260 is the book value opening. Okay, closing stock, sorry, opening stock fair value. Opening stock fair value is to be deducted. How much is it? 286. Okay, this is to be deducted. Then closing stock book value, what should I do? Deduct. Here, see, if you are adding book value of opening stock, closing value book value will be deducted. Okay, closing stock fair value should be added. How much is it? 330 add. Okay, now what else do we have to do? Yeah, debtors and creditors, there is some extra expense to be incurred and all, yes or no? So what is the amount of increase in debtors? 1.14. That means, yes or no? 1 lakh, 1 point 1 lakh 44,000. 1.44. 1.4. Okay. Yeah. Increase in debtors. It is 1.4. Positive or negative here? It is going to be positive. Why? Because it's an expense for me. Okay. Then increase in creditors. How much is it? 3.6. What should I do? Decrease. Why? Because it's an expense for me. 3.6 is an expense for me. Next, government subsidy, he says in future it will not come. How much is it? 60 lakhs. Where is that given? Para 7. Okay, 60 lakhs will not recur is what he is saying. So government subsidy 60 deduct. Okay, apart from this, R&D which we will not incur again, it is 125 in brackets, without brackets, without brackets. Okay, now apart from this, you are doing it from equity shareholders funds perspective. That means you will have interest on term loan also, no? Okay, term loan is how much right now? 165. Okay, now look at the trend in the term loan. Look at the trend in the term loan. What have you done there? From 180 it has become 165. That means every year 15 lakhs is getting reduced. Okay, so you should again further reduce it by 15 by next year, no? Okay, so that means what would be the interest which you will be charging? It will reduce, yes or no? On what should I take now? Interest. Hmm. 160, 165 minus 15, it is 150. Okay, so 150 into this 18%, how much is it? Difference is what we are supposed to take. Yeah, sorry, difference is only 15 lakhs. No, difference is 15 lakhs. On 15 lakhs you are supposed to take the interest. How much is it? 2.7. That is what I am going to save. Yes or no? You are supposed to take savings on interest which you will not pay in future. Okay, savings in interest on term loan repaid. One, yeah, maybe you can take it as 15 lakhs into 18% directly. 2.7 positive. Okay, so 2.7 positive. I think it would not be 2.7 positive. It would be half of it. Half of it is what we are supposed to consider. I'll tell you why. No, no, no. It's not about tax here. So basically, at the beginning of the year, what is the interest on the number which is given there? If you see, it is 180 into 18%. Yes or no? 180 into 18%. How much is it? 32.4. And 165 into 18%. Hang on. 29.7. Now, on an average, if you see what is the interest on an average, that means 180 plus 165 by 2. Entanana? 31 point. So 180 plus 165 by 2 into 18% gives you how much? 31.05. Okay. Now what I am trying to convey here is I need to take, I cannot take for the full year completely, because I am going to do it 15 lakhs is something which is spread across 1 year period. So taking full year's interest saving is not appropriate, because you do not know at what point of time that 15 lakhs is paid. Is it at the beginning of the year, middle of the year, end of the year? Yes or no? Hence, it is supposed to be averaged. It is supposed to be taken by 2. Average is what you are supposed to take, and that saving is what you are supposed to show. Okay, so for that reason you take average. Now tell me what is the difference between these two. 31.05 and 29.7. 1.35 would be more appropriate. Why? Because it is average savings is what I am supposed to take, not the full 1 year's saving. Okay, average saving is 1.35. Okay, now apart from this, what else do we have? Only depreciation adjustment is there. In fact, a similar logic I personally would feel appropriate even for fixed assets. You are supposed to take what is the average depreciation per annum, which means 650 plus 550 divided by 2, you get how much? 600 into 5% would be 30. Yeah? Okay. Which one? Yeah, these values are after depreciation. So on the written down value only we are supposed to charge depreciation again, right? If it is after depreciation, that indicates it is written down value. Emma? 1250 minus 650. Okay. Okay, right. Yeah, fine. Now, so already you have charged depreciation on 650. On 650, it is already charged depreciation. Now you are saying the fair value of the asset is 1250. That means on the difference between 650 and 1250 alone, if you calculate depreciation, that is sufficient, right? Because for 650 you have already charged depreciation. The differential amount is where you are supposed to charge depreciation now, in which case it's going to be like depreciation is going to be 1250 minus 650 into 5%. Only for the increase in value, if I charge depreciation now, that's sufficient. Okay, how much is it? 32.5. 600 into 5% is 30. No, 30. Okay, is there anything else left? Yeah, we will come to that. Okay, so apart from this, there is nothing else to be done, I believe. Now can you please tell me what is the uh, adjusted profit? Adjusted profit before tax. It is called as adjusted profit before tax. $185 point. Everybody? Okay. Adjusted profit before tax is 185.65, it seems. Now he says it would be greater by 10%. Hello? Yeah. FMP before tax are likely to be higher by 10% is what he says. Add 10%. Add 10%, which is 18.56 or 18.6. Okay. So you have got FMP before tax 4.21. Okay. Okay. Now he says on FMP future tax rate is what? 50% or 40%? Okay. Future tax rate at 40%. How much is it? 81.68. Now you get FMP after tax 122.53. Okay. 122.53. Now you know your average capital employed, you know closing capital employed, you know your FMP after tax, you know what is industry return. Okay, now let us do it using capitalization method first. Okay, so capitalization method. Now what would I take for capitalization method? I will take FMP after tax divided by industry return minus my closing capital employed. Okay, so FMP after tax divided by industry return minus closing capital employed. So it is 122.53 divided by industry return is how much? He says it is 15%. How much is it going to come to? 816.87 minus closing capital employed is how much? Closing capital employed we just calculated 1634. Oh, no goodwill at all. 1634. So that means no goodwill. Okay, no goodwill at all. Now let's do it under super profits. Super profits, assuming he's asking you to do it under using ACM. Sorry, using ACE, average capital employed. So average capital employed is what? 1567.9. Okay. So using super profits method, ACE is 1567.9. Okay. And what is your percentage of return? Yeah. Industry average return is 12% on long-term funds, 15% on equity funds. Now, right now we are doing it in equity funds only. 15% is what I should take. Okay. So return is 15% which I should take. So can you tell me what is normal return? Is 235.19, and my FMP after tax is 122.53. Okay, since FMP after tax is 122.53, there is no goodwill. Okay, now if you are doing it using long-term funds approach, if you are doing it using long-term funds approach, నేను చేసేది ఏం లేదు, క్వశ్చన్లో ఇచ్చాడు చేస్తున్నాం. మీరు ఉస్సో గుస్సో అన్నా కానీ ఏం చేయలేను దానికి. Okay, now if it is from long-term funds approach, first of all, will your capitals change or not? First of all, opening capital, can you please tell me from long-term funds approach? Enta? It is actually, please see, it is actually 1501 here. So 1501 plus 180. Yeah, 1501 plus 180. 1501 plus 180 gives you 1681. Opening is 1501 plus 180. 1681. Same way closing, can you please tell me closing capital under long term funds approach? Given there is 1634 plus 180, 165, it is 1799. Okay. So average is going to be what? 1681 plus 1799 divided by 2. 1 1747 40. Okay. Okay. So now this alone will not be sufficient. You should also change your FMP also. Okay. So from long term's perspective, FMP will be, you should not consider the interest cost. Yes or no? So whatever profit before tax you have got, to that add back your interest. Hang on. If you just take 1.35, it would not be appropriate. You are supposed to take on the closure value, no? Hereafter you will not consider it. Okay. So you are supposed to take 185.65. See, you are only taking savings on interest here. In the previous question, previous part, you have done it for savings. Okay. Now you should actually do total amount of interest which you will not be incurring in future. It is actually 29.7. Okay. So 29.7 would be what you will have to add back. So profit before tax given there is how much? 185.65. Okay. To that add interest on closing capital employed, closing this borrowing. It is 29.7. 29.7. Okay. It is now going to be how much? 215.35. Okay. This is revised PBT. To this you should add 10% increase. Yes or no? Higher FMP. 21.53. Okay. FMP before tax is how much? 236.89. From this 40% tax. 94.75. You get finally FMP after tax 142.14. Okay. Now tell me, what is industry return in this case? Industry return is given as 12%. Now can we calculate? Yeah. So again you can do all the methodologies like how we did. Okay. And tell me whether there is any goodwill or not. So if you adopt capitalization method, if you do It is going to be closing capital employed, which you should compare with. Yes or no? Okay, closing capital employed under long term funds is 1799. Okay, and return is 142.14 divided by 12%. How much is it? 1.5. So again, no goodwill. No goodwill. Then super profits method. In super profits, so average is 1740. 1740 into 12%. ఎంత? 208.8. And FMP is 142.14. Again, no goodwill. ఒక ప్రాబ్లంలో చాలా చేసాం. ఇంత డెప్త్లో మీకు క్వశ్చన్ రావు అంటే I wanted to cover maximum possible in one question. That's why. ఏంటన్నా? Yeah. Morning. So we'll finish off the remaining questions what we have. సౌండ్ వస్తలేదా? Summarize balance sheet of Indus Limited as on 31st March 25 is as follows. Equity share capital 12% preference shares of 10 each fully paid. Equity share capital of 10 each 7 partly paid. Reserves and surplus, secure loan, creditors, provision for expenses. Assets, goodwill, land and building, plant and machinery, vehicles, investments, inventory, debtors, cash and bank, prepaid expenses. Total. Net profit of the company for the past 4 years before interest and tax were as under. So 4-year details are given. The company had purchased furniture of 1,20,000 in the year 23-24, which was wrongly charged to revenue account. Furniture and fixtures are depreciated 15% of the WDV. In the year 24-25, an asset having a book value of 80,000 was sold for 65,000. The year 22-23, the company paid 25,000 against the failure to comply with the rules as per the Environment Pollution Control Board. 60% of the investments are non-trade investments and market value of trade investments is 15% below the book value. Investments realize an interest of 8% per annum, whether trade or not. The non-trade investments were purchased on 1/4/24. Goodwill in the books has been purchased in the year 21-22. 60% of the secured loan was availed from US, which was recorded at a rate of $1 at 0.5, or it is 50 actually. It's 50, whereas the closing rate was $1.55. The company wishes to revalue assets on the realizable value as under land and building 550, plant and machinery 5 lakhs, vehicles 2.5 lakh, debtors 80. Ignore the change in depreciation due to the change in value of assets. Rate of tax on companies is 30% and the rate of return on capital employed is 15% per annum. Calculate goodwill based on 4 years super profit. Make appropriate assumptions wherever required. Now, this problem is about doing it under super profits. So, either ways, we are first supposed to calculate what is current closing capital employed. Okay. So, he gave you few details about land and building and all. Okay. So, closing capital employed, first and foremost important thing, goodwill you should ignore. Why? Because book goodwill is not the real goodwill. Goodwill is not the real goodwill. You are supposed to calculate the goodwill for yourself. Okay. Second, with respect to land and building, all the assets which are given there, he gave you some details about it. Those details we are supposed to consider. And then investments, he told you something. 60% is non-trade, 40% is trade, and out of that 40% also, the value reduced by 15% is what he says. Okay. So considering all that data, we are supposed to prepare first what is the uh, closing capital employed. After that, we will do the other aspects. Okay. So let's begin with closing capital employed calculation first. Closing capital employed is your first step. Okay. So for that, take particulars and amount. Start with land and building. 5,50,000 is the fair value. Yes or no? Okay. Then plant and machinery 5 lakhs, vehicles 2.5 lakh, debtors 80,000 is what he says. Debtors is 80,000. So initially, whatever information he has given in the bottom, we have considered. Okay. As I told you, goodwill we will not take. Investments we are supposed to take only trade investments, that to market value today. Okay. So, Emma, oh, furniture and fixture is there. Acha, okay. So it's second point. Yeah. Company purchased furniture of 1,20,000 in 22, 23, 24, which was wrongly charged to revenue account. Furniture and fixtures are depreciated at 15% of the WDV. Now, first of all, when did I buy this? 23, 24. Right now, the balance sheet is as on 24, 25. That means 2 years passed. So, end of 2 years, whatever is the book value, that is what I am supposed to take. Okay. So, I purchased for 1.2 lakh. WDV 15% for 2 years is what you are supposed to take. Furniture 1.2 lakh into 85% into 85%. Correct? 80? 86,700. Okay. Then investments, let's do. Investments, let's do. Out of 5 lakh, 60%, 40% is how much? 2 lakhs. Out of that, only 85% is the value, 15% is lost. Okay. So investments, you can take 5 lakhs into 40% into 85%, which comes to how much? 1,70,000. Okay. Then inventory 4,25,000. No details given, so you can consider the same 4,25,000. Yes or no? Debtors we have already considered fair value. Cash and bank balance, you can take the same 35,000. Prepaid expense also 45,000 can be considered. Okay. Inventory 4,25,000. Cash 35,000 prepaid expenses 45,000. Thank you. Enana? First of all, prepaid expense does not mean fictitious. Fictitious means you have already spent but you would not have any value out of it. This is not that case. In future you are going to get some benefit out of it. Okay. So out of this you are supposed to now deduct your liabilities, yes or no? He says provision for expenses 1.5 lakh and he did not give you any information about it other than that number. So it indicates that you can take that value. Okay. So 1,50,000. Then creditors is 2.5 lakhs is what he has given you. Okay. 2.5 lakhs is what he has given you. Secured loan is 7.5 lakhs. Okay. This secured loan, he gave you something about it, yes or no? What did he tell you? He took that, he told that it is from the US. It's from the US. And you are supposed to take the closing rate value. You are supposed to take the closing rate value as per AS11. That's why. Okay. So that we'll do. First, let's take these two numbers: provision for expenses and sundry creditors 1.5, 2.5. Okay. Loan. So loan, first of all, uh, what is your calculation in this? So he has given you 7,50,000. Out of that, 60% is what you are supposed to take. First 40% you can take it as it is. Yes or no? So loan domestic 7.5 lakh into 40%. How much is it? 3 lakhs. Okay. Foreign, it is 7.5 lakh into 60% into 55 divided by 50. Yes or no? Hello? Into 55 divided by 50. Value please. 4 lakh 95,000. Is there anything else apart from this? That's it. These are my liabilities. Now tell me, what is the value you get? 12 lakh net of 12 lakh 46 700 cents. Got it, everybody? Done? Huh? Not too wrong. Any issue with the totals? Please check once. Nine lakh 46,000. Everybody? Okay, fine. 9,46,700 it seems. Please correct. So, అందరికి అదే వచ్చిందా? Okay. All right. Fine. If 9,46,700 is your closing capital employed, for super profits method, what do I need as a capital employed? Is it closing capital employed or average capital employed? It is generally closing, but here he has told you, he has given you information regarding your current year profits and all also, yes or no? Okay. So if you look at the yesterday's discussion also, I told you saying in specific cases we use average capital employed as well. Average capital employed as well. So in super profits method, you can also do it using average. You can do it using average also. Now, why is that we use average in super profits? If you observe, I'm trying to say that over a year, this is the capital employed which is consumed over a year. I'm not saying that at the end of the year this is the capital employed. Over a year, these are the profits, and I'm gonna multiply this with number of years of purchase. When I'm multiplying it with number of years of purchase, I would like to take average capital employed because this gives more uh, realistic picture of what is the return. I don't want to take on a specific days capital employed. It will give you only one specific point of times return, but year on full year's return, if I would like to see, it's better to take the full year's average capital employed. Okay. So in such case, we can go ahead with average capital employed also. Okay. So let's also do average capital employed. Now tell me, in this problem, do you have opening balance sheet? Do you have opening balance sheet in this problem? You don't have. So what are you supposed to do? Closing capital employed minus half of current year's profits. Okay. So now, do you know current year's profits? Do you know current year's profits? He gave you some information about it. He gave you some information about it. He told you saying net profit for the last 4 years before interest and tax were as under. Okay. So this year it is 5.5 lakh. The previous 3 years he has given you some information. Now using that 5.5 lakh, can I work towards the actual profit in the current year or not? Yes. Okay. So let's start working towards the actual profit earned in the current year. Now he has given you 5.5 lakh. Does that mean profit after tax or profit before tax? Because he clearly told you it is before interest and taxes. He clearly told you this before interest and taxes. Had he not told you about that, you would assume that it is profit after tax and work backwards from tax perspective as well. Okay. So in this problem, he told you it is profit before tax directly. So you need not worry about what exactly it is. Okay. So let's now begin with calculation of average capital employed, for which you need to know what is current year profits. Yeah. So start with profit before interest and tax given 5 lakhs. Okay. 5 lakh 50. Yeah. Okay. Sorry. 5 lakh 50,000. Then you are supposed to do what? What all adjustments do you think you will have to do? He has told you, furniture happened to be something else now. What did he tell you? Furniture 1.2 lakh in the year 23-24. That means not in this financial year, in the previous financial year. Now, in this financial year, should I charge depreciation for that furniture or not? Yes, sir. Okay. So in this financial year, I will have to charge depreciation 1.2 lakh into 85% into 15%. Into 15%, you will get this year's depreciation. Okay. furniture depreciation 1.2 lakh into 85% into 15%. How much is it? 15,300 deduct. Okay. Next, what else should I do? There is a loan liability increase, yes or no? That is your foreign currency loss, forex loss. Please take that forex loss. Forex loss is basically 45,000 rupees. Actually 7.5 lakh. Now the loan is 7.95 lakh. That means 45,000 is basically your forex loss, yes or no? Okay. So 55 minus 50 is basically the amount into 4.5 lakh. Okay. So on 4.5 lakh, it gives you 45,000 of loss. Okay. Same way, debtors book value is actually how much? Book value is 1 lakh. But debtors, what we considered is 80,000. That means here also there is fall in value of 20,000, loss in debtors. So provision for debtors is 20,000. Okay. Apart from this, is there anything else we need to consider here? Inana? So that means it would have already been gone into the P&L, no? Yes or no? $80,000 sold for 65,000 is what he is saying. That means, I mean, like in this profit before tax, already that point would have gone, right? See, I am taking only items which were not part of P&L till now. If it has already gone into P&L, I need not do that adjustment right now, right? See, you are talking from the perspective of FMPs. You are talking from the perspective of FMP. I am talking about current year real profit. For now, we did not start about FMP at all. I am only calculating what is my profit in the current year. That's all. Okay. Don't get confused between FMP calculation and calculation of current year profit for the sake of average capital employed. Okay. There is difference. Okay. So I will not consider that at this juncture. But when we calculate FMP, we will consider that. Okay. So I think with this, no other point to be adjusted. Now tell me, what is your corrected profit before interest and tax? 4 lakh 69,700. Okay. Now he told you it is profit before interest and tax. That means you need to deduct interest also now. Interest is to be deducted. Then you should also deduct tax. Okay. So what is interest? Yeah. How much is it? 12% is the loan. 12% is the secured loan rate of interest. So now he did not tell you opening loan value to take what is the change happening in a year. Yes or no? You cannot do like how we did last problem. If he has given you opening loan details also, you would get to know that what is the amount of loan repaid, so that you can take average out of it. You can take average out of it, but you cannot do it here. Now what would you do? What would you apply here? With respect to domestic loan, you can directly take it on what is the domestic loan component value? 30 lakhs, no? 3 lakhs. 3 lakhs is the domestic loan component. On 3 lakhs, you can take 12%. Okay. Remaining, what would you do? Remaining, what you are supposed to do is, he told you Remaining is actually uh, so 4.5 lakh divided by 50 into 55. How much is it? It is going to be 4 lakh 95,000. No, on that you should take 12% on closing. Okay, so interest, domestic loan interest, domestic loan interest is going to be 3 lakh into 12%. How much is it? 36,000. Okay, and foreign loan interest, it is going to be 4.5 lakh divided by 50 into 55 into 12%. ఎంత? 59,400. Okay, deduct these two. I'm taking it on closing balance value, that's why. So now you get profit before tax. Value is how much? 3,74,300. From this, deduct tax at what rate? He has given you 30%. Please tell me tax value. 1,12,290. You get profit after tax of 1,12,000. Okay. Now can you calculate ACE, average capital employed? So average capital employed is going to be closing capital employed minus half of current year profits, which is basically 9,46,700 minus half of 262,010. And the 815,695. 815,695. Can I go ahead? All right. Now that I have got average capital employed, we are supposed to calculate something called as future maintainable profits. Okay. Now for future maintainable profits, I told you in the beginning saying that if he gives you past data, you are supposed to correct it if possible. If correction is not possible, you reject that data. Okay. Now, given the information, do you think any data is supposed to be rejected is something you need to observe. So first year he told you 4,90,000, that is 11, 12. Well, or 21, 22, it is 4,90,000. 22, 23, 5,25,000. Third year 3,85,000. Fourth year 5.5 lakh. Okay. Using this data, we will first do the adjustments what all are supposed to be done. Why? Because there is a furniture purchased in the previous year which is wrong. I need to correct that. Maybe that's the reason why the profit in 23-24 is so low when compared to previous year and current year. Okay. So all such adjustments, whatever we have seen, now you have told me saying that one asset has been sold for 65,000, 15,000 of loss is there, which might not recur in future. So all these adjustments let's do, and then find out what is the future maintainable profit for over all these years. Then we will arrive at a base profit. Using that, we will go for calculation of goodwill. Okay. So let's begin. Number 3, calculation of future maintainable profits using past data. Okay, take particulars 21, 22, 22, 23, 23, 24, and 24, 25. Okay, so let's start with profit before interest and tax, which is given there. Values given are 4,90,000, 5,25,000. Then you are given 3,85,000 and 5,50,000. Okay. Now, first let's do that furniture adjustment. Add furniture wrongly charged to P&L. 1,20,000 in 23-24 year. Okay. Along with that, less depreciation on furniture at 15%. So 15% on 1.2 lakh, how much is it? First year? 18,000. Deduct. Next year, you have already calculated depreciation 15,300. Okay. Next. So let's take this third point now, which is he says there is a loss of 15,000. This is not going to recur. Okay. Non-recurring loss. Add non-recurring loss. $15,000. Then what other items do you have? What other items do you have to adjust? Yeah. So he's talking about 25,000 of penalty paid. Yes or no? Even that is a non-recurring item. Okay. So you can take that in 22-23 financial year. Okay. In the same item, you can take 22-23 financial year. It is going to be positive. That loss will not recur. Okay. Next, while we are calculating FMP, we should also consider the loss in your debtors and loss in your forex loans. Yes or no? Okay. So less loss in debtors, less loss in forex loan. Both happened in current year, that is 24-25. So 20,000 and 45,000. Okay. I think beyond this, there is nothing else to do. Emma? Oh yeah, investments. Yeah, yeah, correct. We are supposed to. So he says 60% of the investments are non-trade investments. Yes or no? So that means in your profit, already interest income on non-trade investment also would be there, which I will have to now reverse. Yes or no? On non-trade investment. So what would be the value I'll have to reverse? Yeah. So 24,000. Hang on. Please see. The non-trade investments were purchased on 1/4/24. 1/4/24. That means when was that? Only last year. So prior to that, it did not exist. So that means taking this interest calculation uh, in the prior 2 years would not be appropriate. Okay. So that is number one. So this year and the previous year is what we are supposed to take. Okay, only 1 year. Yes or no? Only 1 year we are supposed to take. So let's do that. Less or add? Less, because in the profit it is already there. Okay. Less interest on non-trade investment. Non-trade investment interest is how much? 24,000. So it is basically 7.5 lakhs into 60% into 8%. 24,000 brackets. Okay. Next. So now you are trying to arrive at profit before interest and tax. Yes or no? So at this juncture, if you draw a line, you get to know what is profit before interest and tax. Okay. From that, you will have to deduct interest also, then tax. Okay. So let's deduct interest also here itself. In a single shot, we can finish it off. Okay. So less interest at what percentage did he tell you? 12%. Now, while you take interest on loan, what value will you consider for the loan? So 7.5 lakhs is what he has stated as secured loan. Yes or no? On 7.5 lakh, what is 12%? Huh? 19,000. 90,000. Okay. Now tell me, would it be appropriate to take 90,000 every year? Yeah? Not correct. So what is that you should do? What should you be doing? So how much loan should I be assuming it's there even in the beginning? Yeah? Yes? So 90,000 in the current year it is okay. In the previous years, what would be the situation? Did he tell you when he took that loan? No? Okay, let's assume like this. Let's take it a point. Okay, first let's take interest at 12%. loan taken domestic loan, let's say. I'm just trying to give you a different scenario because I don't want to take completely throughout all the years. That's why. Okay. Domestic loan taken on 1/4/21. Okay. And foreign loan taken. I'm just trying to create new scenario. It's not there in the question. That's why. Okay. Foreign loan taken on 1/4/24. Okay. Now tell me, how much will you consider as interest for the first 3 years? Out of the total loan, he says 60% is foreign loan, yes or no? That means domestic loan is only 40%. 40% is basically 3 lakhs. On 3 lakhs, 12% you are supposed to take all years, yes or no? Okay. 3 lakhs you are supposed to take for all years, but for the remaining 4.5 lakh alone, you should take only in the current year. Okay. Let's try to create that scenario since he did not give you full information. Okay. Na? So if this information is not given, what would you do? You will have to take like now 90,000 what you told throughout all the 4 years. Yes or no? You don't know what when it was taken, so that you will assume that it is taken right from first year of the profits given. Okay. So now I am creating a scenario here saying that domestic loan is taken from 1st of April 21, but foreign loan is taken only from 1st of April 24. With that assumption, let us do. Okay. So 3 lakhs into 12% is going to be 36,000, yes or no? So 36,000 will be deducted in all the 4 years. Okay. Now for foreign loan taken, it is going to be how much? 4.5 lakh into, now should you take 4.5 lakh into 12% or 4.95 lakh into 12%? 4.95 lakh into 12% is what you are supposed to take. 4.95 lakh into 12% is what you are supposed to take. Why? Because that's your balance here. That's your current year outstanding. Okay. How much is it? 59,400 it seems. Okay. Now, I think with this interest also is considered. What you now get is profit before tax, right? So please calculate what is profit before tax. First one is 4 lakhs, huh? 4,54,000. 5,14,000. 4,51,000. 3,65,300. Over. Now tell me, I have got last 4 years data now, right now. Last 4 years data is something which I have got. Now if you look at that, do you see any trend in it? Do you see any trend in it? First year it is 4.54 lakh. Second year it went up 5.14. Third year it fell down. Fourth year it further fell down. That means there is no trend here. It's zigzagged. It's zigzagged. Which means whenever you have FMPs for a period, for various financial years, if you see trend in it, if you see trend, it could be upward trend or downward trend. If you see a trend in it, then you are supposed to calculate weighted average. Otherwise, simple average is supposed to be used. Otherwise, simple average is supposed to be used. Now, since that it is no trend situation, we will go with simple average. Okay. Now, if at all there is trend, what weights to be given to which year? What weight to be given to which year? Highest weights to the recent past. Highest weights to the recent past is the logic. That means, uh, in this case, you would give highest weight to 24-25 data. Okay, that is in case there is trend. Since it is not there, we will calculate it right now in simple average. Okay, so let's calculate average profit. Okay, average profit is going to be all of that divided by 4. Please tell me. 4 lakh 075. Okay, from this you can deduct tax, 30% tax rate. Value please. 1,33,823. Profit after tax is okay. Now you have got FMP. You know what is industry rate of return. What did he tell you? It is 15%. Okay. Now let's do that. Industry rate of return is 15%. So goodwill calculation. Goodwill calculation. What is average capital employed using ACE and super profits? So average capital employed is 8 lakh 15,695, and industry return is 15%. Okay, so normal profits is going to be that into this percentage, 1,22,354. So super profits is how much? 312,252 minus 122,354. 1,89,897. 898. Okay. Okay. Now, did he tell you years of purchase? Number of years of purchase is 4. Goodwill is going to be how much? 759, 592. Okay. So with this, we will stop valuation of goodwill. I think decently two problems. One with full loaded adjustments. This is decent. Okay. ఒకవేళ వస్తే కనుక ఇలాంటి ప్రాబ్లమే రావచ్చు. మరి అంత భయంకరమైన డేటా బిట్ రాదు. ఓకేనా? If at all a problem like this is asked, it will be at least for 12 marks to 16 marks. Depends. All right. Now let's move ahead to valuation of goodwill. Sorry, shares. Okay. మళ్ళీ ఎందుకంటారా? Valuation of shares. Okay. Now valuation of shares. Valuation of shares. Predominantly, there are three ways in which we do. Predominantly, there are three ways in which we do. The first is the most simplest method, what we call as intrinsic value. We also call it as net asset method of valuation. Net asset method of valuation. Okay. Second is based on your growth. Based on your growth. Okay. So for growing companies, we don't go by intrinsic value method or net assets value method. Instead, we go based on what earnings they generate. Okay. What earnings they generate, or what dividends they pay, and based on their yield. Based on their yield. Okay. And there are few schools of thought. There are few schools of thought which take an average of these two. That is intrinsic value plus growth model divided by 2. They take an average of these two. This is the third possible way, but that's a very simple method. Obviously, when you calculate two values, to take average of that is where your value per share comes. Okay. Now, in what circumstances which method has to be used? Intrinsic value or net assets method is a very straightly followed only in case the company is in liquidation, or going concern is no more seen. That means no going concern. No going concern exists for the company. Okay. In case the company is a going concern, if going concern is established, then you go with your growth models. Why? Because you know you will sustain in the market further. Okay. You know you will make profits in future. In which case, I don't want you to do valuation based on only based on what assets you have today. Logic is fairly simple. Say there is a hotel not at all operating. There are no staff with me. I can't see visibility for the hotel in the place at all. It is completely not functioning. Now, any person who comes there, what would he do? He would say you should only consider it as scrap sale. Okay. Now, if the hotel is really functioning well, when the prospective investor comes, he can see a lot of traction happening there. he can see menu card to be really attractive to customers. There is throughout night continuous orders being taken up. In such case, there is cash flows being generated. There's cash flows being generated. In which case, they would not do it as normal, based on the assets available. They do based on the cash flows what they generate. They do based on the cash flows what they generate. That's the same logic being applied here. So one more example. Manaki, people keep giving you this example to keep yourself updated in Japanese. ఒక వైలిన్ తుప్పటేసి వాళ్ళు దుమ్ పట్టేసి పక్కన ఉందనుకోండి, దాన్ని తీసుకెళ్ళి ఎంత అని అడిగితే కనుక ₹1000 అంటారంట. అదే నీట్గా పాలిష్ చేసి ఎవడన్నా ఒక మంచి ఆర్టిస్ట్ కూర్చుని దాన్ని వాయించి బాగా పనిచేస్తుందని చూపించి అదే మ్యూజియంలో పెడితే మనం కోట్లకి ఎదగ వెళ్ళిపోద్ది. వై ఈజ్ ఇట్ గోయింగ్ హై? Because you are able to show the productiveness of that particular violin there. In the first instance, it's just the same violin but completely unproductive. So the moment you show that there is value inside it, automatically value increases. Okay, so that's the objective as to what we are trying to establish here. Okay, now having said this, now let's look through how we do intrinsic value method and how we do based on earnings, dividends, yield and all. Okay, so earnings, dividend, yield are fairly slightly difficult. I mean, like, you need to calculate the what is the earning made by an entity and all that stuff. But from CMA perspective, what is standardly asked is only net assets method. Okay, most of the times the question came only from net assets method, but I'll explain how growth models are also done. That's all. Okay, so first we will finish off net assets method. In net assets method, you would take realizable values of assets. Okay, realizable values of assets. Please note, realizable value does not mean fair value. Realizable value means what I will be able to collect today. See, I am talking about a dying company. ఎంత వస్తే అంత తీసుకుని అప్పులు తీర్చేసి బ్యాలెన్స్ షేర్ హోల్డర్కి ఇస్తాం. ఓకే, సో ఇన్ సచ్ కేస్ I will not look at what its fair value is. Okay, I will not look at what its fair value is. Yeah. So say for example, there is a company is in a distress sale. Bankers auction lo pedta untaru. When they put a land or any property in auction, banker side, he will not say, see, fair value is 10 crores. I am expecting 10 crores is what not what he is going to tell you. What he will say is, fair value is 10 crore. My loan against this property is only 5 crore. If you give 6 crores also, I'm okay. Okay, so what I'm trying to convey is, people don't look at the fair value the moment company is in liquidation. Okay, so in which case you go by realizable values of asset and then you go with settlement values of liabilities. Now what does this settlement value mean? Same banker, he says, look, you don't have any property with you. My loan what I actually gave you is 3 crores. వడ్డీలు పెరుక్కుంటా 5 కోట్లు అయింది ఇప్పటికి. 5 crores is my liability now. 2 crores is your interest only on that loan, which I did not receive. You also have to pay now. Let's both come to an arrangement. I will give you a OTS, one time settlement facility. Okay, one time settlement facility is, my principal should definitely come. You should pay at least 1 crore as interest. You should pay You should pay at least 1 crore as interest. That means all put together, at least you pay 4 crores. Let's close it off here itself is what he came up as an offer. Okay, that means my settlement value of liability, though my books shows 5 crores, he agreed for 4 crores. Okay, that value is what you consider as your settlement value. That will be considered as a deduction from your assets available. Okay, on doing this, you get monies available to equity shareholders. Okay, money is available to equity shareholders. This divided by number of equity shares outstanding. Okay, will give you value per equity share. Am I making sense? Okay. Now, one important thing what you need to observe here is whenever you do net assets method, he would give some value to the goodwill also. Okay. In which case, while calculating values of the assets, you should first calculate goodwill, incorporate that goodwill value in your net assets calculation, then calculate your net asset value per share. Okay. So in case the question asks you to do goodwill also, first step is going to be solving goodwill only. Then only you will bring that into your net assets method. Okay. Book goodwill is always irrelevant. Book goodwill is always irrelevant. So this is with respect to your net assets method. Now, coming to growth models. Coming to growth models. You have 3 models is what I have just stated. Okay. So in these 3 models, how do we calculate is something you need to see. Now, first one is based on earnings, which I told you. First one is based on earnings, which I told you. Now, what does earning mean? Earning to equity shareholder. Okay. Earnings available to equity shareholder should be considered. And to this, he tells you a multiple to that. He tells you a multiple to that, saying that it is earnings multiple. I give value per share based on earnings multiple. So what does that mean? Say for example, if the earnings available to equity shareholders is 10 crores and he says, I would give a earnings multiple of 5. I would give a earnings multiple of 5. That means 50 crores is my company valuation. That divided by number of equity shares outstanding. That divided by number of equity shares outstanding. If we do it in that way, you call it as earnings multiple. Same way, if you do it based on dividends paid. Okay. Now, in what circumstances should we use earnings multiple? What circumstances should we use dividend multiple? If you observe, earning multiple would be applicable in case the entity is profit making. The entity is profit making, but may not be in a position to pay dividends. It only would like to accumulate profits and reutilize in the business. Reutilize in the business. In the second instance, dividends multiple is when entity is actually paying dividends. Again, same logic. If a company is paying dividends, dividend paid into number of multiples is what gives you dividend multiple. Now, what does yield mean? What does yield mean? Stock market. Idea is working. Yield indicates the profit earned divided by actual capital employed. See, it's not equity share capital alone which you are investing. Okay. So equity share capital is some. There could be some loan funds also. Okay. Out of the investment made, what is the profit generated? So when you take that, it is considered as yield. So that yield is also multiplied with a factor, with a multiplier, that gives you yield based valuation. Okay. So uh, these growth models, I don't think, at least CMA exam it is being asked. So information is sufficient for you, but we will do problems in intrinsic value now. Okay. Net assets lo book value తీసుకుని అర్థం కాలేదు నాకు. See, if the question specifically asks you to do it in net assets method, you will do. But in reality, in what circumstances do you use net assets method is where only in case going concern is not indicated. Okay. Yeah. Look at this question. Balance sheet of John Engineering as on 31st December 24 is given below. Share capital 1,50,000 equity shares of 10 each, 2 lakh equity shares of 10 each, 6 fully paid up. Very, very important this is. Okay. 9% cumulative preference shares, reserves and surplus, P&L negative, long-term borrowings 18% term loan, trade payables, total assets, fixed assets, non-current investments 400, inventories, trade receivables, cash and cash equivalents total. Other info, current stock of fixed assets 37,000 and stock 1,000. Investments could fetch only 100,000. 50% of debtors are doubtful. Preference dividend was in arrears of John Engineering Limited. Find out intrinsic value per share. Straight question. Yeah. So he told you directly what is the uh, value. Yes or no? So let's do that. In this problem, it's not about net assets calculation, it's about the denominator calculation. What is important? Number of shares outstanding is the key here. When I go there, I'll talk about it. Okay. 13th question. Calculation of net assets value. So fixed assets, he told you it is 3,700. 3,700. Stock is 1,000. Then investments 100. Okay. Then he says trade receivables is 50% debtors. That means it is only 200. Okay. Cash and cash equivalents 400 can be taken. Okay. Next. Now please take liabilities. Now please take liabilities. Liabilities. Did he tell you that any discounts are given by lenders? Nothing given. So 1400 has to be taken, 800 has to be taken. Additionally, preference dividend is due is what he's saying. Okay. That is also to be taken. And 9% preference shares also has to be paid out, because the NAV method, your ultimate objective is to find out what is available to equity shareholders. So even preference share has to be settled. Okay. So let's take all of this less 9% preference share capital 600 Interest on preference share capital, how much is it? 54. Okay. Then 18% term loan, how much is it? 1400. And trade payables 800. Okay. Now many think that it is over here. Many think that it is over here. Now tell me, he gave you in the question saying that there are 2 lakh equity shares of 10 each, 6 paid up. Okay, that means 4 rupees mandatorily. If you are going to liquidation also, you will call that money. Yes or no? Call money is receivable on call, final call. 4 rupees per share is what you are supposed to call for. So 4 into 2 lakh rupees, how much is it going to be? Okay, 8 lakhs is what you are supposed to take. So that is basically 800. Okay, so please take that. Add money is at call 800. Okay, now tell me what is net assets available to equity shareholders. And the 3346. Okay, now how many equity shares are there? It is basically 1,50,000 and 2 lakhs. All put together 3.5 lakh equity shares is what I have. Okay, so now can you tell me what is అందుకనే కాల్ యాడ్ చేసాం కదా. ఇప్పుడు ఆ డబ్బులు వచ్చేస్తే ఫుల్లీ పేడ్ అప్ ఇంకా I'll tell you to that logic. Wait, I know what from where your question is. I'll give you that logic. First, let me complete. Okay. Now, 3,346 is the value for all the equity shareholders together. Okay. Number of fully paid equity shares outstanding is 150 plus 200. Yes or no? 350. Okay. Value per equity share of 10 each fully paid is how much? 9.56. Okay. So if it is fully paid, it is 9.56. Now, same way, if I have to find out what is value per equity share of 10 each, only 6 paid up. It is going to be 9.56 minus 4, which is going to be 5.56. Okay. అర్థమైందా? No doubt, brother. పర్లేదు. We have a lot of time today till 4 o'clock. At your service. After 4 no time. వస్తా చెప్తా. నాకు అన్ని మైండ్లో ఉన్నాయి, జనాలు అవనండి. అయిందా? Okay, now let me change the situation. Same question. Say the shares are really only 6 rupees face value shares. Okay, I'm changing the situation. They are only 6 rupees face value shares. and you have 10 rupees face value shares also. Okay, or 6 వదిలే 5 చేసుకుందాం, ఈజీగా ఉంటుంది సాల్వ్ చేసుకోవడానికి. ఓకే, సో నౌ ఐఎమ్ చేంజింగ్ ద సిచ్యుయేషన్. Additional scenario. Okay, 10 rupees fully paid shares are 1.5 lakh. Okay, 5 rupees fully paid shares are 2 lakhs. Okay, in this case, how would the answer change is the question. Hang on. Now your net assets available to equity shareholders would be without this 800. Do you agree? Why? Because there is no call money pending. There is no call money pending. Okay, so in which case my net assets available to equity shareholders would be 2546. Yes or no? Okay, in which case it is going to be 3346 minus 800. Why? Because that 800 does not come to me any further now. Okay, so it is only 2546. Now to take the denominator, you should pick denominator such that you do it for the least face value per share. You find out how many equivalent number of least face value per shares would be. Okay, so denominator would be so if I have 1.5 lakh shares of 10 rupees each, equivalent number for 5 rupees would be 3 lakhs. Okay, so 3 lakhs plus 2 lakhs both put together 5 lakh is what I take. Okay, now so what is the value per share now? Value per share of rupees 5 paid, 5 each, 5.09 is what you got. Okay, and equivalent number of 10 rupees share would be 10 rupees share would be 10.18. Okay, now in 10 rupees share, so this is one situation. I will add one more scenario. Additional scenario 2. Okay, so I have 10 rupees fully paid shares of 1.5 lakh, 5 rupees fully paid shares of 2 lakhs. Apart from that, your original case of 10 rupees fully paid 10 rupees 6 rupees paid shares, another 2 lakhs. Rendu mix chesestunna ippudu. What if you have all these scenarios together? Now your net assets value will be the original same 3346. Why? Because you are supposed to receive that 4 rupees per share. Okay, so here it would be net assets is going to be the same 3346, and in the denominator number of shares would be now again you need to find out how many 5 rupees equivalent shares would be there. Yes or no? How many 5 rupees equivalent shares would be there? So for this 6 rupees paid shares, you already added the call money receivable. Hence you can now assume that they are fully paid. Okay, so denominator would be 1.5 lakh plus 2 lakhs into 2. 5 rupees equivalent number of shares would be into 2. Okay, so it is going to be how much? 7 lakhs plus 2 lakhs, total 9 lakh shares. Am I making sense? Okay, now intrinsic value per share of rupees 5 fully paid up would be how much? 3346 divided by 9 lakhs. 3346 divided by 9 or 900. 3.72. Okay. That means intrinsic value per share of rupees 10 fully paid up would be 7.44. Okay. Intrinsic value per share of rupees 10, only 6 paid up, it is going to be 7.44 minus 4, which is 2.44. 3.44. Okay. Okay. So in each situation it would be different. Otherwise, I am confused. Denominator malli apna. Okay. So I am saying that how did I get this 7 lakhs is the question, right? So basically I have 10 rupees fully paid shares of 1.5 lakhs. What would be equivalent number of 5 rupees fully paid shares for that? Double, 3 lakhs. Same way, I have 10 rupees, 6 rupees paid shares for 2 lakh shares. Now, since I have added for that remaining 4 rupees here, remaining call money I have added here now. That's why I am assuming they are also fully paid. Okay. So 2 lakh into 2 shares, 4 lakhs. So both put together it has become 7 lakhs. 7 lakhs plus this 2 lakhs. Total I have 9 lakh shares of 5 rupees each. Equivalent to 5 rupees. Okay. So that 9 lakh shares is what I have divided this 3,346. I got per share of 3.72 for 5 rupees share. For 5 rupees share. Then what it would be for 10 rupees fully paid. For 10 rupees fully paid, it is going to be 7.44. Out of 7.44, if 4 rupees is still pending, it becomes 3.44. Okay. So I don't foresee beyond this logic question to come. Okay. Next question also is in similar lines. Let's finish it off. Balance sheet of Major Limited as at 31st December 24 is as follows. Equity shares 100 each, less calls in arrears, 8% preference share capital of 10 each, general reserve P&L, short-term borrowings, bank loan, trade payables, assets, tangible fixed assets, factory shed, machinery, furniture, vehicles, goodwill, non-current investments, inventories, trade receivables, cash and cash equivalents, other current assets, preliminary expenses. Which means what? Fictitious. Okay. Fictitious. Now, fixed assets are worth 20% above their actual book value. Depreciation on appreciated portion of fixed assets is to be ignored for valuation of goodwill. Of the investments, 80% is non-trading and the balance is trading. All trade investments are to be valued at 20% below cost. A uniform rate of dividend of 10% is earned on all investments. For the purpose of valuation of shares, goodwill is to be considered on the basis of 6 years purchase of the super profits based on the average profit for the last 3 years. Profit after tax at 50% are as follows. In a similar business, return on capital employed is 20%. In 2022, a new furniture costing 10,000 was purchased but wrongly charged to revenue. No effect has been given to rectify the same. Depreciation charged on furniture is 10%. WDV 10, WDV. Find out value of each fully paid and partly paid equity share. Now, there is a problem where you should first calculate goodwill, incorporate that in your NAV method calculation, then find out your value per equity share. Okay. So first let's finish off goodwill calculation. So for goodwill calculation, what is he saying? He wants you to value goodwill on super profits basis, on super profits basis on the average profit of last 3 years. Okay. So you should first calculate what is the closing capital employed is required, average capital employed is required, and then you should go by the future maintainable profits using the last 3 years data. All literally the problem which we did today morning first, that problem should be fully done, then go ahead for remaining thing. Okay. Let's begin. So first is calculation of closing capital employed. Closing capital employed. Now, so he says assets are worth 20% above their actual book value is what he has stated, yes or no? Right? So you can take all the assets put together and take a 20% above that. So factory shed 3 lakhs, machinery 2.3, furniture 25,000, vehicle 60,000. All put together, what is the value for all of this together? 5 6 lakh 50,000. 6 lakh 15,000. Okay, 6 lakh 15,000 into అది separate చేద్దాం అంటే there's some working to be done for that, no? You need to first arrive at the WDV, then do it, right? So fixed assets given in balance sheet 6 lakh 15,000, 15,000 into 120%, 7 lakh 38,000. Okay, now let's come to that furniture. Furniture he purchased when he purchased it in 2022. So if it is 2022, right now I am in 2024. How many years passed? 2 years passed. Okay, 2 years or 3 years? I think it's 3 years. No, he has given you December 24. That means 22, 23, 24. 3 years passed. Okay, so please take furniture 10,000 into 90% into 90% into 90% into 120%. 8748. Okay, guys. Then what else do we have? Yeah, you now have goodwill. We will not consider because we are calculating goodwill now. Okay, then non-current investments 1 lakh. Now what did he tell you about investments? 80% is non-trade. Balance investments are to be valued at 20% below cost. That means 20,000 into 80%. It's going to be 16,000. Okay, so trade investments 1 lakh into 80, 1 lakh into 20% into 80%. It is 16,000. Okay, then you have inventories 2 lakh 10,000 given there. Did he tell you anything about inventories? Yeah, nothing mentioned. 2 lakh 10,000. Then trade receivables 3 lakh 50,000. Nothing mentioned. Cash and cash equivalents, you can take it as this. Preliminary expenses should not consider. Trade receivables 3 lakh 50,000. Okay. Then what? Cash 50,000. Inventories is 2 lakh 10,000. అయిపోలేదు కదా ఇంకా లైబిలిటీస్ ఉన్నాయిగా ఎందుకంత ఆవేశం యా నౌ లెట్స్ గో టు liabilities so you have trade payables 2,70,000 borrowings 1 lakh okay now preference share capital should I take or not goodwill valuation should not take should not take so it's basically only 3,70,000 okay so trade payables is 2,70,000 and bank loan is 1 lakh that's all ah 10 lakh 2,748 okay now that you have got closing capital employed you should go ahead for average capital employed for which you need to know what is current year profit okay so number 2 calculation of average capital employed in that a calculation of current year profits okay what is the profit given for the current year 2.5 lakh for 24 it is 2.5 lakh and he says tax is 50% yes or no now he gave you actually profit after tax 2,50,000 add back taxes 2,50,000 so profit before tax is 5 lakhs okay now what adjustment do we have to do only one adjustment is there which is depreciation for the current year yes or no so depreciation on furniture it is basically 10,000 into 90% into 90% into 10% 810 okay so it's basically corrected profit before tax 4,99,190 okay less tax at 50% 2 lakh something tell me 49,599 so profit after tax would be same 2,49,599 595 okay so average capital employed is going to be 10 lakh 2,748 minus half of 2,49,595 value please 8 lakh 77 okay 950 okay now so you have got average capital employed you now need to calculate what is FMP okay so let's go ahead number 3 FMP calculation using past 3 years info okay now again particulars 2022, 2023, 2024. Only adjustment required to be done is the depreciation adjustment. That's all. Okay. So profit before tax, profit after tax given, no? Okay, okay. After tax, how much is it? 1,90,000, 2 lakhs, 2,50,000. Add tax 50%, same 1,90,000, 2 lakhs, 2.5 lakh. Profit before tax is going to be 3,80,000, 4 lakhs, 5 lakhs. Okay. Now, less depreciation on furniture. Oh, first we need to add the furniture, no? Okay, fine, fine, fine. Okay. Add furniture wrongly taken. So in which year it is? First year. 10,000. Please add less depreciation on furniture at 10% WDV. It is going to be 1,000 for the first year, 900 for the second year, third year is 810. Okay. Now, apart from this, what other adjustments do you think we need to make? We are doing FMP, so any non-trade investment income should be deducted, yes or no? So non-trade investments are 80% of 1 lakh. And he says uniform rate of dividend of 10% is earned, is what he says. Okay. So less interest on non-trade investments at 10%, 8,000 for all the 3 years. Okay. Now, can you please tell me the values? 3,81,000, 91,100. Now tell me, do you see any trend or not? There is a trend. Okay. So write down since trend in profits is visible, consider weighted average. Okay. Highest weights to the nearest period. Highest weights to the nearest period. Since trend in profits is visible, consider weighted average. Highest weights to the nearest period. So that is going to be 3,81,000 into 1 plus 3,91,100 into 2 plus 4,91,190 into 3 whole divided by 6. Value please. 4,39,462. Okay. So this is basically your base profit. Now tell me, what is the future tax rate he has told you? Did he tell you anything about future tax rate? Nothing told? All right. If nothing is given, assume tax at 15% on FMP. I'm giving you. I'm giving you. See, the reason why I'm giving you 15%, I'll tell you. If I give you 50%, like how it have happened in the past, you will think that why should I do this calculation at profit before tax? This is revised profit before tax, right? Okay. Now you will get a thought. If it is the same tax rate, why should I do before profit before tax is what you get? But fact is, there is a possibility you are right now arriving at a situation where you're calculating future maintainable profits. In the future, the tax rate need not be same what it happened in the past. If you look at your tax reforms also, budget will announce tax rate for next year in the current year, saying that from next year onwards tax rate is 25% on companies, or next year onwards tax rate on companies is 30%. So he is giving you future rates, in which case that rate should be applied for my calculation. Okay. So for that reason, we will first calculate base profits, taking the weighted average or simple average. On that we will apply tax rates. Okay. So assume tax at 15% on future profits. So it's going to be how much? $65,919. So FMP after tax is 542. Okay. I'm giving you an assumption of 15%. Fairly speaking, if nothing is given, you can assume the same 50% and do also. You can take the same 50% and do also. This is an additional scenario for you. Okay. So if it is at same 50%, what will happen? 4,39,462 in that 50%. 2 lakh something. 2,19,731. Okay. If problem is silent, you can go ahead with the same 50% as future tax rate also. I am changing here because I want you to experience, in case if the future tax rate is different from current tax rate, how does the answer change? That's all. Okay. Now, once this calculation is done, can we now go ahead for calculation of goodwill or not? Okay. So number 4, calculation of goodwill. So industry rate is how much? 20%. Please see there. He has given you here. Where? Yeah. Okay. 20% is what he says. So now let's calculate what is average capital employed is how much for you? 877,950 into 20%. 1,75,590. Okay. Super profits are 373,542 minus 175,590. In my case, in the case which I gave you. Okay. 77,952 into how many years of purchase? 3 years, sir. 593, 856. If you go by 50% tax rate, what would be the goodwill? It is going to be 219,731 minus 175, 570, 590. If you go by 50% tax rate, what is the goodwill? 44,144 into 3, 1,32. Yeah. Okay. Hello. He has told you on the base of 6 years profit, no? 3 years another? Huh? Come on. Yeah. Please correct it. ఏది 11 lakhs? 15%. 11 lakh 712. Okay, here 24. Okay. Now, so please highlight that this is a special scenario for you. Okay. Special additional scenario. Okay. What is additional scenario for you here? It is only about assume tax rate at 15%. Okay. So now we will continue with the same 50% tax rate thing. Okay. What we calculated here. Now you can go ahead for calculation of your net assets value. Yes or no? So number 5, number 5, calculation of net assets. Okay. Now, fairly speaking, you have already calculated closing capital employed here. Yes or no? Closing capital employed you have calculated here, saying it is 10,02,748. Right? To that, if you add goodwill, if you add non-trade investments, if you add anything else, what else do you have? Calls in arrears. You get to know what is assets available to equity shareholders minus preference share capital. Okay, so let's do that. So closing capital employed is 10 lakh. How much? 1002 748. Okay, so to this add non-trade investments. ఎంత 80,000. He did not tell you anything about fair value of that 80,000. Okay. Add goodwill. Goodwill, how much is it? 2 lakh 64 864. Add calls in arrears 10,000. Okay. That's it or anything else? That's it or anything else? He also told you about preference share capital there, no? 8% preference share capital is there for 2 lakhs. You are supposed to deduct that. Right or not? Did we deduct the preference share capital while calculating capital employed, closing capital employed? We did not. Now you are calculating net assets available to equity shareholders. When you are calculating net assets available to equity shareholders, you should deduct that preference share capital also. Okay. So less preference share capital 8 lakhs kada. 2 lakhs, huh? Oh, 8%. Huh? Okay, fine. How much? 11,57,612. Okay. Net assets available to equity shareholders. Okay. Now, please take number of equity shares of 10 each fully paid. It is basically how many? 50,000. 100 rupees each, no? Sorry, not 10 rupees each. It is 100 rupees each. So it is only 5,000 shares. 100 each, fully paid up, 5,000 shares. Net asset value of rupees 100 each, fully paid, is equal to how much, please? 200 and 231.5. Okay. NAV of 100 each, rupees 98 paid up, yes or no? It's going to be 229.5. He told you only 2 rupees is final call pending, no? Out of 100 rupees, only 2 rupees pending. So it is going to be 229.5. Over. So with this, we'll stop valuation. Okay. Break. AS7 and AS19. Let's finish these two now. And in the afternoon, we'll finish off with cash flow statement so that we can bid adios. A firm of contractors obtained a contract for construction of bridge across river Revati. ఎక్కడుందో నాకు తెలీదు. Yeah. The following details are available in the records for the year ended 31st March 21. Total contract price 1000. Work certified for the cost incurred 500. Then you have work yet not certified for the cost incurred 105. Estimated further cost to completion 495. Progress payments received 400, to be received 140. Okay. The firm seeks your advice and assistance in the presentation of accounts keeping in view requirements of AS7 issued by the institute. Okay. Now, first of all, he says contract price is how much? Contract price is 1000. Okay. Now, till now, the work certified is 500. Work already done but not certified is 105. 105. And then you have estimated further cost to completion is 495. Yes or no? So that means total cost of project would be the total of all of these three. Yes or no? Total cost, estimated total cost is total of all of these three. How much is it? 1100. Okay. So what A7 says is, the moment you see your cost going beyond your contract price, you should provide for that loss immediately. So you are saying your contract price is only 1000, but you are foreseeing that your expenses will go beyond 1000 today itself. That means that extra 100 rupees you should provide today itself. Okay, that is number one. Progress payments received is 400, to be received is 140 is what he says. Okay, so right now what is billed, that means progress payment out of received is 400, yet to be received is 140. That means I billed for 540, of which 400 is received, 140 is yet to be received. I completed work worth 605. I completed work worth 605, of which I have already billed for 540, of which I received only 400. Am I making sense? Okay. So that is what he is giving you. So now he is asking you advice and assistance in the presentation of accounts. That's all. Okay. So what you would see is, you would show is your total cost spent and to be spent, expected total cost all put together is going to be 1100 less total contract price 1000, recognize immediately in P&L and for the future loss of 100. Okay, number one, that is supposed to be done. Then what else do we have? Now you have work completed, which is how much? 605. 605 is the work completed out of a total work of how much? 1000 or 1100. 1000 or 1100. Right now your total cost of the project is 1100. Okay, so that means you get a percentage by taking 605 by 1100. So much percentage of revenue is supposed to be recognized. So let's put that down. A7 problems. Number one, amount of construction loss to be provided for. Okay. Total project cost incurred plus to be incurred. Okay, is 500 plus 105 plus how much is it? 495. 700 less contract price 1000. Loss provision to be made immediately. Okay. Next, number 2, calculation of percentage of completion for revenue recognition. For revenue recognition. Total work completed. That means certified plus uncertified divided by cost of the project. This is basically revised cost of the project. It's basically revised cost of the project. It's going to be 500 plus 105 divided by 1100. Percentage, please. 55, 55%. Okay. Revenue to be recognized. 1000 into 55%. 550. No? Revenue to be recognized is 550. Now, he says, so 550 is basically your revenue which you recognize. Okay. And how much did you receive as progress payments till now? 400. Yet to be received is 140. 140 is what he says. Now, what is the liability you have at this juncture? Or amount, what is the amount which you are supposed to collect from customers? Progress payments received is 400. To be received is 140. That means 540 is what it says. Okay. Now, you recognize revenue of how much? 550. Yeah. So 550 is what you have recognized as revenue, of which only 400 is received till now. 400 is received till now. 140 is due from customers. Okay. So how do you recognize this? So in a P&L statement, if you show, in a P&L statement, if you show, how do you show it? P&L revenue you recognize is 550. Yes or no? Revenue recognize is 550. Then what would you take as an expense? What would you take as an expense? Only to the extent of work certified do you show as expense, or even work uncertified also you show as an expense? Work uncertified also. So it is basically 500 plus 105. Yes or no? 500 plus 105. Apart from this, a loss provision is supposed to be made. Okay. 100 is loss provision what you make. Okay. So now tell me, do you have any profit? You don't have any profit. You actually have loss. How much is the loss? 1. Okay. So basically the loss is so it is 705 minus 550. 155 is your loss. Am I making sense? Now, from your balance sheet perspective, how much should you be showing as receivables and payables? So out of 550 revenue recognized, you have received 400. That means out of 550, 400 is received. 140 is your receivable. And is there anything I will have to pay? I will have to pay. Did he tell you anything about liabilities for you? Yeah. He did not tell much about it, right? So it's not much given there. Okay, 605 is your work certified, sorry, work completed, and for the work completed, you have recognized revenue of 550. That's all. Okay, so with this, we will leave it here. So he's asked you how it is going to be presented. We have shown you how P&L appears. That's all. Okay. Then second question, please see. On 1st December 21, Vishwakarma Constructions Limited undertook a contract to construct a building for 85 lakhs. On 31st March 22, the company found that it had already spent 64 lakh 99,000 on the construction. The prudent estimate of additional cost to complete was 32 lakh 1,000. That means how much is that going to be total? 97 lakhs. That means your contract price is only 85 lakhs, but your spend is 97 lakh. That means you have a loss of 12 lakhs. Okay. Prudent estimate. Okay. What amount should be recognized in the P&L for the year ended 31st March 22 as per provisions of A7? Just now we told 12 lakhs. That's all. Direct question. Okay. Next. Now, next question, if you see, he talks about Akar Limited signed on 1/4/21 a construction contract for 1 crore 50 lakhs. Following particulars are extracted in respect of contract for the year ended 31st March 22. Material used 71 lakhs, labor charges 36 lakhs, hire charge for plant 10 lakhs, other cost incurred 15 lakhs. Okay. Then labor charges 2 lakhs are still outstanding on 31st March 22. It is estimated that by spending further 33 lakh 50,000, the work can be completed in all respects. You are required to compute profit or loss for the year to be taken to P&L account, and any provision for foreseeable losses to be recognized as per AS7. So whatever loss, whatever expenses you have incurred, you should take. Okay, work certified or uncertified, you should take. Apart from that, you should also calculate what is the percentage of revenue to be recognized out of 1.5 crores. And if there is any foreseeable loss, that is also supposed to be recognized. Okay. Now, first of all, tell me what is the cost incurred till date? 71 lakhs plus 36 lakhs plus 10 lakhs plus 15 lakhs plus 2 lakhs. Enta? 1 crore 34 lakhs. And he says further 33 lakh 50,000 has to be incurred. So 1 crore 67 lakh 50,000. So 1 crore 67 lakh 50,000 is the total cost, foreseeable cost. But your revenue is only 1.5 crores. That means you should provide for it immediately. Difference. How much is it? 17.5. Okay. Now, what is the percentage of work completed till now? What is the percentage of work completed till now? So illustration question 1 na? Question 1. So cost incurred till date. Material, how much is it? 71 lakhs. Labor, please take with outstanding. 36 plus 2 lakhs, 38 lakhs. Okay. Then you have plant charges. Plant charges is 10 lakhs. Okay. Then other contract cost incurred is 15 lakhs. Other contracts cost 15 lakhs. Okay. So this is basically cost incurred till date. How much is it? 1 crore 34 lakhs. Add further cost to completion. How much is it? 33 lakh 50,000 is what he has given. Estimated total cost 167 50,000. Okay. Less contract price 1 crore 50 lakhs. This gives you loss provision 17 lakh 50,000. Okay, 17 lakh 50,000 loss provision. Next, percentage of completion, work completed. What would I take now? Yes. So it is going to be 1 crore 34 lakhs divided by 1 crore 67 lakh 50,000 to 100. Percentage 80%. Okay. Revenue to be recognized is going to be 1.5 crore into 80%. And 1.2 crore. Okay. So now let's put all of these in a P&L. Okay. So revenue is going to be 1 crore 20 lakhs. To expenses incurred till date are 1 crore 34 lakh. Right? Next, to loss provision 17 lakh 50,000. Now, by the way, the total loss provision is supposed to be 17 lakh 50,000. No. Okay. Already out of this 17 lakh 50,000, I am providing how much here? Here itself, I am able to recognize a loss of 14 crores, 14 lakhs, yes or no? So additionally, if I have to provide, it is going to be only the remaining amount. 3 lakh 50,000 is what's supposed to be provided. So It's going to be 17.5 lakh minus 14 lakh already provided from this above itself. So now if I provide just 3,50,000, it's sufficient. Okay. So let's go to next question. This is slightly holistic. A construction contractor has a fixed price for 9,000 lakhs to build a bridge in 3 years. To build a bridge in 3 years. Initial amount for revenue agreed in contract is 9,000. Variation in revenue over next 2 years there is there. Contracts cost incurred up to the reporting date. Numbers are given with some important points. Estimated profit for whole contract is given. So first star mark includes 100 lakhs for standard material stored at the site to be used in year 3 to complete the work. That means out of the total cost, it is just stored there. It is not actually used. Okay. Next. Second star mark excludes 100 lakhs for standard material bought forward from year 2. That means in that 100 is not there. Variation in cost and revenue in year 2 has been approved by customer. Okay. Compute year-wise amount of revenue, expense, contract cost to complete, and profit or loss to be recognized. The statement of P&L as per AS7. Okay. So first of all, what we need to observe is first year is a very simple thing. First year it is very simple. Why? Because he says what is the contract cost here. He told what would be the estimated profit for the whole contract also. Okay. Now tell me, sitting in year 1, what would be my expense for the rest of the period? What would I know about the contract cost I'll have to incur in future? Please see, revenue wise there is no change, 9,000 rupees only every year. Costs, if you see incurred up to date, it is 2,093. Okay, 2,093 is what I have spent, and he is saying estimated profit for whole contract is 950. Now from 9,000, if you deduct 950, you get what is the total cost projected, yes or no? You can do it reverse. Okay, so using that you would get to know what is the percentage of completion. You would get to know what is the percentage of completion. Second and third year, let's do it little later. First, let's do it for first year. Okay. Okay. Calculation of percentage of work completed. And total estimated cost. Okay. Now take particulars and 3 amount columns for 3 years. We will first fill only first year data. We will take it for all the 3 years. Okay. Take particulars, year 1, year 2, year 3. Okay. Now take revenue. Revenue is first year you are expecting that revenue is 9,000. Second year 9,200. Third year also you are expecting the revenue to be 9,200. Okay. From that, if you deduct expected profit, he says it is 950,000. Okay. This gives you what? Expected total cost. Expected total cost, in fact. For 3 years. It is going to be 8,050, 8,200, 8,200. Okay. Now, you need to understand what is the actual cost incurred till now. Okay. Now, he says first year actual cost is 2,093. That you can directly take. Second year, though he says 6,166, you are supposed to take only 6,068. Why? Because 100 rupees is for third year. You purchased and kept material in your store. Doesn't mean you used for the project. Okay. So you just bought it in advance and kept it with you. You did not use. Hence, it's only 6,068. Third year, what will happen? It is not 8,100. It is plus that 100 rupees. Okay. So let's do it. Cost incurred is going to be 2,093 for the first year. Then 6,068 for the second year. And 8,200 for the third year. It's basically 6,168 minus 100. Here it is 8,100 plus 100. Okay. Now please calculate what is percentage of completion each year. This is cost incurred till date. Very, very important. Yeah. Can you please tell me percentage of completion? 2,093 divided by 8,050. 26%. Okay. 74%. 100%. Okay. Okay. Now that you got percentage of completions and all, can we recognize revenue? We can recognize revenue. Okay. Now, revenue recognition. Okay. Now, please take like this. Revenue to be recognized till date. Revenue to be recognized till date. Okay. It is going to be out of 9,000, 26%. 2340. Okay. Now, for second year, it is going to be 9,200 into 74%. Please take 6,808. Third year, entire 9,200. Yes or no? Okay. Less revenue recognized in previous years till date. In first year, it is 0 because the first year, previous year, nothing would be there. In second year, already out of 6,808, 2,340 is recognized in first year itself. Okay. Then in third year, till second year ending 6,808 is recognized. Okay. So now what you get is revenue for current year is 2,340 for the first year. Second year, please tell me. 4468 and 2392. Okay. Inana 2392. Now you are supposed to take costs. Okay. Now cost, if you see, you incurred how much? You incurred 2093. Yes or no? Which is 26%. Okay. Now can you take that as it is? First year you can take. You actually really incurred the 2093. No, you can consider that. But second year you cannot take 6068 because that 6068 also contains 2093. Okay. Third year 8200 cannot be taken in full. It contains 6868. Okay. So less cost incurred till date. Okay. So it is going to be 2093 for the first year. Second year it is going to be year 2 6068 minus 2093. How much is it? 313975. Okay. For year 3 it is going to be 8200 minus 6068. 2132. Okay. Now we arrive at your profits. Profit for the period. First year, what is the profit? How much? 247 it seems. Second year 493 260. Profit or loss? Profit है क्या? Okay. I don't think any question would come beyond this. I'll explain once again. So basically what's given in the question is, he has told you aslo every year revenue ఎంత వస్తది, cost ఎంత వస్తది అన్నది he gave you cumulative costs here. Okay. Revenue also he is telling you along with variations possible. At the end of 3 years, what is the revenue I make? I am expecting that it to be only 9,000 in the first year. But second and third year, I am expecting it to be 9,200 because maybe I have satisfied some criteria there. Okay. So, and he also told you what is the profit which I will be making in the contract. Okay. Now, what is the purpose of giving that profit to be made in contract? Because generally in any problem, what they would do is they will give you cost incurred till date along with expected cost to complete. But in this problem, he did not tell you expected cost to complete. He gave you reverse working. He told you saying that if your revenue is 9,000, you will make 950 rupees of profit in first year. So that information is given to you to make you understand that difference is basically your cost to complete. total cost to complete. Okay, for that reason what we did is we first calculated what is the expected total cost to complete in 3 years time. Okay, every year we have deducted the profits from the total revenue. You got the expected cost to complete. Out of that, what is spent till then, will give you percentage of completion. Okay, so that way you got 26%, 74% and 100%. Now using these numbers, you should go for recognition of revenue. For recognition of revenue, if you directly apply that 26%, 74% and 100%, it will give you revenue till date. Out of the till date revenue, if any revenue is already recognized in the past, that should be removed to identify what is revenue for this financial year. Okay, hence first year there is no last year revenue. Second year onwards there is 2340 first year ka revenue already recognized. In third year, both years together, whatever you have already recognized, you have deducted. Okay, so that gave you revenue for current year. Now from this you have deducted costs incurred till now. So in cost, if you see again, first year you directly know what is the cost incurred. Second year he told you the total cost incurred is 6068. He actually gave you 6168, of which 100 rupees is cost incurred for next year, this year itself. Okay, that's why I have removed that. 6068 is the total cost incurred in the second year. Till second year, in fact, it's not in the second year, till second year. Out of that 6068, since 2093 is considered as expense in first year, remaining I have considered as cost in second year. Same logic for the third year also. For all the 3 years put together, I have incurred 8200. Out of that, till second year, I have already incurred 6068, which is already recognized in second year, till second year P&L. Remaining I have considered as expense in third year. Finally, I got the profits. Okay, so I think this would be sufficient for you for problems. Yeah. Leases, please see. So first question I'll read out. Square Private Limited has taken machinery on finance lease from SK Limited. Information is as under. Lease term 4 years. Fair value at inception of lease 20 lakhs. Lease rent 6,25,000 per annum at the end of year. Guaranteed residual value 1,25,000. Expected residual value 3,75,000. Implicit interest rate is 15%. Discounted rates for first, second, third years and fourth years are given there. Calculate value of lease liability as per AS 19 and disclose impact of this on balance sheet and P&L account at the end of year 1. Now, first of all, let's understand the methodology in which we solve. Okay. Whenever you have finance lease, you need to understand from whose standpoint you are solving the question. From whose standpoint you are solving the question. Is it standpoint of lessor or lessee. Okay. If it is from lessee's standpoint, okay, think like a lessee. What will you do? As a lessee, do you know the price at which lessor bought the asset? Think like lessee. Do you know the price at which lessor bought the asset? You don't know. Okay. So that means initial investment in asset is unknown to you. Initial investment in the asset is unknown to you. Now, at the end of year 1, 2, 3, 4, you are agreeing to give some cash flows to him. You are agreeing to give him some cash flows. What are those? Whatever he has given to you now. Okay. Those are the cash flows. Now, do you know at what rate of return the lessor operates? That also I don't know. It means నాకు లెస్సార్కి ఎంత ప్రాఫిట్లో బిజినెస్ చేస్తాడు, ఎంత పర్సంటేజ్ ఆఫ్ ప్రాఫిట్లో బిజినెస్ చేస్తాడు అన్నది నాకు తెలియదు. ఐ డు నాట్ నో at what profit margins lessor makes money. Lessor is interested to do business. That's why I will go with an assumpted rate of return for my lessor. Assumed rate of return is what we calculate. Okay, that's why we call it as expected rate of return. Or inside the standard there is a word called implicit rate of return. Implicit means I am thinking that this is the rate at which lessor is interested to do business. Okay, in such case expected rate of return, here lessee is going to do his own guesswork. It's pure guesswork. In this problem, what did he tell you percentage? It is 15%. Okay, now from lessee standpoint, what all cash flows will go to lessor? He will every year pay premium, that is whatever lease rental. At the end of 4th year, to buy out that asset, he will guarantee something. He will guarantee something. Okay, now beyond that he will not pay anything. Beyond that he will not pay anything. That means in year 4 he will also pay guaranteed residual value, some number, small number. Okay, now if I am accounting in the books of lessee, lessee will present value all these cash flows at this discount rate. Present value all these cash flows at this discount rate and initially recognize the asset in his books of accounts. The asset in his books of accounts. That is what lessee does, and he will go with his accounting. Now, if lessor sends his statement to lessee for comparison, or lessee sends his statement to lessor for comparison, these will never match. Why? Because from lessor's perspective, lessor knows actually the price at which he bought. Okay, so price is known. Price is known. Next, he also knows what all cash flows he will make. Every year lessee will pay him something. At the end of lease period, he will also get guaranteed residual value. If at all lessee does not take, he will also get unguaranteed residual value from outside. How will this come, sir? Logic is very simple. Since I gave the asset on lease to my lessee, I have to give it to him for a lesser price. The same asset, if I continue to hold with me, at the end of 4th year, if I put it in the open market for sale, people will pay me better than lessee. That's why there would be a differential number between UGRV and GRV. Okay, so he is expecting something else. Now for all these cash flows, I am lessor, I am buying it at a cost, I am fixing what the lessee has to pay me. That means I also know at what rate I would like to do business. IRR is also known. Okay. Hence, accounting in the books of lessor and lessee will never match. Will never match. That is number one. Second, when you read a problem like this, how do you know from whose perspective he is asking you to prepare? How do you know from whose perspective he is asking you to prepare? Now look at the question. He says S Square Private Limited has taken machinery on finance lease from SK Limited. That is what he has stated. Okay. Now who is lessee here? S Square. SK is the lessor. Now last line, if you see, calculate the value of lease liability. For whom will be their lease liability? Lessee only will have lease liability. Number one. Okay. And disclose the impact of this on balance sheet and P&L account at the end of year one is what he is asking. Now, please see. He says fair value at the inception of lease 20 lakhs. That means he did not tell you the cost. He told you it's a guesswork. He is expecting it to be so much. Fair value is what I assume as a lessee. Okay, I don't know the real cost, what my lessor is buying for. Next. Lease rental 6,25,000 every year. Then guaranteed residual value is given, expected residual value is given. Now, do you think I really need to consider expected residual value? Yeah. From a lessee's perspective, that expected residual value is not important. That is nothing but UGRV, unguaranteed residual value, which is not relevant from lessee's perspective. If it is lessor's books, then relevant. From lessee's books, nowhere relevant. Okay. So implicit rate, interest rate is what he has talked about, 15%. So you need to look for these terms. You need to literally look for these terms. Did he use this word called implicit rate of return? The moment he gave you implicit rate of return, that means he is asking you from lessee's perspective. If it is lessor perspective, he will directly tell you IRR, internal rate of return. Okay. Second word, what you need to see is fair value at the cost of inception of lease. Fair value, who will use? Only lessee will use. Lessor knows cost. Am I making sense? Okay. So these are words which will trigger you saying that the accounting is required from the perspective of lessee. The moment lessee's books is what you are trying to do, this expected residual value is not at all required for you. Okay. So this is what you are supposed to do. Now, so having discussed all this, let's now prepare from lessee's perspective, what would be the initial value which you would have to recognize and all. Okay. Now, he told you fair value at the inception of lease is 20 lakhs. But when you present value the future cash flows, is it coming to 20 lakhs or not is what we will have to first test. We'll have to first test. If the present value of future cash flow is greater than 20 lakhs, take only 20 lakhs. If the present value of future cash flows is less than 20 lakhs, you should take whatever is the lesser value. Otherwise, your numbers will never match. That's why. Okay. So now let us go ahead. So illustration 1. Calculation of present value of future cash flows from lessee's standpoint. Okay. Here cash flow discount factor at 15%, discounted cash flows. I have 4 years. Cash flows are 6,25,000. 6,25,000. 6,25,000. 6,25,000. 6,25,000. Fourth year, you also have a Guaranteed residual value of 1,25,000. Can you please tell me discount factors? He has already given you there. Use those numbers. 0.8696, 0.75. Yeah. Yeah. So discounted cash flows would be in the 543, 500, 472, 562, 4,10,000, 937, 375, and then 1,25,000 into 71,475. Okay. All put together, please. Eighteen lakh 55,849. This indicates that paid value is 20 lakhs, but when I present value my future cash flows, it's only 18,55,849. That means initial recognition is 20 lakhs or 18,55,849, whichever is lower. Hence take 18,55,849. Okay. Can we go to the next question? Yeah. Prakash Limited leased a machine to Badal Limited as on the following terms. Fair value of machine 48 lakhs, lease terms 5 years, lease rental per annum 8 lakhs, guaranteed residual value 1.3, expected residual value 3 lakhs, IRR 15%. Look at the language used, IRR, internal rate of return. That means from whose standpoint? Lessor. Okay. Discount rates for 1 to 5 years is given. Ascertain unearned finance income. Unearned finance income is what he is talking about. That means you should actually calculate something called as from lessor standpoint. You should now do from lessor standpoint. Now what is your investment in lease initially? Gross investment is basically, so 5 years you are going to receive 8 lakh rupees, yes or no? Right? 8 lakh rupees you are going to receive for 5 years, and then you are going to receive GRV of 1.6 lakhs. If expected residual value is 3 lakhs, it indicates that if you deduct the guaranteed residual value out of that expected residual value, remaining is unguaranteed residual value. Okay, unguaranteed is 1.4 lakh. Okay, so basically your gross investment in lease is nothing but future cash flows what you make from lessee plus GRV plus UGRV. Okay, so can we please do that? Okay, gross investment in lease is equal to future cash flows plus GRV plus UGRV. is 8 lakhs into 5 years plus 1.6 lakh plus 1.4 lakh. It's going to be 43 lakhs, yes or no? Okay, so 43 lakhs is what you have got. Now, do you know net investment in lease? Gross investment in lease minus net investment in lease tells you your unearned finance income. Okay, now how do you calculate net investment in lease? Net investment in lease is nothing but present value of future cash flows from the standpoint of lessor. Okay, so now let's do net investment in lease. Okay, so net investment in lease is going to be again year cash flows, discount factor at 15% is what he has told you, discounted cash flows. So how many years is this? You have it for 5 years. 1, 2, 3, 4, 5. Okay, so 8 lakhs every year, and then you have 3 lakhs GRV and UGRV together. Okay, so discounted numbers please do and tell me. Discount factors are already given for us. Oh yeah, for the first 5 you can do annuity factor, last again 3 lakhs you have no separately. Annuity varkochu, no problem. 0.4972. Please tell me the final number here. బయటికి వెళ్తే అలా కొట్టేస్తారండి. 28 lakh 30,920. Everybody got the same number? So if this be the case, so unearned finance income is going to be gross investment in lease minus net investment in lease, which is 43 lakhs minus 28 lakh 30,920. How much is it? 14 lakh 69,080. Thank you. Okay. Next. Look at the example given there. Suppose outputs from a machine taken on a 3-year operating lease are estimated as 10,000 units in year 1, 20,000 in year 2, 50,000 in year 3. Agreed annual lease payments is 25,000, 45,000, 50,000 respectively. Show accounting entries in the books of year 1 of the lessee. So basically he's asking you, there's a question about operating leases. There's actually a question about operating leases. I'll explain what the background is. maybe not a full-fledged question here. So there would be instances where I pay lease rent straight upfront every year, but if the utilization of the leased asset is based on units produced or units manufactured, you cannot write off the utilization, or you cannot write off the expense over 3 years based on the rent paid. Okay, instead do it based on any other scientific method is what standard suggests you to do. Here if you see, I am paying every year a rent of 25,000, 45,000 and 50,000 respectively. But if you look at the usage, I am manufacturing 10,000 units in the first year, 20,000 units in the second year and 50,000 units in the third year. So this is a point where you should equalize your lease rentals. You should equalize your lease rentals and do. That is what standard suggests you to do in case you have lease rentals, different lease rentals for the same asset based on units produced. Okay, for all the 3 years put together, what is the lease rental you are paying? It is 1,20,000. Okay, lease rental what you are paying is 1,20,000, and for 3 years, and total number of units you are manufacturing is 80,000. 80,000. So it is advisable to go for equalization of lease rentals paid. Go for equalization of lease rentals paid. That is the background of this question. Okay, so now 1,20,000 divided by 80,000. What is the rate per unit? 1.5. So 1.5 rupees is what you are supposed to consider as expense per unit. Now, if I have manufactured 10,000 units, how much should I consider this year? Yeah, 15,000 if I pay, that's sufficient. But I actually paid how much? 25,000. That means 15,000 is rental advance. Yes or no? You need to recognize it as rental advance. Second year, I manufactured 20,000 units. That means how much should I recognize? 30,000 is what I should recognize. But I paid how much? 45,000. That means in this year also another 15,000 I have paid extra rent advance. Third year, I should recognize 50,000 units into 1.5. 75,000 is what I should pay. But I recognize only 50,000. That means whatever I have paid in the first 2 years, I will recognize as expense in this current year. Okay. Now let's write accounting entries for all the 3 years. Okay. Average. So first take it as total rent paid in 3 years is 1,20,000. Total units produced in 3 years is 80,000. Rate per unit is 1.5. Okay. Year 1, I'll put it like this. I'll write for both the years first particulars. Year 1, year 2. Okay. Lease rent account debit. Lease rent advance account debit to bank. So first year I paid 25,000, of which only 15,000 is my rent. I have paid 10,000 advance. Second year I paid 45,000, of which 30,000 is rent and 15,000 is advance. Okay. So for third year, it's going to be lease rental account debit to bank to lease rent advance. I paid 50,000 in the current year. I have accumulated 25,000. All put together 75,000. Okay. This is an example on equalization of it. It's basically uh, operating lease. Okay. Next. So third question is also about operating lease, but here I'll first explain, then we will look through the solution. Okay. So operating lease, you are supposed to take the least of the cost actually incurred and fair values. Okay. So I'll explain it to you as we read. Okay. It makes sense better if it is done so. Okay. A Limited sold machinery having WDV of 40 lakhs to B Limited for 50 lakhs. And the same machinery was leased back by B Limited to by B Limited to A Limited. The lease back is operating lease. Comment if sale price is 50 lakhs, sale price of 50 lakhs is equal to fair value. Now first of all, think like a situation where today I hold an asset. I need money, but I also need the asset. What I would ask financer is, look, I have this asset. On paper, I will give it to you in writing. You give me money. Let the asset be with me only. Possession will continue with me. Okay? But I will pay you lease rental every month or every year. This is a case of sale and lease back. This is a case of sale and lease back. Now, in this transaction, he is giving you various alternatives. He is saying, today the book value is 40 lakhs. Okay? He sold it for 50 lakhs. Sold it for 50 lakhs. Now, the lease back is operating lease. Comment if sale price is 50 lakhs equal to fair value. So, right now you sold for 50 lakhs. Fair value is also 50 lakhs. In my books, I am showing it at 40 lakhs. Need not be that to be true. Fair value is 50 lakhs. Now, should I recognize any profit or loss immediately or not? I have to recognize because my books has got a asset of 40 lakhs. I sold for 50 lakhs. Hence, 10 lakh is supposed to be recognized as profit. Do you agree or not? Okay. I'll explain once again. No problem. I'm talking about a situation where the transaction is a sale and lease back transaction. What does that mean? I hold an asset. I need that asset. I also need money. Hence, in paper, I sell the asset to somebody else, and I hold the asset in possession. Okay, in possession, it is with me only. Now, when that be the case, initially when I sell, my book value of the asset is 40 lakhs. I sold it for 50 lakhs. That means I should recognize a profit of how much? 10 lakh rupees. Normal transaction. Okay. Next. Fair value is 60 lakhs. Fair value is 60 lakhs. I sold for how much? 50 lakhs. Now tell me what should be recognized. See, logic is, though the fair value is 60 lakhs, I did not find a buyer for 60 lakhs. That's why I sold it for 50 lakhs, which is a very common situation anywhere. In which case also you will recognize the same 10 lakhs. Okay. Now please see. Fair value is 45 lakhs. and sale price is 38 lakhs. Now you tell me what we should do. Fair value is 45 lakhs. I sold it for 38 lakhs. So now the fair value is 45 lakhs. Keep that aside. I sold it only for 38 lakhs. That means 2 lakh rupees is loss for me. Okay. Next case. Fair value is 40 lakhs. Sale price is 50 lakhs. Here you need to be cautious. My book value is 40 lakhs. Fair value is also 40 lakhs. But I sold it to that fellow for 50 lakhs. What does that mean? I would like to indirectly generate income. So I'm actually selling it for 50 lakhs to him. Later on, I'm going to pay out of that money only to him for the lease rentals. Yes or no? Okay. So there is some hidden agenda behind this. Fair value itself is 40 lakhs, but I sold it for 50 lakhs. That means I'm going to use that money to pay him his lease rentals every month. So how should I recognize here? You should not recognize this 10 lakh rupees profit immediately. Instead, you should postpone the recognition over the lease rentals, over the lease period. Say for example, I agree to pay him 2 lakh rupees as lease rental every year. I will not recognize 10 lakhs today itself as profit. I will recognize this as deferred income. Whenever I pay 2 lakh rupees lease rental, I will recognize 2 lakhs as income. Am I making sense? Do you want me to explain once again? Okay. So I am saying third case or fourth case? Fourth case. Fourth case lo book value 40 lakhs. Fair value koda 40 lakhs. But I sold it to him for 50 lakhs. Why did I sell it to him for 50 lakhs? Intention is I would like to knock off my lease rentals in future what I pay to him out of his money itself. That's my objective. Okay. Lease rental. That is my objective. If this be the case, you cannot recognize the 10 lakhs as income in the first year itself. Complete income as in the first year itself. You will be eligible to recognize that as income over the lease rental period. Say for example, if you are taking the asset on lease back for 5 years for payment of rent of 2 lakh rupees every year. Okay. You are going to pay rent of 2 lakh rupees for next 5 years. Over the same 5-year period, you recognize this 10 lakhs also as income in your books. Year 1, you will have lease rent paid 2 lakhs. Same time, deferred revenue now recognized 2 lakhs. Okay. So first time when you receive money, what will you write? Bank account debit 50 lakhs, to asset 40. Don't write to profit 10 lakhs. It is to deferred revenue 10 lakhs. Okay. This is what you are supposed to do in case of fourth scenario. Next. E. Fair value is 46 lakhs. Sale price is 50 lakhs. Now tell me, you are selling for 50 lakhs. Fair value is 46 lakhs. Up to 6 lakhs you can recognize immediately. But 4 lakhs you should defer. Agreed or not? So here it is going to be so this is fourth scenario. Fifth scenario, you are receiving how much? 50 lakhs is what you are receiving, but asset is only 40 lakhs. Deferred revenue is 4, P&L is 6. Okay na? Next, last case. Fair value is 35 lakhs. Okay, but you sold it for 39 lakhs. This is even more important. Now you have two transactions here. Number 1, you sold the asset for loss. 1 lakh rupees is the loss. Okay. Second, you sold something for 39 lakhs when the fair value is only 35 lakhs. That means 4 lakhs is deferred income. Okay, deferred income also should be recognized, and also this loss also should be recognized. So how will we do that? So you will book the uh, so first of all, you are selling for 39 lakhs. You are selling for 39 lakhs. Up to fair value, you should recognize as profit. Okay. So what you can do is, you can recognize 5 lakhs of profit and 4 lakhs of loss. Effective గా అదే కదా 1 lakh loss వస్తుంది కదా మీకు. Yes or no? So in this case, what you can do is, bank account debit 39 lakhs to asset, book value is 40. Okay. Now wait. To deferred revenue, it is 4 lakhs. 4 lakhs, and loss on sale 5 lakhs. Okay. So these are various scenarios in which it can happen in case of it is sale and lease back transaction. అర్థమైందా? Okay. Okay. Yeah. Okay. అదే ఒకటే ఇంటర్వ్యూ చేస్తున్నాను నేను. ఇంపాక్ట్, ఫైనల్ ఇంపాక్ట్ ఈస్ ద సేమ్. ఓకే, ఎఫెక్ట్ ఈస్ ఫైనల్ ఈస్ ది సేమ్. యూ కెన్ డూ దట్ వే ఆల్సో, దెర్ ఇస్ నో రాంగ్. ఓకే, మీరు చెప్తుంది ఏంటి? ఎంట్రీ ఎట్లా ఉంటుంది? లాస్ ఆన్ ఫేర్ వాల్యుయేషన్ 5 lakhs to asset 40. 40, bank is 35. ఓకేనా కదా? అవును. ఓకే. ఓకే, got it. So to asset 5 lakhs. 5 lakhs. Now your book value has become 35 lakhs. Now you are selling it for 39 lakhs. Okay. So it is going to be bank account debit 39 to asset 35 to P&L. ఎలా ఉందా? ఓకే, అంటే ఇంపాక్ట్ అదే ఇచ్చాను, బట్ ఓకే. ఇప్పుడు నేను చేసింది అదే, కాకపోతే ఏంటంటే నీకు ఒకటే ఎంట్రీలో ఎట్లా చేసుకోవాలని చూపిస్తున్నాను అంతే. దెర్ ఇస్ నో డిఫరెన్స్ బిట్వీన్ సైజ్ ట్రాన్స్ అండ్ వాట్ ఐఎమ్ గివింగ్ యూ. ఓకే, నెక్స్ట్. సో ఈ రెండు క్వశ్చన్లు మీకు ఈజీగా తెలుస్తాయి, చూడండి ఒకసారి. Question 1. A machine was given on 3-year operating lease by a dealer of the machine for equal annual lease rentals to yield 30% profit margin on cost of 1,50,000. Economic life of machine is 5 years, and output from the machines are estimated as 40,000, 50,000, 60,000, 80,000, 70,000 units consecutively for 5 years. Straight line depreciation is in proportion of output is considered appropriate. Compute the following: annual lease rental, lease rent income to be recognized in each operating year, depreciation for 3 years lease. Now what is he saying? it will yield 30% profit on cost of 1,50,000 అంటున్నాడు. Okay, first of all, how many units can it manufacture? All put together, please see. Yeah. Anna? 2,30,000. So 2,30,000 units is what it can manufacture. So if 2,30,000 is supposed to be manufactured, out of that per year ఎంత వస్తుందో 3 lakhs. Okay, 3 lakhs is what it can manufacture. That means ఒక్కొక్క యూనిట్ కి 50 paise. 1.5 lakhs is what my cost is, yes or no? Right? So if 1.5 lakhs is my cost, it is supposed to be taken per unit 50 paise. So first 40,000 units కి ఎంత తీసుకోవాలి అట్లా క్యాలిక్యులేట్ చేసుకోవడం దాన్ని. Okay, so can you please do that and tell me? Yeah, what would be the lease rental? Total lease rent ఎంత? Output is how much? Enana? So he is asking for annual lease rentals to yield 30% profit margin on cost. Okay. So over 5 years, the total unit output is how much? Total output is 3 lakhs. 3 lakhs. In the first 3 years, how much is the output? 1.5 lakhs. Yes or no? 1.5 lakhs is what you need to generate. Okay. So 1.5 lakh divided by 3 lakhs, it is 50%. Okay. And he says profit margin required is 30% అంటున్నాడు. అంటే if cost is 100 rupees, I want 130%. Yes or no? 30% profit margin on cost of 1.5 lakhs is what he's saying. Okay. So let's do it here. Total units produced in 5 years is 3 lakhs. Total units produced in 3 years is 1.5 lakh. Okay. Cost of machine 1.5 lakh. Okay. Markup required 30%. Okay. It is basically 1.5 lakh into 130% is what I should generate. Okay. 1.5 lakh into 130% is what I should generate into 1.5 lakh divided by 3 lakh. How much is it going to be? Okay, so it is going to be 97,500. This is rent for 3 years. See, if I buy the machine, it should give me 30% markup. 30% should be the profit for me. That's why I have taken into 130%. Today, I am going to give it out on lease for 3 years out of 5 years. In 3 years, how many units will I produce? 1.5 lakh units I will produce out of 3 lakh units. Okay. So that means I need to generate 97,500 as rent in 3 years time. Per annum, how much is it? 11 lakh? Hey, 97,500 divided by 3. 30? 32,500. Okay. Now, as a lessor, I will charge 32,500. Okay. But let's see what will he do. He will do like the previous problem what we did. He will equalize. I will charge 32,500, but he will charge in his books only based on units produced. Clear? So that also let us do. So from lessee perspective, number of units, year, number of units. Okay, 1, 2, 3. It is 40,000, 50,000, 60,000. Total units is 1.5 lakhs. Okay, 1.5 lakh divided by 97,500. It gives you how much? 1.53. Okay, 1.53 per unit. Per unit. Now, rent recognized each year is going to be year 1, 40,000 into 1.53. Second year, 50,000 into 1.53. Third year, 60,000 into 1.53. Okay. Yeah. Now, please tell me this 3 questions. Yeah. Classify the following into operating and finance leases. Lease has option to purchase the asset at lower than fair value at the end of lease term. Now tell me. Lessee has an option to purchase the asset at lower than fair value at the end of lease term. This is basically how a finance lease works. He will be given an option to buy at a lesser price. Okay, so it is basically finance lease. Next, economic life of the asset is 7 years. Lease term is 6 years, but asset is not acquired at the end of the lease term. It is operating. Okay. Next, economic life of the asset is 6 years. Lease term is 2 years, but the asset is of special nature and has been procured only for the use of lessee. So the moment it is procured specifically for a purpose, it is finance lease. Other questions you can go through. Easy only. Part of what we have done till now. Similar to what we have done. Okay. We'll take a break now. Comments back at 1:30 vachestara? Yes. So let's do the last topic for the batch for the day. AS3. Material I have sent across. If you haven't got, ask from your friends, you'll get it. Now, so there are two questions which I have specifically identified. Time permits, we will solve both. The time does not permit, at least one we will definitely. Okay. Another one, I've already shared the solution also in Excel. Okay. Now, AS3 talks about cash flow statement where the intention is to give a real cash picture of an entity. If you look at your P&L and balance sheet of a company, this is prepared using accrual system of accounting, or we also call it as mercantile system of accounting, where even though you don't really generate cash on hand, it might show profitable, it might show to be profitable, but in reality cash might not be collected, or cash could be extra collected also at times. Okay. But when a user of financial statement uses this information, his intention would be to understand to what extent is cash being generated by the entity, is what they look at. For that reason, there is a separate structure which is given by ICI, which suggests you on how a cash flow statement has to be prepared. Now, what does a cash flow statement mean? Basically, there are many analytical tools for financial reporting. Say, for example, ratio analysis. You talk about what is the current ratio, what is your EBITDA levels, what is your PAT levels, what is EBIT levels. Like this, there are multiple types of ratios what we prepare. They will give insights on how operatingly you are efficient. But is there something which can tell me my efficiency from cash collection or cash spend perspective? No. For that sake, a separate tool called cash flow statement is required to be prepared. Now, what does a cash flow statement mean? It is, technically speaking, complete analysis of your cash book. When I say cash book, it is not just cash in hand, also cash at bank, both put together. Now, what all transactions do generally exist in a cash book? The cash book, if you see, there would be various types of transactions. To start with, there would be something called as opening balance. And then there would be closing balance. Apart from this, you would have various operating receipts. Say you have made a cash sale, you get that. Or you collected monies from debtors, you get that. Or you have got some interest income, you get that. You have made some sale of investment, you get that. You have made some sale of asset, you get that here. Okay, like this. If at all there is any other income which you have made, say for example dividend is received by you, you get that. Okay, or if at all you have made any loan taken, okay, loan taken will give you cash inflow, or you have raised equity shares, you get money, or you have raised preference shares, you get money. You gave rights issue, you get money. Okay, like this there are various types of transactions which will give you cash inside the company, which will generate cash inflow. Same way outflows also, if you see, you would pay out to your vendors, or you would have some cash expenses for which you pay, or there could be some interest expenses. Okay, otherwise there are some operating expenses which you incur. Okay, or there would be some repayment of loan. Okay, repay loan, or you may buy some assets, or you may buy back your securities, equity shares, or you may have redemption of preference shares, debentures and all. Like this you have varieties of transactions in your cash book. I'm gonna try to understand what's generating me cash by my business, and also I would also look at how my investments are happening. That is, what are the sources of funds from which I am actually able to prepare this, do this business, and also how am I investing this. Hence, technically speaking, you are going to do it in three parts. First is called as cash flow from operating activities. Second is called as cash flow from investing activities, and third is called as cash flow from financing activities. Okay, that is how you end up in these three methods of parts of your cash flow statement. Now if you look through here, you can identify what is part of your operating activities. Say for example, you make payments to debtors. That means debtor has come into your books only because you sold to him. Okay, same way sales you have made is basically operations. Interest income is not operating. Sale of sale of investment is not operating. Sale of asset, not operating. Other incomes, not operating. Loans taken, not operating. Equity shares issued, not operating. Preference shares issued, not operating. Rights issue, not operating. Now from your payments perspective, you see vendor payments is operating. Cash expenses incurred, operating. Okay, operation expenses incurred, operating. Others again are not operating expenses. Okay, same way from investments perspective, investing activities perspective, what does that mean? Where did I put in money? Or if I have already put in money, did I sell it out? Or is there anything I generate out of the investments made? These are the various angles which I will have to look through. Now if I have interest income, it is caused only because I invested somewhere, yes or no? That means interest income can be considered as investing activity item. Same way, if I sell investment, it indicates I invested in a particular transaction, now I am exiting. That is also part of my investing activity. We need to see both inflows and outflows for a specific target audience. Okay, so next, sale of asset is also investing activity. Okay, now other income, say I generated dividend, which is another income for me. So can I call it as investing activity or not? Of course yes. Okay, so same way from your payments perspective, you bought some assets, can be considered as a investing activity. Okay, or you bought some plant and machinery, investing activity. You invested in debentures, equity shares, everything is investing activities. Okay, then you have the third category, which talks about your financing activities, where rest all items would form part of your financing activities. Loan taken is a financing activity, equity shares issued is financing, preference shares is financing, rights issue is financing, redemption of debentures, buyback, repayment of loan, interest expense, all these are part of your financing activities. Now, literally, you are only trying to populate each segment data in 3 specific places out of your cash book. Now, by doing that, what we are going to arrive at is, we will be able to reconcile the opening and closing balances of our cash book. Okay, so by doing these activities, your intention is to reconcile the cash book and also tell that from where cash is being generated in each of these activities. Okay, now having said this, how do I prepare a cash flow statement? Cash flow statement, as I told you, there are 3 parts, of which first one is cash flow from operating activities. This can be done in 2 ways. One is called as direct method. Second is called as indirect method. This can be done in 2 ways. One is called as direct method. Second is indirect method. Now, what does direct method mean? Direct method is a method in which you would approach it from the information available. You would not approach it from the P&L. You would approach it from the information available. What kind of information would be available? The structure goes like this for direct method. The structure goes like this for direct method. You would start from cash sales given. You would start from cash sales. That means all cash transactions which form part of operations, you take here. Cash sales given, and then any collections from debtors. Okay, then cash expenses would be deducted, and payments to creditors would be deducted. Okay, by doing this, what we end up at is, we know what is my cash generated from my operations before extraordinary items. Okay, so at this juncture, I generate something called as cash from operating activities before extraordinary items. To this, I add or deduct extraordinary items. Now, what does an extraordinary item mean? Extraordinary item can either be a cash inflow or an outflow. Say, for example, you incurred fire in the factory, because of which you have to spend say 30 lakh rupees. That is a cash outflow. If that alone is your cash outflow, in which case it will be a negative item. Say, for example, an insurance company has underwritten that risk for you, and now you got 50 lakhs of claim against that 30 lakhs of spending. Now you have got 20 lakhs of inflow, extra 20 lakhs of inflow. Yes or no? 50 lakhs is what you received, 30 lakhs spent for your this extraordinary item, and then you are left with 20 lakhs of cash on hand. Okay, so the 20 lakhs you consider it as inflow, right? So this is how you are supposed to check for your extraordinary items in your books. So once we are done with it, what you land up at is cash flow from operating activities before tax, and from this, if you deduct taxes paid, very important, taxes paid, when you deduct tax paid, you end up in something called as cash flow from operating activities. Okay. Now, the same thing under indirect method is different. It is not always practically possible to have all the information handy just like how we did. For that reason, what standard suggests is, in case you would like to, now by doing this direct method, if you see, is there any linkage to your P&L balance sheet? No link. I would like to connect my cash flow statement along with my P&L balance sheet. I would like to connect my cash flow statement along with my P&L balance sheet, for which I cannot adopt this direct method. Why? Because it purely considers the cash transactions, but my P&L contains non-cash transactions also. It also contains some accrual system of accounting. All should be considered by me while preparing my cash flow statement as well, in which case standard advises you to do under indirect method. Under indirect method. Now, under indirect method, you are actually now trying to find out cash flow from operations. In your P&L balance sheet, what talks about your operations? Only P&L. P&L is what talks about your operations. Apart from P&L, your current assets and current liabilities also talk about your operations. Why? Because these are some working capital required for you for your operations to happen. Okay. For that reason, in indirect method, all places that you look for are only three places. One is P&L, second is in balance sheet current assets, third is in balance sheet current liabilities. These three places are where you will be picking information for preparation of your indirect method cash flow statement. Now, with respect to operating activities, how do I start with? The starting point is profit before tax is your starting point. Now, though I tell profit before tax as the starting point, you get a feeling like profit after tax is what's there in my P&L. Why can't I start from there? Of course, you should start from there only if you have profit after tax. If you are starting from profit after tax, you should first reach out till profit before tax. How do you do that? Add back the provision for tax, which will give you profit before tax. So profit before tax is generally your starting point. Now, in this profit, there are some expenses which are non-cash. What kind of expenses do we see which are non-cash? Number one, depreciation, or number two, amortization. Okay. So these two items are not really spent by me in cash, but I am considering it as an expense in my P&L. Now, I want cash profits. I want cash generated from operations. For which sake, what should I do to these non-cash items? These are expenses which you have booked. Now, these are reducing your profits, yes or no? So, should I add them back or deduct? Should I add them back or deduct? Think logically and tell. Add. Why? Because this has right now reduced my profits. I need to arrive at my cash profits. Okay. Hence, you would add them. Okay. Then, there are items which do not belong to me, belong to operations but considered here already. Say for example, there is interest expense incurred. Interest expense. If you are paying interest, that means it is part of financing activities. You borrowed money somewhere, hence you have paid interest. That means it should not form part of your operations, no? Now, if this interest expense has reduced your profit today, you now want your pure operating cash profits. So should you add that back or deduct? Add. Okay. Think logically and tell. Think logically and tell. Next, there are some interest incomes. Interest incomes which you have seen in your P&L. Okay. Now, interest income you get only because you have invested in some securities. Now, your profit in your P&L is more because you already received that interest income. Now you don't want that interest income to be part of your operations. So what should you do? Add or deduct? Deduct. Okay. Think logically and tell me each item. Next. I have a sale of asset. I have a sale of asset because of which I got some profit. My book value of an asset is 10,000 rupees. I sold for 12,000 rupees. 2,000 rupees is parked as profit in my P&L. Now, is that part of your operations? No. So, should it be part of your operating profits? No. That means what should you now do? Deduct. That means profit on sale of asset is to be deducted. Same way if it is loss. Loss on sale of asset, it is to be added. Okay. So by doing all these transactions, where do you end up? Where do you end up? Now, please wait. So here, till now I have done only from my P&L's perspective. From P&L I picked all information, that's all. I did not do anything else. But problem is, when I say operations, I should also consider my working capital changes. That means the profit what I arrive at here is what I call as cash flow from operating activities before working capital changes. Do you agree or not? Okay. So this is what we call as cash flow from operating activities before working capital changes. Okay. Now, from this working capital changes profit, I need to understand what working capital changes are. Now, tell me what type of current assets could be there. Current assets could be inventory, debtors, inventory stock है क्या? Debtors and trade receivables है. Bills receivable, cash and cash equivalents, okay, or prepaid expenses. Okay, these are predominantly what you see in your current assets. Current assets. Now, you are right now talking about reconciliation of cash and cash equivalents. Hence, don't bother about cash and cash equivalents in analyzing working capital changes. Remaining, if you take from your current assets, it's sufficient. Okay. Now, tell me, I have inventories in the current year 50,000. Last year, I have inventory of 60,000. What does that convey? Is there any decrease in the current asset or increase in current asset? Decrease in current asset. If inventory got reduced, what does that indicate? It got sold or not? It got sold. So if sale happens, will it generate me cash or will it not generate me cash? it will generate me cash. That means if there is a fall in value of a current asset, there is cash which is coming inside. Okay, same logic. Debtors I have. Current year I have 1,50,000. Last year I had only 1,20,000. Now tell me, from last year if you compare current my debtors, this year it got increased. That means my money is getting blocked in somebody's hands. Which means I don't have that cash inflow here. If it is getting blocked outside, it is cash outflow. Okay. So if it is increasing, if the current asset is increasing from compared to last year, it is cash outflow. Okay. So this is inflow, this is outflow. Now bills receivable also. I have last year 1,50,000. This year 1 lakh. What does this mean? I have collected, I have realized that money from them. Yes or no? So that means it is inflow. Same way, prepaid expenses. Last year I had 50,000. This year I have 70,000. Now what does this mean? I have paid more money this month, this year, for the sake of future. That means there is outflow. Okay. So what you need to understand is, with respect to current assets, if it increases from last year, from previous year, it is going to be a cash outflow. If it has decreased from previous year, it is cash inflow. Okay, this is the rule for your current assets perspective. Okay, now let's understand current liabilities. Exactly reverse. First of all, what all will form part of current liabilities? Current liabilities. You will have other current liabilities. You will have trade payables, bills payables, outstanding expenses. Then you will have provisions. All these would be there. Okay. Now, in all of this, if you see, again, from previous year to current year, if you compare. Okay. So I have other current liabilities. Current year it is 10,000. Previous year 30,000. What does that mean? I gave out the cash. I settled the dues. That means my cash has gone outside. Yes or no? I reduced liability means I paid them. Yes or no? So it is cash outflow. Same way, trade payables. I have 50,000 in the current year. Last year I had only 20,000. What does this mean? I am holding cash in my hands without giving to the creditor. That means if I am holding cash in my hand, it indicates cash inflow only, no? Without paying, if I hold, it is inflow. Okay. So inflow. Next, bills payable. Last year I have 50,000. This year 20,000. What does that mean? I paid. Outflow. Okay. Outstanding expenses. Last year 50,000. This year 70,000. What happened? I did not pay money to outsiders, to these parties. It is inflow. Okay. So provisions. I created last year for 30,000. This year it is 80,000. Now what would I do? That means I know I have an expense, but I have not paid it. That means I have held it. Yes or no? Inflow. Okay. Now from this, what can you understand with respect to current liabilities? If there is increase from previous year, what does that mean? If there is increase from previous year, it indicates there is inflow. There is cash inflow. If it reduces from previous year, it is cash outflow. Am I making sense? Okay. Now, considering these two rules, you should prepare your working capital changes here. Okay. You should prepare your working capital changes. So, working capital changes would be, you would take all the items given there and take whether it is plus or minus, and end up at something called as, here it is cash flow from operating activities before extraordinary items. Hereafter, there is no difference between direct method and indirect method. Am I making sense? Once this is done, once this is done, now you will go ahead for same steps. Plus or minus extraordinary items. Okay. Plus or minus extraordinary items. Then you will have something called as cash flow before taxes. From that, less tax paid. You will arrive at cash flow from operating activities, outer column. Okay. Now, second part is number 2, cash flow from investing activities. Cash flow from investing activities. What all will you consider under investing activities? Number 1, purchase of assets for cash. Number 2, sale of assets for cash. If you purchase, will there be cash inflow or outflow? Outflow within brackets. Okay. Number 3. Now, please note, I am not bothered about the profit or loss in cash flow statement. In operating activities also, I just reversed the profit or loss. That's all. Okay. In cash flow from investing activities, I am not going to recognize profit or loss. I'll just tell how much is cash collected or how much is cash spent. That's all. Okay. Next, there could be interest income received. Very, very important. Not earned. Not earned. It is received. Okay. Next, dividend income received. Okay, not earned. That means I am ignoring accrual concept. I am ignoring mercantile system. I am only considering cash collected. Okay. So on taking all these aspects, you end up something called as cash flow from investing activities. Very, very simple. Third part is cash flow from financing activities. What kind of transactions would be there here? You issue equity shares for cash. Equity shares, or issue preference shares, issue debentures. All of this, please note, very, very important, for cash only. If there is any issue of shares for consideration other than cash, you cannot take it here. That's why for cash I have highlighted. Okay. Or there could be redemption of debentures for cash or preference shares for cash, buyback of equity shares, buyback of equity shares, okay, or there could be interest expense paid in cash, not expense incurred, paid in cash. Everything is in cash only here. Okay. Or I may pay dividend. I may pay dividend. Or I may repay loan. Take loan. All these transactions, all of these transactions are your part of your cash flow from investing, financing activities. Okay. So finally, what you end up at is called as cash flow from financing activities. You get this value. Okay. So net of is what we call as net cash flow of the three heads together is what you get as net cash flow. This net cash flow can be positive or negative. Can be either positive or negative. Now, with this, the problem does not end. Any day, your cash flow statement is complete only after reconciliation. That means to this net cash flow, if you add opening cash and cash equivalents, you add opening cash and cash equivalents, you should arrive at closing cash and cash equivalents. Should arrive at closing cash and cash equivalents. Only then your problem is said to be complete. Okay. Now, let's try to understand what these cash flow from operating activities, investing activities, and financing activities actually mean. What that numbers generally convey. Now, from a business perspective, if your cash flow from operating activities is positive, that indicates your business is able to generate cash for its expenses. Now, is that a good sign or a bad sign? That's a good sign. That's what it indicates. Now, if it is negative, it indicates that the other two sources are actually fueling your operations. Which is absolutely not a good sign. That is one important caution or red sign in case if it is negative. Okay. But sad to say, in startup community today, in this startup world, only if your cash flow from operations is negative, if you are burning cash, you are a growing company. You are a growing company. So that's a different perspective what's there in the market today. Now, coming to investing activities, what gives you a good sign? Is it cash inflow or outflow? Inflow is also a good sign. Huh? Now, it depends on situation. It depends on kind of transactions you enter. Say, for example, you are selling all your assets. Not at all a good sign. You are selling all your assets. Not at all a good sign. You are trying to add more capacity to your assets. Good sign. So that means from each and every item you will have to look through and then decide. Okay. Every item is what you are supposed to look through and then decide. So Capacity increase, you are spending money, that's a good sign. You are selling away your assets, not a good sign. You are able to generate interest incomes on investments made, very good sign. You sold your equity shares, not a good sign. So these are kind of things which you need to see whenever you're looking from a investment activities perspective. Then financing activities. Now you have taken bank loans. You need to observe whether that bank loan is useful or not. How are you going to repay that monies? So you need to look at your repaying capacity, whether your operations are able to source that monies or not, is what we look at. Okay, same way, at times we will have something called as issue of equity shares, preference shares and all. If you are raising money, are you using it for good or not? Are you using it for good or not? That tells you whether it is a good sign or not. Again, if it is redemption of debentures, redemption of preference shares, buyback of equity shares, it by default indicates a very good sign. By default gives a very good sign. Your loan settlements is a good sign. Interest payments is a good sign. So you need to look at each aspect and then define whether the company's transactions are good for the entity or not. Is that clear? So this is with respect to your cash flow from financing activities. Now, having said about this, let's now look through the questions which are given there for you. Yeah. So extraordinary item annadi entante, I am saying there is something which is see, this extraordinary item concept is there only in AS cash flow statement. In days lo ledhu asalu first thing. Okay, ఎందుకంటే నేను మొన్న చెప్పుకున్నట్టున్నాం ఫస్ట్ డే ఈవినింగ్ I was mentioning about there is no concept of extraordinary in days. Okay, so what does extraordinary mean is, apart from my regular operating cash flows or expenses, there came up a huge impactful expense for me. There is a fire in the factory. ఆ ఫైర్ వల్ల నాకు 30 lakhs ఖర్చు అయింది. నాకు ఆ 30 lakhsకి అగేన్స్ ఇన్సూరెన్స్ కంపెనీ ఏం డబ్బులు ఇవ్వలేదు అనుకో, 30 lakhs ఇట్ సెల్ఫ్ ఈస్ మై cash expense, cash outflow. Okay, that forms as a negative item in my cash flow from operating activities. అలా కాకుండా 30 lakhs నాకు ఇన్కర్ అయింది, కానీ ఇన్సూరెన్స్ కంపెనీ వాళ్ళు 50 lakhs ఇచ్చారు. అప్పుడు ఇంకా 20 lakhs ఎక్స్ట్రా వచ్చినట్టేగా నాకు. Is that part of my operations? Actually not, but I should show it somewhere. Where will I show? I'll show it in operating activities. Okay, so that's how you look at it. Yeah, so few important items given here. So in case if you see in the screen, interest received based on the industry in which you operate, the place where you take changes. If you are a financing company, if you have received interest, that will be considered as operating activity. But in any other case, it will be considered as investing activity. Interest paid for a financing company, it is operating activities. For others, it is financing activity. Dividend received for an investing company, it is operating activity. In case of others, it is investing activity. Dividend paid, it is operating activity. Oh no, here it is also financing only. Dividend is paid only to equity shareholders. No, please correct it if you can. Okay, financing activity. Here also it is financing activity only. Okay, so this is how you look at in case you have various varieties of transactions and a variety of industries in which you are supposed to operate. Okay, now yeah, classify the following as operating, investing and financing activities and cash equivalents. Okay, purchase of machinery, what is it? Material. Purchase of machinery, what? Operating. Investing activity. Proceeds from issue of equity shares. Financing. Hello. You issued equity shares, you got money. Financing activity. Cash sales. Operating. Long-term borrowings. Financing, Babu. Investing and ochinde. Proceeds from long-term borrowings. You got money by borrowing money from outside. Financing activity. Then checks collected from trade receivables. Operating. Cash received from trade receivables. Operating. Trading commission received. Operating. Purchase of investment. Investing activity. Redemption of preference shares. Financing activity. Cash purchases. Operating. Proceeds from sale of investment. Investing activity. Purchase of goodwill. Investing only. Cash paid to supplier. Operating. Interim dividend paid on equity shares. Financing. Wages and salaries paid. Operating. Proceeds from sale of patents. Investing. Very good. Interest received on debentures held as investment. Investing. Interest paid on long-term borrowings. Financing. Office and administrative expenses. Operating. Manufacturing overheads. Operating. Dividend received on shares invested. Investing activity. Rent received on property held as investment. Property held as investment. Property held as investment. What? Investing activity. Investing activity. Why? Because it is that is not your business. Rent received on property held as investment. Hence, investing activity only. Say for example, my business itself is to take properties on rent and hire it as room rentals. Operating. Okay. Rent paid is also operating. Rent received is also operating. Okay. Next, selling and distribution expenses. Income tax paid. Dividend paid on preference shares. Financing. Investing ఎక్కడి వస్తుందో అర్థం కాదు మీకు. Underwriting commission paid. Please note that's a pure finance cost. Okay. Finance. Rent paid. Operating. Brokerage paid on purchase of investment. Investing activity. Bank OD. Finance. Cash credit. Hang on. Bank OD, cash credit, short-term deposits, highly liquid marketable securities. All these are considered as cash and cash equivalents. Why? Because see, at least bank OD you can call it as a liability. Okay, but to be very frank, if you don't use bank OD, it's just that you have an account, you have a facility with the banker, you haven't used it, right? So cash credit is also of same kind. Cash credit is also of same kind, and short-term deposits are also of same kind, highly liquid marketable securities without any risk in value. All these can be considered as cash and cash equivalents. Now, when can I consider item to be cash equivalent? Standard says if it is convertible into cash in less than 3 months time, then you consider it as cash equivalent. In less than 3 months time, you consider it as cash equivalent. In all of these cases, it is convertible into cash in less than 3 months only. That's why you're going to consider it as cash and cash equivalents. Now, refund of income tax received. What? It is also operating on. Okay. Next. X Limited purchased debentures of 10 lakhs of Y Limited which are redeemable within 3 months. How will you show this item as per AS3 while preparing cash flow statement for the year ended 31st March 21? Now, he is saying it is investment in debentures. Should I call it as cash equivalent or not is the question. Yes or no? So you can consider that, subject to it should not have any change in value. So today if you invest, say if you would like to withdraw within 3 months also, if he says out of 10 lakhs you will get only 9.5 lakhs, that is not acceptable. Okay, so you need to see how the investment is going to be placed. If it is going to be 10 lakhs completely which you receive, then you can consider it as cash and cash equivalent. Okay, next. Classify the following activities as per AS3 cash flow statement. Interest paid by financial enterprise, operating activity. Tax deducted at source on interest received from subsidiary company. Please note, first of all, tax deducted at source on interest received from subsidiary company. Hang on. I'll tax paknete modra. Tax paknete. You received interest from your subsidiary. What does that mean? Investing activity or not? Investing activity. Now, instead of you paying tax, your subsidiary paid tax on your name. That's all. Okay. So the TDS is actually your income. It's indirectly like I received money, I paid tax. Now what happening is he has to pay me 90 rupees of 100 rupees of dividend, of which 90 he paid to me, 10 rupees he paid there. That means indirectly I received, no. నా చేతిలో వచ్చి నేను ట్యాక్స్ కడితే ఆపరేటింగ్ అంటున్నాను, ట్యాక్స్ పెయిడ్ ఇస్ ఆపరేటింగ్ క్యాష్ ఫ్లో అంటున్నాను. నా చేతికి రాకుండా డైరెక్ట్గా వాడే కడుతున్నాడు, అప్పుడు కూడా ఆపరేటింగే కదా అది. ట్యాక్స్ పెయిడ్ వరకు ఆపరేటింగే. నా ఇన్కమ్ ఎంత, నా నా ఇన్వెస్ట్మెంట్ మీద ఇన్కమ్ ఎంత, 100. ఎస్ ఆర్ నో? సో ట్యాక్స్ డిడక్టెడ్ ఎట్ సోర్స్ is going to be operating only. Okay, deposit with bank for a 2-year term, more than 3 months, that means it is investing activity. Okay, insurance claim received towards loss of machinery by fire. Yeah, what kind? Extraordinary. Okay, bad debts written off. First of all, indulo cash flow emundi, anta poyindi kada already. Okay, so it will not form part of your operating activities. I mean, like it will come as part of your operating activities, but not a cash item. Okay, so now we will solve a problem. Ementa time on. Telestunda? So look at these questions. From the following balance sheets of Nandita Limited and the additional information given, make out a statement of cash flows. Capital and liabilities 2016-17 data given. Equity share capital already shared. Vachinda andarkani? Equity share capital 8% redemption, redeemable preference shares, general reserve, P&L, proposed dividend, trade creditors, bills payable, provision for tax, total assets, goodwill, land and building, plant, trade receivables, stock, bills receivable, cash in hand, cash at bank, total. Additional info: depreciation during 2017, plant 10,000, land and building 20,000. An interim dividend of 20,000 has been paid during 2017. Income tax paid during the year 35,000. That's all. Very simple question this is. Okay, మరి డెప్త్ ఎక్కువ వద్దులే అని చెప్పని భయపడుతున్నారు పిల్లలు అని చెప్పని. కావాలంటే ఇంకా ఇస్తాం మీకు, మీరు ప్రాక్టీస్ చేసుకోండి. విత్ సొల్యూషన్స్ ఐ కెన్ గివ్ యూ. అవసరం పడదు మీకు అంత అక్కడ సిఎంఏలో. Okay, I don't mind. I'll share you the material if you want. You can solve. Now, tell me what's the starting point for this now? Yeah? What is the starting point for this? I need to start with profit before tax. Okay. But did he tell you what is profit before tax? Did he give you P&L? No. In which case, you need to analyze your reserves to understand what is the profit after tax. So first step is analyzing your P&L, analyzing your reserves. Now look at your reserves. In your reserves, you have P&L, you have P&L, you have general reserve also. Okay. So that means look at what has happened there. P&L has become from 30,000 to 48,000. Why will it become from 30,000 to 48,000? Only if I make profits in the current year. Next, general reserve also from 40,000 to 70,000 it has become. Only if I transfer in the current year from P&L to general reserve it will happen. Otherwise, it will not happen also. Okay, that means from both of these you need to understand that your profit for the current period is difference between these two. Do you agree or not? Your profit after tax is difference between these two. Okay, so it's going to be 18,000 plus 30,000. 48,000 is your profit before tax, profit after tax. Okay, antena kada? So your starting point is going to be 48,000. Okay, now that is your profit after tax. Do you know what is provision for tax in the current year? Yes, sir. Did he tell you? He told you saying that tax paid is 35,000. He did not tell provision for tax. That means if you prepare a provision for tax account, you get to know what is the uh, provision which is created during the financial year. Okay. So let's start with the solution. Okay. So problem number 2. Number 1, calculation of profit after tax. Okay. Closing P&L given 48,000 less opening P&L given 30,000. Net off is 18,000. Okay. Then closing general reserve given, it is 70,000 less opening general reserve given 40,000. It is 30,000. Current year profit after tax is 48,000. Correct? Okay. Next, number 2, calculation of provision for tax. Calculation of provision for tax. Okay. Now prepare a provision for tax account that will make your life easy. Okay. By balance brought down, how much is provision for tax opening balance given there? Please see, it is 40,000. Okay. Closing is given there as to balance carried down 30,000. and he also told you current year tax paid to bank, it is 35,000. This will give you a balancing figure of provision, 85,000 by P&L. How much is it? 45,000. Okay. Is it done with this to arrive at profit before tax? Yeah. There's something else also to be done. Look at the dividends. Look at dividend. Now, generally, dividends are paid after tax only, no? Okay. Now, proposed dividend, he says, opening is 42,000, 50,000 is closing. In between, he told you current year dividend paid, interim dividend paid is 20,000. Again, same logic. If you prepare proposed dividend account, provision for dividend account, you get what is current year transferred from P&L, yes or no? So let's do that. Number 3, calculation of provision for dividend in current year. Again, open. Provision for dividend account. Okay. By balance brought down. How much it is? 42,000. Closing balance is 50,000. And to bank, current year paid is 20,000. So you have 70,000 on the debit side. By P&L is going to be 28, 28,000. Okay. If you do like this, it is utter flop. Intentionally done. Damage. అవునా చెప్తారని చూశాను నేను. ఏమ్మా? Tell me one thing. He told you saying that it is interim dividend. ఓకే. ఇప్పుడు నాకు బ్యాలెన్స్ షీట్లో if there is opening 42,000 of dividend payable, that means what it is? Final dividend of last year. Final dividend, nobody will hold it in hand. Everybody would have collected monies and went. Yes or no? I should make payment for that also. Okay. So what is the mistake? What you have done here is you have taken 20,000 cash, correct? I don't deny that, but you should pay the opening liability of 42,000. Dividends once proposed should be paid. No, you cannot hold it in your account. Okay. So to bank, final dividend 42,000. Intentionally done, guys. Okay. Now please tell me, total is on the debit side. Total 50. 1,12,000 by P&L it is 70,000. Okay. Now that you got all your information, can you arrive at profit before tax? Now we can start with profit before tax. Okay. So now let's start with your cash flow statement of so and so for the year so and so. Take particulars and two amount columns, inner amount column and outer amount column. Okay. In that, number one, cash flow from operating activities. Okay. Start with profit after tax. Working note 1 you've done here. It is 48,000, inner amount column. Then add provision for tax, add provision for dividend. Tax it is 45,000, dividend it is 70,000. What you get now is profit before tax 1,63,000. Okay. Now to this, what are you supposed to do? You are supposed to add depreciation, any amortizations and all. Now depreciations, he told you directly in the note below, 10,000 and 20,000, 30,000, yes or no? Okay. Apart from that, he also told you there is goodwill of 1,15,000 in the previous year. Now it has become 90,000. That means you have amortized 25,000, yes or no? Okay. So that also you should take. So depreciation, it is given. It is 30,000. Add back. Okay. And then add amortization of goodwill. You calculated it is 1,15,000 minus 19,000. It's not given. It's not given. You calculated. Please show. Okay. Now, apart from this, is there anything else we need to do? You don't have any interest incomes and all, or interest expenses. You don't have anything, yes or no? Now, look at redeemable preference shares. You have 8% redeemable preference shares, yes or no? Now, should I consider interest outflow for that? Not required. So 8% are redeemable preference shares. Opening is 1.5 lakh, closing is 1 lakh. Okay. Now interest expense, I would have paid, no? Yes or no? I would have paid interest expense. Did he talk anything about it? He did not talk. Actually, I should take. I would have paid interest, yes or no? So you can assume that the preference shares have been redeemed at the end of the year. If no information is given, you can assume that preference shares are redeemed at the end of the year. Okay, if that is the case, I would have paid interest for the one full year, no, on 1.5 lakh. Now, if there is any interest expense in operating activity, what should I do? I should add back. Okay, so write down, add 8% preference dividend on 1.5 lakh. How much is it? 12,000. 12,000. That's it. And there are no interest incomes and all. Okay, no interest incomes and all. Now we can go ahead for your working capital changes. Now tell me, what all working capital changes should I take? Creditors I should take, bills payables I should take, provision for tax should I take? Not required, because I will anyways do it separately in the operating activities below. Okay, then you also have trade debtors, stock, bills receivable. Total 5 items to be done. Okay, so let's do. Now tell me, with respect to trade creditors, last year it was 20,000. This year it has become 16,000. Correct? Trade creditors is oh, 5583. Okay, trade creditors, it was 55,000. It has become 83,000. It increased. That means cash inflow or outflow? Inflow. Next, bills payables, 20 has become 16,000. Outflow. Okay. Next, trade debtors, 1 lakh 60 to 2 lakhs. Outflow. Stock, 77,000 to 1 lakh 9,000. Outflow. Bills receivable, 20,000 to 30,000. Outflow. Okay, so let's do it. So at this juncture, first draw a balance. Cash flow before working capital changes. It is how much? 2 lakhs. 2 lakh 30,000 it seems. Okay, 2 lakh 30,000. Now working capital changes. Start with trade payables, bills payables. Trade payables, what happened? It is cash inflow kada, 28,000. Bills payable, is 4,000 outflow. Same way, trade receivables, bills receivables, and what else do you have? Stock. Yeah, trade receivables, what is it? Everything is negative now, right? Trade receivables is 40,000 negative. Bills receivable is 10,000 negative. And stock is how much? 32,000 negative. One lakh net of 1,72,000 is your cash flow before extraordinary items and taxes. Okay, I don't see any extraordinary items in this problem, so ignore that. Directly deduct taxes. Taxes paid, you already know, you prepared a working note for that. Payment is only 35,000, right or not? Taxes paid is 35,000. Now your cash flow from operating activities is how much? 1,37,000. Take it in the outer amount column. Okay. Then you have number 2, part 2, cash flow from investing activities. Cash flow from investing activities, where you have now please see, tell me your goodwill decreased. Okay, land and building was 2 lakhs, it has become 1,70,000. But this fellow says on land and building depreciation is only 20,000. What does that convey? Still there is 10,000 deduction. No, 2 lakhs minus 20,000 should be 1,80,000. It became 1,70,000. What does that mean? Sale of land and building for 10,000 rupees. Okay, that is one thing. Next, plant depreciation is 10,000. Now look at plant there. 80 has become 2 lakhs. That means purchase of plant exists. Okay, so these two we are supposed to take. Sale of land and building. Okay, so it is directly you can take 10,000. Inflow, purchase of plant and machinery, it is 80,000 minus 10,000. Okay, plus 2 lakhs. Okay, so that means it is 1,30,000 outflow. Okay, people. So finally you have something called cash outflow of cash flow from investing activities. Outflow is 1,20,000. Agreed? Interest income ekkadundi kana, that is interest expense kada, it will go in financing activity. Over. Next, number 3, cash flow from financing activities. Before we forget, let's finish off that interest thing now. Okay, interest on 8% preference shares, spent 12,000 rupees. Outflow, brackets. Okay, now look at each of your transactions liabilities side. Equity share capital 3 lakhs has become 4 lakhs. If it is issued for other than cash, he would have given you some note point about it. Nothing is mentioned, you can assume that it is for cash only. Okay, so equity shares issued 1 lakh, preference shares redeemed 50,000 outflow. Why? Because 1,50,000 has become 1 lakh. Yes or no? General reserve P&L need not do. Proposed dividend you need to take. Dividends paid during the current year, you thought it is 20,000, but there is 42,000 also paid. Yes or no? So dividends paid from your working note 3. Please see, it is 62,000 paid, dividends paid. Okay, చిన్నగా నిద్ర వస్తుందా? Okay, so with this, your cash flow from financing activities would be done. Value please, 24,000. Positive or negative? Negative. Okay, now what is your net cash flow? It is lakh and 37,000 minus 1,20,000 minus 24,000. 7,000 negative. Now to this, please take your opening cash and cash equivalents. Opening cash and cash equivalents, how much is it? It is 25,000. Okay, closing is 18,000. So tallied. Opening cash and cash equivalents is 25,000. This is negative. So your closing cash and cash equivalents would be 18,000. Sixth question. Next question. Please see, the following data were provided by the accounting records of Rian Limited at 31st March 2016. Sales, cost of goods sold, gross margin, operating expenses, including depreciation of 37,000. Then other income, interest expense paid, interest income received, gain on sale of investments, loss on sale of plant, profit before tax, income tax paid, profit, income tax provision, profit after tax, comparative balance sheets, share capital, reserves and surplus, bonds, current liabilities, accounts payables, accrued liabilities, income tax payable total, assets, plant assets, less accumulated depreciation, investments. So please take this as this is total, guys. I mean, like net of 7,15,000 minus 1,03,000, 6,15,000, that is okay. Basically, investments is this. Okay, inventories is the same. Inventories is accounts receivables. Some alignment issue, please don't bother. వాటిని కాపీ చేసి ఇక్కడ పేస్ట్ చేశాను, సో ఎగిరిపోయింది అనమాట. ఓకే, సో cash and prepaid expenses total. Analysis of selected accounts and transactions during 15-16. Purchased investments for 78,000, sold investments for 1,02,000. These investments cost 90,000. Purchased plant assets for 1,20,000, sold plant assets that cost 10,000 with accumulated depreciation of 2,000 for 5,000. Issued 1 lakh of bonds at face value in exchange for plant assets on 31st March 2015. Repaid 50,000 of bonds at face value at maturity. Paid cash dividends 8,000. Issued equity shares 15,000. Equity shares at 10 each. Prepare cash flow statement using AS3 indirect method. This is a satisfactory problem from your perspective, I believe. Okay. ఎక్కడ స్టార్ట్ చేయాలి ఇప్పుడు? Did he tell you what is profit before tax for you? He already told you. Okay, 23,000 is profit before tax. Starting point is already given. You need not start from profit after tax in this problem. You can start from profit before tax. So start from profit before tax. You know what is your all this loss on sale of plant, sale of investment gains, interest income, interest expenses, depreciation. All these are something which you know what to do. Okay, reversals to be done. Reversals to be done. And then he talked about some transactions here. We will see when we go there. We will see individually when we go there and pick it up. Okay, so let's begin. In this problem, not much of what do you call notes to be prepared, working notes to be prepared. You can directly start doing it. Okay, so sixth question, start with cash flow statement of whoever for the period. Okay, start with particulars, amount and amount. Okay, number one, cash flow from operating activities. Start with profit before tax. Profit before tax is given as 23,000. Add depreciation given. Depreciation given is 37,000 in the question. Okay, 37,000. Then interest expense paid. How much is it? 23,000. Then loss on sale of plant 3,000. Add okay. Then you have interest income received, gain on sale of investment 12,000, 6,000 and 12,000. Okay, take those less interest income 6,000 within brackets, gain on sale of plant is 12,000. Okay, now apart from this, is there anything else to be done? Please see the notes which are given below. So purchase of investments will not come there. So sale of investments, he says it is profit is how much? 1,02,000. These investments cost 90,000. That means 22,000. Yes or no? Did I take that gain of sale of investment? Oh, 12,000. Sorry, we have taken already. Okay. Plant purchased, not required. Sold plant, accumulated depreciation is 2,000 for 5,000. That means your book value is 8,000. You sold for 5,000. 3,000 is the loss which we already recognized. Next, issued 1 lakh of bonds at face value in exchange of plant. This we did not take, need not take in operating activities. Next, repaid 50,000 bonds at face value, not required to be taken in operating activities. Issued shares, not required. Dividends paid, not required. Okay, so I think at this juncture we can Draw out what is cash flow before working capital changes. 68,000 it seems. Now, what working capital changes do you have? You have inventories account, you have trade receivables, you have prepaid expenses. So or no? Inventories, last year it is 1,44,000, this year 1,10,000. What does that mean? Cash inflow or outflow? Inflow. In Emma? Oh, sorry. Okay, I told you the numbers other way. Dates totally. So it is outflow. Okay. Then accounts receivable 55,000 has become 47,000. Inflow reduced. Then prepaid expenses 4,000 has become 1,000. That means what? It reduced. That is inflow. Okay. So that is inflow. So these three first let's put down. Inventories, debtors, and prepaid expenses. So inventories, how much it is? 34,000 outflow, debtors inflow 7,000, prepaid expenses 3,000 inflow. Then income tax payable not required to be taken. Oh, it is 8,000. 8,000, not 7,000. Sorry. Debtors it is 8,000, not 7,000. Then from your liabilities perspective, you have accounts payable 43,000 has become 50,000. That means it increased. That means cash is with me only now. Inflow 7,000 inflow. Then accrued liabilities, which is outstanding expenses, 9,000 has become 12,000 inflow 3,000. Then you have income tax payable does not come. Okay. So creditors 7,000, outstanding expenses 3,000 inflow. What is now? Do you have any extraordinary items? No extraordinary items. No. You can directly jump into cash flow before tax and the 55,000 less taxes paid. Taxes paid. Did he tell you tax paid? But he gave you provision. 5,000 is opening. Current year provision is 7,000. Closing is 3,000. That means what is it netted? 5,000 plus 7,000 minus 3,000. 5,000 plus 7,000 minus 3,000. It is 9,000. So please take 5,000 plus 7,000 minus 3,000. 9,000 is tax paid. Finally, you get cash flow from operating activities. 46,000. Okay. Next. Number 2. Cash flow from investing activities. You have a lot of things to do here. Okay. Now, you purchased investments for 78,000, yes or no? First item he has given you here. Take that. 78,000 is purchase of investments. Sale of investments for 1,02,000. Purchase of investments 78,000 negative. Sale of investments 1,02,000. Okay. Purchase of plant 1,20,000. Okay. Sale of plant for 5,000. Anything else apart from this? Look at your P&L, your operating activities. You have taken down interest income 6,000, yes or no? You need to now consider that. Okay. Interest income 6,000. Okay. I don't think anything else is there apart from this. Please tell me what it is. Cash flow from investing activities. 85,000 negative. Then part 3. Part 3. So this is done. This is done. This is done. Now, if there is issue of bonds in exchange of plant, will you take? No, there is no cash flow in it. Okay, this will not come. Repaid bonds of 50,000 on maturity, it will come. 50,000 cash outflow. 1,50,000 equity shares issued will come. Dividends paid 8,000 in cash will come. Okay, so these three items let's take first. Cash flow from financing activities. Start with bonds redeemed 50,000. Then you have issue of equity shares 1,50,000. This is negative. Uh, bonds redeemed is negative. Issue of equity shares is positive. Okay. Then what else do we have? Dividends paid. Dividends paid 8,000 negative. And apart from this, in your operating activities, if you see, you have taken interest expense 23,000. Yes or no? You need to take that. Interest expense 23,000 outflow. Finally, you get cash flow from financing activities. Value, please. 69,000 positive, negative. Positive. Okay. And then your net cash flows are going to be 13 or 30. 30,000. To this, add your opening cash and cash equivalents. Opening cash and cash equivalents, how much? Cash and cash equivalents, it is 16,000 opening. Okay. So 16,000 and automatically closing is 46,000. With this, I'm done from my side as a responsibility. Any doubts? Segment reporting, huh? Okay. segment report, be it AS or Ind AS, there is no difference. First thing, most important, it's all the same. Now in segment reporting, you will have to do 5 types of tests, of which first 3 are 10% tests. Next comes management choice. Next comes 75% test. Okay, so what are the first 3 tests? The 3 tests are, first is 10% revenue test. 10% revenue test. Second is called as 10% result test. 10% result test. Third is called as 10% assets test. Okay, on doing all these three, if out of all segments, if a segment satisfies any one of these tests, that becomes reportable. Okay, say for example, I have 10 segments, A, B, C, D, E, F, like that. There are 10 segments. Out of these 10 segments, segment A satisfied first test, segment B satisfied third test, segment C did not satisfy any test, like that. D, E, F, G, okay. Now C, D, E did not satisfy any of the tests, but A, B, F, G and other segments also have satisfied the test. Now since it has satisfied one of the tests of 10%, you will consider them in your segment report. Now a test ఎట్లా చేయాలో చెప్తాను తర్వాత. After selection of these segments from your 10% test, if the management feels segment E, which is a upcoming segment, it might not look very promising today, but I want this to be known to the investors. In such case, management can enforce this into the segment report. That is why we call it as management choice. On considering this management choices segments also, if the revenue of the total segments reportable, total of revenues of all the segments reportable is less than 75% of the external revenue, of external revenue, in such case you should add so many number of segments such that your segment report gives information of at least 75% of external revenue. That is why this 75% is there. So the very objective in giving this segment report is, I would like to give to the users of financial statements full details of what all businesses I have. And when I say full details of what all businesses I have, I would like to give them majority of the lines transactions. With that intention, this 75% test is brought in. Okay. Now individually, how do I conduct these tests is something important. When I say 10% revenue test, it indicates that I am going to test the revenue generated by one particular segment compared with the total revenue of the entity. If this one particular segment's revenue is more than 10% of the total revenue of that entity, it becomes reportable. Same way, 10% result test. This is very important. Why this is important is because here you do it based on absolute numbers, but not based on the net profit or loss. Okay. Now what does this mean? It means that I would take all segments in profits. Say for example, again I have 10 segments, 1 2 3 4 5 6 7 8 9 10. Okay, I have 10 segments. out of these 10 segments, first segment, first 4 segments, say they are in losses. Next 6 segments are in profits. For these 4 segments, I would say what is the percentage of what is the result of these 4 segments individually. Okay, individually, maybe this is 5 negative, maybe this is 10 negative, maybe this is 2 negative, this 8 negative. Okay, and segments in profits, these are all profitable segments, 10, 20, 30, 5, 10, 2, whatever. Okay, now you should take all segments in profits and see what is the 10% out of that. If any of these segments satisfy that, you take it. You take it. Again, out of these also, you see what is the 10% of the all these segments in losses. Now, in absolute numbers, that means you don't look at profit or loss now. Say, for example, in this you have got 3, negative 3. Okay. Here you have got negative 8 or positive 8. Okay. Don't look at plus or minus. Don't look at plus or minus. 3 is the least number. Any number, any profit or loss, if it is beyond 3, becomes reportable. Any number beyond 3 becomes reportable. That means 1 is reportable, 2 is reportable, 3 will not get reported, 4 will be reported, 5, 6, 7, 8, 9, 10, everything reported. 10 will not get reported because it's only 2 again. Okay. This is what you do in case of results test, 10% results test. Please note, I am going by absolute number. Absolute number. That is the important parameter here. And then you have something called as 10% assets test. When I say assets, those identifiable segment assets is what we need to take. At times what happens is I might not be able to allocate few corporate assets to a segment. Leave them aside. Leave them aside. All your assets together, out of which a segment's particular assets is what you compare. If a segment's assets are 10% of the total assets of the company, that assets have to be, that segments become reportable again. Okay. So on completion of these 3 tests, then management choice comes, where management specifies what segments can be added to the report. Okay, what segments can be added to the report over and above the tests which qualify, over and above the segments which qualify in the first 3 tests. After this entire process is done, you have chosen 6 segments to be reported. 6 segments to be reported in the total segments. You still have 4 more segments. Now, if the revenue of these 6 segments put together is less than 75% of the total revenue of the company as a whole, total external revenue of the company as a whole, very important, total external revenue of the company as a whole, you need to add 1 or 2 segments, or you may add all the segments also, to make it at least 75%. To make it at least 75%, that's the objective in doing the segment report. Now, once the segments are identified, how do I prepare the report? Report preparation is fairly simple. Standard says you are only giving segment-wise data which is necessary for the users of financial statements. You need not give deep dive of numbers. You need not give full breakup of numbers. All what is expected is particulars, segment A, B, C and all in the horizontal axis, and you would give what is the revenue, and you would give result. Need not give full breakup of expenses. Need not give, in fact should not give. Why? Because that is good enough as competitors information for other entities. Okay. For that reason, if you just give revenue, top line, bottom line, along with that assets, segment assets, if you would like to give a breakup, you may also give geographical information. You can also give geographical information. That means the first three are mandatory. After that, in your segment report, whatever data you are adding, as long as it is not detrimental to the interest of your company, you can keep adding. Okay, what all information will I add? I will add geographical, saying that in this segment, I have domestic sales so much, international sales so much, or if you would like to give continental information, in Asian continent so much, Africa so much, you can keep adding information geographically also if required. Otherwise, there's no requirement at all. Okay. Yes. Anything else? All right. So thank you so much for the patient listening, for attending all the 3 days continuously. I hope I made some value creation. Uh, now, all the best for your exams. Please do well. Message me whenever. Fairly speaking, మీకు ఎప్పుడు కూడా క్యాష్ ఫ్లో స్టేట్మెంట్ ఖచ్చితంగా వస్తుంది ఒకటి, క్యాష్ ఫ్లో ఒకటి, అండ్ ఈసాప్ మ్యాండేటరీ క్వశ్చన్. ఏమున్నాయి మీకు మ్యాండేటరీగా వచ్చేవి? స్టాండర్డ్ క్యాష్ ఫ్లో స్టేట్మెంట్, ఇదే రెండే మెయిన్ మ్యాండేటరీ. కన్సాలిడేషన్ ఒకటి ఖచ్చితంగా వస్తుంది, బిజినెస్ కాంబినేషన్ ఖచ్చితంగా వస్తుంది. మనం ఆల్మోస్ట్ అన్నీ చేసినట్టే ఇప్పుడు. అది అన్నిటిలోనూ ఒక మోడల్ అయితే ఖచ్చితంగా చేశాను నేను. ఓకే, రైట్. థ్యాంక్ యూ సో మచ్. స్టే కనెక్టెడ్. నంబర్ ఉంది మీ దగ్గర. See you. Bye bye.